Ladies and gentlemen, good morning. Can I please request everyone to take seats because we are about to start now. Everybody in front of the gates, request you all to take seats. The RBI governor will be joining us shortly. Could you please take seats? Everybody standing on the right side of the hall, please. Ladies and gentlemen, can I please request everyone standing in front of the door to please take seats? The RBI governor is in the hall. We'll start shortly. Request everybody to please take seats. Ladies and gentlemen, can I please request everyone to now take seats? Good morning, ladies and gentlemen, and welcome back to the day 2 of the 12th SBI Banking and Economics Conclave here at the Taj Mahal Palace, Mumbai. Yesterday, we explored verses and thoughts along policy preambles, transformational leadership, evolving ambit of services, industry strategies, and the macro-financial landscape, all together shaping India's economic landscape and its upward trajectory. Today, we continue that journey focusing on growth with purpose, sustainability, and India's demographic future. Now, to begin the day 2 and set the context for our exciting lineup of discussions ahead, may I please invite on stage Sri Ashwini Kumar Tiwari, Managing Director CBNS at the State Bank of India for the welcome remarks. Ladies and gentlemen, please give him a huge round of applause.
Respected Governor RBI, Shri Sanjay Malhotra ji, Chairman SBI Shri Sethi, my colleague Shri Rana, Managing Director, members of the board, other staff from SBI, our guests, many of whom would join us in the panels to follow. Ladies and gentlemen, good morning. This is the second day of the 12th SBI Banking and Economic Conclave, and we resume from where we left yesterday. The evening performance of the breathless but breathtaking performance by Shri Shankar Mahadevan, probably still fresh, and the events are moving at a real fast pace. Just to give a little bit of a recap, I know Saloni did it yesterday, but for those who were not there, we had the gracious presence of the Honorable Finance Minister, and who had very graciously come only for this session. So we again thank her. And her inaugural address shed the light on future path towards self-reliance in an increasingly fragmented world. And she talked about the concept of self-reliance or Atmanirbharta, which she clarified is not isolationism, it is essentially a active participation in global value chains, developing homegrown solutions and technology or otherwise, and that work for not only domestic problems, but also for global countries and people. And she acknowledged the role of banks in the financial self-reliance, which is part of economic self-reliance. She, in the end, also exhorted the banks to keep the physical touch along with the digital, have a local connect with special focus on using local language, vernacular for serving customers, and also said that banks must further support MSME. They've done so, but more support is required. This was followed by a very interesting CEO panel, which had a large variety of CEOs, ranging from Anish Shah, the head of the conglomerate Mahindra Group, who talked about his ambition to have his company amongst the 50 most admired companies Even after he was pushed to give some numbers to that, he resisted the idea but said, this is what we want to lead with a sense of purpose. We also had Mr. Vikas Kaushal, the HPCL chairman, who talked about the investments HPCL is making and the challenges which have come with the sanctions in the crude oil space. Dipali Goenka, representing Welspun, again talked about the textile industry, which again has challenges in terms of the sanctions, or rather tariffs, which have been imposed. Dr. Praveer Sinha from Tata Power talked about the fact that India is in a really sweet spot as far as renewable energy is concerned, and we should be able to achieve the targets which are set in very, very seamlessly. We also had Upasana Taku, who leads MobiKwik, a fintech, and this was a completely different lens versus growth versus the need for cybersecurity and keeping customers safe. And finally, we had R. Dinesh, who leads the logistics company, TVS, and therefore he talked about from a TVS, working on logistics, which is currently very fragmented. After this panel, we had the keynote address by Shri Tuhin Kanta Pandey, the chairman of SEBI, who pointed out that the trend for household savings to move to investment is a secular trend, and he gave some numbers to show this. For example, from 2019, the number of unique investors have moved up from 38 million to 135 million in 2025, and similarly, mutual fund unique investors have moved up from 10 to 56 in this same period. And the rate of growth of mutual funds and securities in these 5-6 years is at a CAGR of 24% versus bank deposit growth of 9%. So this is something we have to recognize and then work accordingly. And if this is the trend, then how do SEBI and the different regulators, including us at banks, keep the customers safe and have customer education as a key element of having a proper asset allocation? And this was followed by a talk by Shri M. Nagaraju, Secretary, Department of Financial Services, who shared his valuable insights on a number of subjects, such as the requirement of a double-digit credit growth for achieving Viksit Bharat. He talked about 13.3% credit growth for a 22-year period. And thankfully, the banks are getting there, and therefore we expect that we should be able to measure up. He also asked banks to continue to support MSMEs, agriculture, education loans, and said that the service in the branches must continue to be better and consistent. And this was the day yesterday, followed by Shankar Mahadevan's performance, as I mentioned, and today's proceedings. We have a beginning with a keynote address by the Governor RBI, Shri Sanjay Malhotra, and we look forward to hearing you from sir, and followed by a unique family business panel, which will talk about scaling with purpose. So this has been a unique feature since the last two editions of this event, where we are calling younger heirs or those who will lead the companies in future and trying to understand what their thoughts and their vision is for the companies. This will be followed by a green panel, which will take up the issue of sustainable opportunities and how do we achieve self-reliance here, and also achieve our national commitments towards the climate change, despite the fact that the external environment is not so conducive today. And followed by a post-lunch session, we'll have two special addresses by the Deputy Governor RBI, Shri T. Ravi Shankar, and this would be followed by an economist panel, which has a very interesting topic, which is, will India get older before it gets richer? I have to compliment Dr. Ghosh for being a little provocative here, but we hope to see some good views expressed here. And the last special address will come from Dr. V. Anant Nageshwaran, the Chief Economic Advisor to the Government of India, who will talk about his views on Indian economy, the views of the economy growth in the foreseeable future, and again, how we can achieve self-reliance. The policy perspective coming from him will be of interest to many in the audience. So I hope the audience will find all these topics interesting, informative, and use these key takeaways to fine-tune things back home. And let me now take the opportunity to welcome Shri Sanjay Malhotra, Governor RBI, to deliver the keynote address and set in motion the second day of the 12th SBI Banking and Finance Conclave. Thank you.
Chairperson SBI, Mr. Sethi, MDs, members of the board of SBI, esteemed industry leaders from the banking and finance world, media, ladies and gentlemen. I'm delighted to be here, as always, in this SBI Banking and Economic Conclave. I thank the chairperson, SBI, and the whole SBI family for giving me this opportunity to be here. This conclave comes at a time when there are unprecedented uncertainties, geopolitical tensions, technological disruption, and so this is very timely. It affords us with an opportunity to dwell on what the challenges are, and at the same time, what this offers to us, more importantly, I would say, in terms of the opportunities. I recall about a year ago when I spoke at this particular conclave virtually from North Block. I talked about the reforms that we carried on in the taxation sector. And today I stand here before all of you to talk about some of the regulatory changes that we have brought out in the last few months. You are aware that earlier we had issued a regulation-making framework for RBI, in which we have a consultative process. We are trying to make it more open, more consultative, more data-driven, more evidence-driven. And so we do a consultation, a public consultation, which has been formalized in the framework. We set out the objectives of the regulations, and we do an impact analysis. So in line with the same spirit which has been given there in the framework, I propose today to shed some more light on the objectives and the rationale for some of the important measures that we have taken in the last few months. To set the context, I would like to reiterate what I said in my first MPC statement in February this year, and whatever we have done in these past few months, including the last MPC statement, is in line and consistent with what I had said in my first MPC statement. I would reiterate that, and I had said that the interest of the national economy demands financial stability. For us in the Reserve Bank, this is the guiding principle. This is the North Star, because short-term growth, which is achieved at the cost of financial stability, can have bigger consequences for longer-term growth. Research shows that financial instability may not only more than offset the gains of short-term accelerated growth, but may also make recovery more distressful and longer. At the same time, economic interest warrants increasing efficiency and promoting innovation, which also is the duty of RBI. We recognize that just like there are no free lunches, regulation to enhance stability too is not devoid of costs. There are trade-offs between stability and efficiency, and I had assured that we will keep this trade-off in mind while formulating our regulations. I had mentioned that it will be our attempt to strike the right balance, keeping in view the benefits and costs of each and every regulation. The recent regulatory proposals strive to attain that balance between the drive to innovate and grow on the one hand and the duty to protect. Moreover, in a rapidly evolving banking system, underpinned by technological advancements of tectonic magnitude, no regulator can afford to situate the system at a point of time. The role of the regulator is to guide its evolution within guardrails that ensure stability, fairness, and resilience. In India, this philosophy has found steady expression in RBI's approach towards regulation, what might be called responsive conservatism, a model that prizes stability yet remains open to reform, change, and improvement. In this context, while all of you are aware, you are all veterans in this field, but I think it would still be germane to briefly recap the developments of the past decade in the financial system, in which we have made huge strides, as you are all aware. SBI has become a $100 billion bank. That is also part of this journey. So post the GFC, in the wake of aggressive fiscal and monetary stimulus, the ensuing regulatory forbearance sowed the seeds of the twin balance sheet problem: over-leveraged corporates and stressed balance sheets of the banks. Coupled with the manifestation of external sector vulnerabilities, India got clubbed amongst the so-called Fragile Five. Guided by the principle never to waste a good crisis, the period from 2014 led to a foundational surgery to restore the long-term health of the financial system. This was driven by a series of regulatory measures aimed at recognition, resolution, and recapitalization of the banking system. The AQR, initiated in 2015, compelled banks to recognize the true state of their loan books, bring hidden NPAs onto their balance sheets, and significant improvements were also brought about in the supervisory framework. Simultaneously, the Prompt Corrective Action Framework, the PCA framework, helped restore the health of weak banks. It was followed by consolidation of 27 public sector banks into 12 by 2020. These measures, complemented by massive recapitalization program, strengthened the balance sheets, the capital buffers of the banks, and restored their capacity to resume healthy lending. SBI chairperson was just now mentioning as we entered that in 2018, they were in a loss. And today they are a $100 billion company. The introduction of IBC in 2016 and the pursuant resolution paradigm introduced through out-of-court workout mechanisms have fundamentally transformed India's credit culture. Parallelly, major reforms were taken to strengthen monetary as well as macroeconomic stability. This includes the adoption of the flexible inflation targeting regime, the deepening of the forex markets, and the gradual liberalization on the capital account. The recent past has also seen a number of transformative measures. Financial intermediation has now become a sophisticated and layered system. There are nimble fintechs and NBFCs that assume a greater role in origination. Development of capital markets and credit risk transfer channels such as securitization now provide a conduit for risk transfers. The project finance directions issued recently address risks arising from regulatory approvals and availability of land, etc. The proposed forward-looking ECL provisioning will force earlier recognition of the deterioration in asset quality and provide for appropriate loss buffers. Moreover, all of you are aware, Indian banks today are far more mature than they were a decade ago. Credit and deposits have expanded almost 3 times. capital buffers to have strengthened. The CRAR has improved by about 4% from 2015 to 2025. Similarly, the CET1 has increased from 10.43% to 14.73%, an increase of 3.4%. Asset quality has improved, GNPA and NPAs have decreased, profitability has improved, return on assets, return on equity, all have jumped. 17-18, it was negative, as was that of SBI. To give you some numbers, return on total assets was negative 0.24 for the bank, for the scheduled commercial banks in 17-18. And that's not very long ago. And today, it's 13 points. Last year, it was 13.7%, and it has been consistently positive and in double digits for a very long period. So regulation cannot ignore these developments, this performance, these changed realities. This evolution implies that the prudential rule books too should evolve in a calibrated manner as banks are now stronger, supervision more alert, even as alternative risk-bearing pillars have deepened and market-based risk transfer has become more effective. The recent regulatory measures need to be seen in the backdrop of these developments which have shaped the banking industry and the financial system over the last decade. Let me elaborate on a few measures. First of all, I'll speak on the draft guidelines on the capital market exposure. The proposals to enhance the limits for lending to individuals against securities and rationalize the norms for lending to capital market intermediaries are part of the normal process of review, seeking to reset the limits which were set way back 26 years old ago in 1999. Importantly, the revision in limits has been accompanied by a more structured LTV framework, which is sensitive to the risks of the underlying securities. The proposed removal of limits on loan against debt instruments while retaining the regulatory limits for equity instruments recognizes the fundamental difference between these two, equity and debt, from a risk perspective. The key risk a debt instrument carries is credit risk. And just like loans, credit risk is expected to be managed as part of the broader credit risk management framework. An additional comforting factor that has been brought in these regulations is that only listed and investment-grade debt securities are proposed to be taken against collateral for these loans. This rationalization is expected to foster a virtuous, positive feedback loop for the development of the bond market. As regards acquisition finance, which is also part of the CME, this is acknowledged worldwide as an integral element of an evolved financial system that helps in better allocation of financial resources. And recognizing this need, even within our own country, non-bank players such as the NBFCs and the bond markets are already allowed to provide such funding. Removal of the restriction on the banks will benefit the real economy, and these come, as you are aware, as the draft puts out, with guardrails like limiting bank funding to 70% of the deal value, limits on debt to equity ratio, aggregate exposure limits relative to tier 1 capital of the bank, eligibility criteria, etc., which will ensure safety while allowing banks and their stakeholders to reap benefits of additional business. Let me now turn to the withdrawal of the specific borrower framework, which was introduced in 2013. 2016. This framework was instituted in a very, very different financial environment, as I just mentioned, when the banks were almost reeling under losses. This was a unique measure, which perhaps to our knowledge, no other country has ever implemented at the bank level, at the system level. At that time, the banking system was grappling with elevated levels of stress, which no longer is the case. The tier 1 capital of the banking system as a whole was only about 8 lakh crore rupees. Today it is 26 lakh crore rupees, 3.2 times, more than 3 times what it was. On the other hand, the overall share of exposure of the banks to the corporates has considerably reduced. The regulatory landscape, as mentioned earlier, has evolved significantly. The large exposure framework, which is aligned with international best practices, is now well established. The supervisory toolkit is vastly improved, and therefore, it is proposed to substitute the blanket risk weights and provisions in the extant framework with better monitoring and risk management by the banks. Coming to risk weights for infrastructure exposure of NBFCs, I would like to highlight that the proposal seeks to prescribe risk weights on the basis of the risk profile of the exposures. However, certain conditions have to be satisfied to qualify for the lower risk weight. One, there is a set of qualitative criteria that has to be fulfilled ab initio. The details are there in the guidelines. And two, a principal repayment criteria that would demonstrate a reasonable performance track record before the risk weights can be lowered. As regards the ECB external commercial borrowing framework, these measures come against the backdrop of a strong external sector. India's current account recorded a surplus of 13.5 billion US dollars in the last quarter of the last financial year. This is 1.3% of our GDP. Even the first quarter of this year, we had a modest deficit of only about 2.4 billion US dollars, or 0.2% of our GDP. The foreign exchange reserves, all of you are aware, are very healthy. Even on the capital account, the flows are very robust. Net inflows to India under the foreign investment, ECB and NRI deposits, in fact, were higher in the first quarter by almost about $4 billion. They stood at $30.4 billion as against $26.8 billion in the period April to July. Our projections show that the capital flows will remain quite strong even during the rest of the year. The calibration of the ECB framework, therefore, is a natural step in India's financial evolution, grounded in strong fundamentals, guided by prudence, and inspired by confidence in the economy's capacity to engage with global finance on its own terms. The removal of all-in cost ceilings will encourage competitive rates and promote prudent hedging behavior. Expansion of the universe of eligible lenders will improve pricing efficiency. Linking the borrowing limits to the borrower's net worth under the automatic route links ECB to the strength of the borrower while enhancing ease of doing business. This limit and the overall soft ceiling of total outstanding being 6.5% of the GDP will mitigate the risks, if any, of excessive external leverage. Moreover, I wish to clarify that ECB will be permitted only for FDI-compliant real estate projects and remain prohibited for speculative dealing or loans for land or property trading. To summarize, all these measures are balanced and appropriate, built on the bedrock of a banking system that has been systematically fortified over the last decade, with financial stability remaining the unwavering cornerstone of our policy architecture. All these changes are incremental in nature, and I quote what Shakespeare said, "We are moving wisely and slow. They stumble that run fast." At the same time, while we move with caution, we need to display courage. And again, I am reminded of Shakespeare. It's dangerous to take a cold, to sleep, to drink. I repeat, it's dangerous to take a cold, to sleep, to drink, to do normal activities is also dangerous. But out of this nettle danger, nettle is a plant which has some thorns, etc. But out of this nettle plant, which has danger, we pluck this flower, safety. So these measures do reflect some fresh thinking, but they are incremental, and they do not introduce any sea change. Moreover, no regulatory measure, as I mentioned earlier, can be understood in isolation. Each measure has to be seen in the continuum of regulatory evolution and not in isolation. These proposals must be read against the broader regulatory scaffolding which mitigates all these risks. Together, the regulations create a multi-layered defense to keep systemic risk in check. Analyzing merely one regulation without understanding the complete regulatory landscape risks missing the forest for the trees. Let me highlight that the higher responsibilities placed on the banks are based on their past performance. This is on account of improved governance, prudent decision-making by the banks over the last decade. As highlighted earlier, capital buffers are stronger, asset quality better, profitability much improved. Regulation has evolved, keeping in mind, regulation therefore has to evolve, keeping in mind the realities of time and the performance of the banks. Moreover, no regulator can or should, as far as possible, substitute for boardroom judgment. Especially in a diverse country like ours, each case, each loan, each deposit, each transaction is different, different risks, different opportunities. We need to allow the regulated entities to take decisions based on the merits of each case rather than prescribing a one-size-fits-all rule. This will enable regulated entities to experiment and innovate, to learn and improve. At the same time, wherever we have allowed hitherto prohibited activities or reduced restrictions, or we have proposed to reduce them, we have provided, as mentioned, sufficient guardrails to ensure safety and prudence. I may also mention that the role of a regulator does not end just by providing the regulations. His role is like that of a gardener whose job does not stop with providing the enabling framework. The gardener keeps on monitoring the growth of the plant and prunes unwanted growth to shape a collective, orderly, beautiful garden. RBI has ample tools, risk weights, provisioning norms, countercyclical buffers to contain emerging risks. History shows our readiness to act, as was seen most recently in November 2023 when we raised the risk weights for certain types of consumer credit. Needless to say, therefore, supervisory action have enabled effective backstops to moderate or prune unsustainable growth and shape a robust, resilient, and beautiful banking system. Finally, let me emphasize that most of these regulations, measures that we have put in place, they are draft, even though they have been issued after great deliberation, thought, and a pre-consultative process. And while they do reflect the broad direction of the regulations, they are not final. We will take inputs from all stakeholders, and we'll finalize them basis those inputs. Before I conclude, let me also touch upon some of the changes introduced with respect to consumer grievances. The Reserve Bank has maintained a persistent focus on enhancing customer service standards and strengthening grievance redressal systems. Recently, in the last few months, 2 campaigns, one has been already organized, and the other one, the first one relating to financial inclusion has been already organized, and the other one now related to unclaimed deposits is in progress. Good work has been done by the banks, and I'm sure they will continue the good work in this regard. And so in this direction, we have now put out 2 regulations, one for the internal ombudsman and the other for the RBI ombudsman's scheme, which are being proposed to be refined to further improve and enhance their efficacy. It is imperative that the regulated entities too address consumer grievances through mechanisms that are fair, transparent, timely, and without undue cost. The regulated entities may kindly assess the quality of customer service through periodic and regular thematic studies. Effective root cause analysis of the complaints may also be conducted to identify systemic issues so that such complaints and grievances do not arise in future. I would request all the MDs, CEOs, senior management present here and listening for their full support and their attention in ensuring that the proposed changes, once finalized, are implemented not only in letter but also in spirit. To conclude, I would like to emphasize that our approach is calibrated, granting banks greater commercial leeway for growth, innovation, and ease of doing business, while ensuring that the risks to the banks are minimum and financial stability is ensured. We have set ourselves an ambitious goal of becoming a developed country by 2047. The financial sector has a big role to play in it. RBI remains committed to this goal. We will ensure that our financial system evolves responsibility to support innovation, growth, and the long-term resilience of our economy. I'm sure that the deliberations in this conclave will help in taking this developmental agenda forward. I commend SBI for this initiative, and I wish the conclave a huge success. Thank you. Jai Hind.
Sir, could I please request you to stay on the stage? Thank you so much, sir. It truly looks a very important and enthusing day. Now I request Chairman, sir, to please present the RBI Governor with the green certificate. Ladies and gentlemen, a huge round of applause for the RBI Governor, Sanjay Malhotra. Now, our first session this morning brings together policy, regulatory, and monetary perspectives at the highest level, and we heard all about it. Let me now move on from this and request everybody to please take seats again as we are about to begin with the first panel of the day. Everybody, please be seated in your seats. We are about to begin with the next panel. Everyone in the back who's standing in front of the gates, could I please request you all to be seated? Okay. Ladies and gentlemen, let's now move on to our first panel of the day, the topic for which is scaling with purpose. Now, family businesses are the backbone of Indian enterprise, and many are now entering the next era of professionalization, global expansion, while ensuring continuity of legacy. The conversation will explore how scale can align with purpose, culture, and long-term stewardship, even as core competencies get redefined. Please join me in welcoming on stage our moderator, Professor Tulsi Jayakumar of SPJIMR. A huge round of applause, ladies and gentlemen. And to our panelists, Shri Ankit Kedia, founder and lead investor, Capital A, Manjushri Technopack Limited. Ladies and gentlemen, the applause should not stop. Shri Sumit Kabra, Director RR Global, Shri Pranav Sharma, President Baidyanath, Shri Siddharth Agarwal, MD Systematic Group of Companies, Shri Rama Mohan Rao, MD IBG M&T at State Bank of India. Ladies and gentlemen, a huge round of applause for panel number 1.
Hi, good morning. Can you hear me? Okay. So it's a very interesting panel in the context of today's conclave. Why are we looking at a bunch of family businesses? Because family businesses constitute more than 80% of the businesses in India. Small and medium businesses in particular contribute to more than 30% of the GDP. They account for huge employment. They also account for more than 40% of the industrial production and more than 45% of the exports. So what you have here on the stage is just a small set of the kind of businesses that drive India and that are going to probably take India to a $1 trillion economy and, as the RBI governor spoke about, a developed economy by 2047. But what are the kind of contradictions that we are talking about here? We are looking at these businesses being driven by the 3 Ps, of course, which have to be very, very critical going forward, driving the businesses through profits, planet, and profit. But more importantly, driven by a 4th logic, which I call perpetuity, which is the 4th P, which seems to be a supraordinate logic, trying to reconcile some of the conflicts among these 3 logics, which are the people, planet, and the profit. We're also looking at a tumultuous world. We're looking at a changing world order, greater and greater demands being made on costs and competitiveness, and possibly the moment of truth where you will have to kind of contend with a moment of truth as family businesses, because you not only have to look at scaling, but you also need to be scaling with purpose. And that's what this particular panel is all about. Let me also tell you that there is a research, though it's not something which I believe in, but there is a research which talks about a 30-13-3 rule, which is that family businesses typically do not survive into the 2nd generation more than 30% of them do not survive. More than 13% do not survive the third generation, and more than 3% don't survive beyond the fourth generation, right? And I was looking at some statistics. Most of Indian businesses are in the second generation. So does that spell disaster for India, or is it that we need to look at the way in which we could probably turn around the curse? So we have with us panelists. We have Mr. Ankit Kedia, who is second generation business, right? So he was leading Manjushri Technopack, a family business, which they sold out to a PE fund. And Ankit himself is someone who has set up his own venture capital fund, which is Capital A. Then I have Sumit Kabra here, who is the director of RR Kabul. RR Kabul has gone in for an IPO recently. It's in the wires and cables business. I have to my right Pranav Sharma, who is the director of Baidyanath, one of the very, very old and well-known Ayurveda companies in the world. But Pranav himself is an entrepreneur, and he has started a bunch of companies, Shunya being one of them. He also has pioneered the group's journey into renewable energy, bioethanol, LNG, and nutraceuticals. To my left, I have Mr. Ram Mohan Rao Amara, the MD of International Business, International Banking Group, the Global Markets and Technology domains at SBI, someone who has been a banker for more than 35 years now. Thank you, Mr.
Perhaps an odd man in the group.
No. I think they bank with you. And to the extreme left, I have Siddharth Agarwal, who's the managing director of Systematic, which is a group which has currently gone in for an IPO. And Siddharth himself represents a family business, a second generation, but he started Systematic with his family's support on his own. So a round of applause for this panel. I think it's an extremely good panel that we have here. So let me just start with the first question, and I could have any one of you answering this. When we are looking at scaling, right, what are some of the non-negotiables on the path to growth? How are you looking at balancing ambition with responsibility? We could start with you, Ankit.
Good morning. Maybe check. Let me take a stab at that. One of the things with getting involved with the packaging industry is that you have to be creative at all times when you are dealing with various FMCG brands like Unilever, Nestle, Coca-Cola, Pepsi. You have to be creative with your packaging. And that then begets the need for innovation. And one of the things that we kept trying in our growth trajectory was to keep doing these small dipsticks with innovation, small ideas with, where we kept saying that, can we try this, can we try that, can we develop this, can we get a machinery to manufacture this part or that part. And what happened is, in that process of doing these continuous experiments, we always landed up in, out of 10, at least 4 times, ending up with something very different from what our competitors are offering. And in that sense, that growth sort of started from a DNA of innovation. That as a company innovates continuously during its journey of, the generation 1 building the foundation of the business, and then generation 2 blending with the DNA of the foundations of 1, as well as some new ideas of generation 2, sort of blending that and amalgamating that into some innovative ideas. A few non-negotiables for us was that at the core of it, we never lost sight of customer centricity. And I'm told that the finance minister spoke about it yesterday, that customer centricity is so important. The experience of the customer for a packaging can be great, but if I'm not able to engage with them continuously, and if I'm not able to sort of meet them on fundamentals like, processing their order on time, timely delivery, and making sure that they are felt, important, I think that sort of loses, that sort of completely dilutes the overall functioning of the business. And for us, that was a very big non-negotiable.
So non-negotiable for you was customer centricity. Great. I think that's something which almost every business would speak about. But I'll just give you my perspective on why customer centricity becomes even more important for family businesses. I've heard family businesses saying that the way in which the family stays together is through the value of everyone saying that customer is God, and whatever differences we might have, but when it comes to customer centricity, that's what binds us together. So interesting that it is the profit logic which kind of reinforces your perpetuity logic, right? Yeah. So I would also like to ask maybe Pranav about the moats that you created. You're looking at Ayurveda, the kind of moats that are required for Ayurveda to kind of stand up against modern day, medicine or modern day products. What are some of those moats of excellence that you created, and the networks that may have helped you to create those moats?
Good morning, everybody. First of all, I am a third generation, so I am actually in the other side that you were mentioning a short while back.
Okay.
But I'm glad that for 108 years, we must have done a few things right to keep things afloat and growing, hopefully. So to answer your question, we have had to rediscover the way Ayurveda has been looked at from a consumer perspective again, because we are looking at customers in the form of doctors as well as retail consumers. Outside India, more so, because outside India, there is a healthy skepticism to understand what Ayurveda is, to understand what natural products for well-being management is. Because we are not talking about a parochial problem. We are talking about an overall problem where we are trying to address the consumer's issues, and we are not talking about only the vested interests of manufacturing companies like ours or anybody else. We have to keep the patient and his requirements at the center, at the core, and therefore the nutraceutical division that we started was more to actually align with doing combination therapies between novel ingredients that are well researched, well documented, safe, and we are able to blend that with the age-old tradition of our herbal understanding of Ayurveda, and trying to standardize evidence-based so that we can actually give more and more confidence to the consumer who is taking these products. Because we all today, even when a modern doctor prescribes the product, we all use our Googles or Chat GPTs to actually check the pros and cons. So it's not very difficult for anybody to lose confidence in the best of doctors, sometimes advising something that maybe from the doctor's perspective the right thing to do, but from the consumer's perspective may not be the right thing to do. So therefore, in that sense, all of us have become very, very discerning. And we cannot today shortchange the consumer at any point in time. So I think for us, the learning has been that we have to reinvent novel delivery forms. We have to improve our communication. We have to make it crisp, clear, and we have to make it customer-centric to the point where if we are targeting a doctor, then we are trying to address the gap in doctor's repertoire. So if a doctor has a particular therapy where an allopathic product, for example, may not be giving him the desired results, then can we come in and give him that solution in that segment? So I could give you an example, but it will become too esoteric. So I'll leave it at that. Thank you.
I'll come back to you, because from a 108-year-old company to starting Shunya, you went back to zero. So we'll want to hear that story also. But coming to Mr. Amara, is it capital which is a constraint to the family businesses today, or do you see the challenge as something beyond capital?
I think in the beginning phase, anyway, the promoters are there to bring in their capital, and by virtue of their connect with the local community and the trust they have from the community, they will be very easily able to mobilize the capital needed. But the issue arises once they want to diversify into other lines of activity, or diversify into different customer segments, or diversify into various geographies. More than capital, it calls for certain fundamental changes. The challenge here is like the model of family business is endowed with a lot of positives. We know like the entrepreneurial spirit, the ability to identify a business opportunity much before others, and the ability to quickly execute that by mobilizing the resources is tremendous. And of course, they have a very good reputation among the community. But for scaling up, definitely, I think a different ballgame is required. They need to professionalize the entire setup. They need to invest in technology. More so particularly not only in their internal operations, they should also offer a kind of D2C kind of play they need to have in e-commerce. And of course, it goes without saying, like professionals have to be there in various areas, like whether it is a financial reporting or disclosures have to be more authentic and reliable. And of course, I mean, finally, what you said, the purpose. I think they need to now figure out, like, while they transition to a much more diversified, a professionally run entity, how do they keep that original idea of delivering value to the community and still having a professional setup, not losing it in a different, in the new avatar? I think that will be the challenge. But if these elements are in place, I'm sure there are plenty of players, not only the traditional banks, there are other risk takers like NBFCs, AIFs, etc., who are willing to provide capital to them.
Correct. Yeah, absolutely. I'll come back to some of the other challenges that you as a banker might face. But Siddharth, from a family business which was into manufacturing of steel tapes to starting your own wires and cables business at the age of 23, what prompted you to diversify? And that's what Mr. Amara was also speaking about, the need to diversify. And how did you keep purpose as your North Star as you went about diversifying? Today you have successfully executed an IPO, so that's quite a journey in itself.
Yes. Hello. Yes. Good morning, everyone. So at the age of 23, we don't know what to do. When I was in college, and the most interesting thing, they were talking about management, they're talking about leadership and everything. So I used to ask to my friend, सबसे important है कि माल बिकेगा तो आगे सब कुछ होगा. So first, the most important thing is the sales. So we don't have the revenue, and we are talking about management. But now, after coming about 20 years, and now I can recollect all the chapters, that leadership and family business and all those things, management are the most important thing, because those are the crux, and you can, with that, you can control the business. Just adding on the scalability, what is there, that one thing which I work on this, that companies like where we operate is very highly competitive industries. So where all the models in terms of technology, people, and products are replaceable, or you can be, other person can copy from one person to another person. So what had worked for me is human connection. So for example, I have 3 bankers since the banking summit. So 3 bankers are giving to me the rates, and everyone is giving the same rate. Someone is giving almost the equal rate, but I will work with a person with whom I feel comfortable with. So I will go with a person with him I can connect and I can sleep peacefully. The same thing I want to apply to my customer. So what we can do is, if you are dealing with systematic, you can sleep well, you know that everything will be taken care, and your life would be easy. So I work on those principles and move the journey from that place to this place.
Great, thanks, Siddharth. So Sumit, coming to you, it's again a wires and cables business, and it's a business which is extremely price sensitive. Where others are competing on price, you have looked at safety, you've looked at things like trust as your differentiator. So one, how do you look at these as differentiating elements? And two, it's okay for you to speak about safety and trust, but how do you operationalize some of these things?
Good morning, everyone. Thanks, SBI and Madam, to felicitate this panel. Well, our name, RR Kabil, itself distinguishes and differentiates on the safety level. When we say we are the only company in India who represent as RR Kabil, so outside the Asia, if you go, the European regions, they mention as wires as a Kabil. And that's what we decided from the day one, that we will make a best European wire and cable quality and make in India and make sure that we export to the Europe and the rest of the world. Well, when it comes to safety, of course, for us in a price-cutting market, it's very important. We found out a lot of import substitute and also as a solution provider to our customers. When I say, I still remember, we designed a fire alarm cable in 2010-11 itself, where even if the fire is there, the circuit integrity will be on for at least 3 hours. And that equipment for testing was not available in any of the labs in India. That's what we designed at point of time, where after there is a fire on the wire, and there's a mechanical stabbing where we run on the fire. We designed that whole system, mechanical heating on the wire, and after 15 to 20 minutes, there's a water sprinkling where ambulance and other fire brigades are coming, and how the wire performs after the fire as well. And this is kind of innovation and depth level we have done. And so, of course, it's very paramount to be competitive in the world, but at the same time, what we learn from it, if you are able to or create some solution provided to your customers, you can sustain in any of the markets and you can create a brand out of it.
That's a great perspective, Sumit. So, to Ankit, what we find today is, and this is something which I've seen, a large number of the next generation seems to be moving away from wanting to do the operations, to run the operations of the business. I was recently in conversation with a young family business scion from south of India, and she's a female. She currently runs the operations of the business, and she was telling me how in the south, in Hyderabad in particular, a lot of the family businesses have set up family offices with the next generation running the family offices. So what does the move away from leading the operations to becoming investors mean for family business capital in India?
You know, I sometimes grapple with this question a lot, that, you know, you were a part of a family business and then you exited that business and now you have set up your own venture capital fund. And while I know you are not implying it, but I've also in other forums sort of got a feeling that, you know, it's easy money. Your father, you got this money in inheritance, or you got this capital in inheritance, and it's easy to deploy this money in a bunch of startups and wait for them to grow and sort of give you the returns. Thankfully, and while that exists in many other scenarios, I joined the business in 2006. Just to give you a little bit of a backstory, my father came from Assam. We used to manufacture umbrellas there because it used to rain a lot in Assam. And we then shifted in '95 in the midst of extreme terrorism, insurgency, and all kind of things in that area. And when we moved to Assam, I think we didn't have it easy. When I joined in 2006, right after college, I was actually put on the shop floor, and I was not given a fancy cabin. I was given a small cubicle to help the production planning department. Now, the reason why I'm giving you this story is there is 4 years of that time that I spent on the shop floor, and though I'm a business graduate, taught me so much about engineering and the science of packaging and blow molding that no other engineering institute could have taught me. Only in 2010, when I was about to get married and my in-laws were coming to the factory, did my father promote me to a cabin because he said, the in-laws are coming to see the boy. It's not nice to see you working in a cubicle. Let me put you in a cabin. So some of these things, also happen by chance. It also happens to manage optics. I was very fortunate to put 15 years of operational experience before starting my fund, and the ability or the deep operational expertise that I was able to inherit from the family business sort of helped me to deploy this money. And now as we run the fund and when we sort of mentor a lot of entrepreneurs and a lot of companies that we are investing in, it just gives us so much joy to sort of use those same experiences to tell these folks what not to do. What to do they usually figure out, but at least what not to do and what the pitfalls are, that becomes very important. That's the thing that we've sort of seen in this entire generational pass on. We have the new generation coming in. My uncle's son is coming into the business. He's all of 21, 22 years. Surprisingly, he is absolutely interested in one of our other packaging businesses, and he likes the fact that he is supplying to brands like Starbucks, Chayos, Chai Point. Is also a part of the a premier MBA institute. So I think it's also going the reverse way, where a lot of newer generation folks are leaning on to the family legacy to create newer legacies for themselves.
So, according to you, the capital is not going to be dissipated, it's going to grow. That's what you would say.
Absolutely, absolutely. Capital is commodity now. We are getting access to capital thanks to the banking system, thanks to the private equity markets. But I think the legacy that we inherit is going to be invaluable.
So I would like to ask Mr. Amara at this point of time that when you're dealing with family businesses as a banker, what are some of the points that you would want to insist on in terms of, say, governance within the family businesses? Is that something that you're looking at? Because increasingly, I think that the business dailies are splashed with news about some more conflicts and some more issues within family businesses. And these are leading to a capital being dissipated, not just for the family, but for also multiple shareholders.
Yeah, a very, very pertinent question and very contemporary. I think as a lender, generally, whenever we look at any, taking a exposure to any company or any business, fundamentally we look at three parts. One is the financial risk, how it is faring. Right. More than that, of course, the business, the sector in which it is operating, and more importantly, what we call a management risk. Management risk. What we mean is, it's a very nomenclature. Management risk essentially means, is there a proper succession plan for a promoter who has been successful so far, with whom we have a very satisfactory relationship. They have been repaying our liabilities very well, and it is also growing, and their working capital or the term loan or project finance requirements are growing. But back of our mind, always the thought is there, like what is the succession plan, and whether, as Mr. Ankit has said, whether that second generation is taking an interest actually in the activities, are they being groomed in the traditional business or not, that aspect definitely we look at. Second aspect, of course, is whether it is being run by professionals. I mean, while the oversight of the promoter can be there, even when they age, etc., that has to be there, but day-to-day affairs and the execution, operations, etc., are they being managed by professionals, whether there is a qualified CA to take care of the financial reporting, whether there is an operations head to run the operations, and whether they have a proper marketing, and more importantly, whether they have a business plan, which talks about like what is their ambition, etc. So I think these qualitative aspects actually gain a lot of importance more than the financial ratios, etc.
That's a very, very important point, and I believe that all family businesses need to keep that in mind, that while you're going forward, the legacy that has been built is not the legacy that will continue if we do not take into account putting in place some guardrails. So, Pranav, when you have expanded your business and when you have moved into newer businesses, how is it that you're ensuring that the points that Mr. Amara was speaking about are being put in place for your legacy business, even while, you and Sidhesh and the others in the family are diversifying into newer and new ventures?
I think to his point, when we actually looked at doing infrastructure and getting into areas which were sort of resonating with the family, with myself, that we were doing clean, green medicines, we said, why can't we also get into sustainable businesses, which is basically your next, the Conclave's next forum discussion is on sustainable climate change businesses. We said that what is it that India is looking for? India is looking for renewable energy. India is looking for bioethanol to blend in petrol so that we can reduce our import bill and genuinely make ourselves more Atmanirbhar and of course move our economy from fossil fuel based economy to more greener economy and making ethanol probably as a base fuel, moving the share of gas from 6% odd to 15% is what the government of India was also planning on doing, and they actually announced it a few years ago. So we looked at LNG again as the cleanest form of hydrocarbon in that sense, which was environmentally friendly and also economically friendly, because in developing markets, E stands not necessarily only for environment, it also stands for economics as much as environment, and that's the practical aspect. But to actually answer this question differently from a family business perspective, when you look at infrastructure and you look at infrastructure financing, you look at equity IRRs, you have to approach lenders, you have to look at raising finance at competitive rates on terms and conditions that actually make sense for the business and the investment and the investor, so that it basically gives every stakeholder something in the chain to make. So when we looked at renewable energy initially, of course, there was a lot of hesitation because Baidyanath and consumer businesses largely were businesses that were negative working capital businesses. We did not need to borrow too much term loans, too much working capital in that sense. But when you actually look at infrastructure, you're looking at completely the opposite end of the curve. So I did have a challenge in explaining this to my father, but I had to build my own equity, not only internally but also externally with lenders. So I'm happy that in the last 15, 20 years today, lenders are more and more comfortable lending loans to our infrastructure projects with me being in the center and not the family, because giving collaterals, giving personal guarantees, all of these are very touchy issues in third generation family businesses, and I'm sure lenders would experience that a lot too. So negotiating, doing the commercial contracting right, and all of that becomes very essential to ensuring that the family as well as the business can actually remain in harmony.
Absolutely. So that we'll come back to that, but Siddharth, how difficult or easy was it for you to get your family to agree for an IPO? Because I'm just speaking about this tendency of family businesses not to want to lose control. And that goes to even borrowing. So most family businesses would say with pride, we are a zero debt company. And you're looking at you going in for an IPO. So how difficult or easy was it to get your family to agree to an IPO?
So I'm very fortunate that we had our IPO ringing ceremony in the same hall 1 month back. Okay, and I'm talking about the same event here. So for me, it was not very difficult, as my father was, it was my father's dream that he wanted it to happen. And so there were two choices. I could have waited more and make it much more bigger. But then I thought that sometimes your father's dreams are more important, and that's why we went. And in terms of integrity wise, I will say that we have not diluted any offer for sale. We have kept all the money in the company. So our thought process is that we have to grow with this, and we have to multiply, and whoever has put the faith and trust in the company, we have to give multiply the rewards to him.
What about you with the IPO? What was it like?
So for us, IPO was a clear plan because TPG was an investor who invested with us in 2018. So roadmap was clear from the day one, and we gave ourselves good enough time to prepare ourselves, almost 3 to 5 years, where a lot of structural changes were there on the top management level. And also the best practices and the governance were implemented during this time. So for us, it was a very easy roadmap to execute for an IPO.
So the family in particular did not see it as something, because I've heard you saying this, keeping the family together when you're making some of these decisions becomes extremely critical. So what was that large purpose which held you together?
Well, of course, once you decided that to get PE on the board was one of the tough decisions. So, but we have a good culture, I always say a statement in family business, हमारे बीच में मतभेद है, but मनभेद नहीं है. and this is what we say again and again in our mind to get the consensus at one level. And we follow the structure. If majorities are aligned towards one decision, we always 3 other sides support to that decision.
Sure. So I would want to ask the 3 largely family business people right now here, and then Ankit also possibly. How do you adopt a patient mindset in an impatient world, right? Because family businesses are known for their patient capital. They are looking at not just quarters, as I call it. They don't follow a QSQT, a quarter se quarter tak model, but they are looking at it in terms of generations. And here we are talking about an impatient world, a tumultuous world, a world where the order itself is being restructured. How do you ensure that you keep a patient mindset as members of the 3rd generation or the next generation, even while, and how do you also look at the Gen Z, which is your next generation coming into your business? How do you ensure that there is a certain amount of patience, jisko kehte hain ठहराव, right? How do you manage that?
To partially answer that question, when we look at what foundational values our forefathers built in the brand, we really take inspiration from that, because in today's times, everybody is looking at burning cash at the rate of knots. Traditionally, we always looked at building sustainable competitive advantages for growing the business and keeping it afloat and relevant, and not only looking at valuations. So I think over the last few years, and without disrespecting anybody who's doing it today, and I'm sure all the Gen Z businesses, the new businesses that have come about, you look at the Zomatos and the Blinkits and all of these guys, they're doing phenomenally well. But there are so many other businesses which are also growing, which are brick and mortar. And we feel that the values that our forefathers inculcated, those values still remain very, very relevant. For example, if there is efficacy lent to a particular product using a particular method that was prescribed in the traditional texts, today if we try to shortchange that, there are differences in the efficacy levels that you actually see, even though you will end up making more money in the short term. To the point of RBI governor's speech initially, when he said
Absolutely.
that at the detriment of
Long-term value.
you should not look at only short term.
Correct, absolutely. So, Sumit, your thoughts on patience in an impatient world?
So I completely agree with Pranav. Like the value systems which have been imbibed with our elder generation in ours. And I always say that, this values imbibe is not in the boardroom, it's always in the dining room, where we discuss with our father, grandfather, and elder generation that what should be done on the personal side. Well, of course, patience are important in this FOMO world, especially where many a times you feel that this startup started before 10 years and they are $1 billion, and you see yourself struggling for 27 years and trying to build up a $1 billion. So this kind of, comparison, the pressure from the outside world, this is certainly creating certain pressure, but we know where Pranav said that long-term strategy, the end of the day, profit matters a lot. And we know that we are building up a sustainable and profitable model, and we have to build up on that. So we always believe that our foundations are strong on profitable and sustainable model, and we have an opportunity to focus more further.
Sure. Yes.
So for me, patience does not mean being slow. For
Right.
me, patience means to have a clear-cut map, being consistent, being persistent, and sometimes that you have like something short term which you can do, and okay, you get the sales, but which is not good, doesn't fit in your value system. You invest in the people, you invest in the process, and sooner or later it is going to give you returns. They say that you have to have belief in yourself. If you have belief in yourself, then things will grow.
Sure. And sir, Mr. Amara, have you seen a difference in the way in which when you're banking with a startup versus when you're looking at a family business? What is the difference that you would note?
Yeah, I think incidentally, among the banks, we were the first ones to start what is called startup branches. That is, we realized, even though we had a very elaborate setup by way of SME intensive branches, and for larger corporate needs, we have CCG branches, CAG means corporate accounts group branches, we felt like catering to startup is a different ballgame altogether. Particularly the ones who are starting in the beginning may not be fit for a bank financing straight away. I mean, their needs are very, very simple to begin with. Some transaction banking and some personal banking needs of the promoters have to be taken care of. So we have set up these branches in the startup hubs. It also, besides the traditional bankers, they also have people from the wealth, they also have people from the cards, payments, etc., to help them start their operations. And they also actually connect, once the proof of concept is done and once they're confident of actually showcasing, we also connect them to the investors. In fact, we also have our own venture entity, but of course, if it is not fitting in their scheme of things, then we connect them to the others. But once they reach a stage, I mean, I'm talking about a kind of maturity where it's a commercial scale kind of operation, it is only like they need growth capital, definitely we pitch in there. We have created special schemes, and I should credit even the government of India for encouraging financing to startups in a big way. They came out with a scheme up to financing startup up to 20 crores without any collateral, without any personal guarantee of the promoters. Up to 20 crores we can extend. So we are leveraging that actually for the startups. So we realize startups is a different ballgame altogether. It needs to be approached with a different mindset, not a traditional mindset of looking at positive cash flows, sustained profit. These things don't work there. So you have to take some kind of bet, but it is calibrated and a calculated bet we need to take. And we also know some of these startups have the potential to become unicorns, and actually their requirements will increase further going forward. So we actually would like to always handhold them wherever we come across.
Sure. And maybe the new age startups are going to be the old age family businesses, as I think this panel represents. Ankit, just taking this conversation forward, how do you look at these new age businesses which come to you for venture capital and they're chasing value? So what are you looking at? How do you separate scaling with purpose from those who are merely chasing valuations?
There has been a lot of discussion around startups, valuation, and it's also reflecting in some of the market caps of some of these startups who are listing right now. And we are seeing companies like, Lenskart drawing criticism from the shareholders for its, perceived cost economics and valuation. Maybe let me break this down into two parts. One of the things that these startups, the idea for these startups to first of all, take that leap of faith and go on to their entrepreneurial journey was never to start a business which will organically grow or would never be a lifestyle business. The startup is always, you have an idea, it's a new age idea, and it can be grown with agility. If these elements are missing in the foundation of the startup, then it was never a startup to start with. It was always a lifestyle business. Secondly, the first phase of venture capital money that came in, that was sometime between 2010 and 2020, has led to the torching of so much capital. So much capital has eroded into funding startups that are, were never focused on revenue, profitability, defensibility, differentiation, and was always based on some vanity metrics. That has unfortunately sort of set benchmarks for the startup industry as a whole. We've seen some amazing success stories with Flipkart, with Swiggies of the world coming from the foundries of India. But what's happening is you will see a lot of media attention towards the real economy, the manufacturing economy, that everyone is talking about. The entire China plus one story. We perhaps might not become a China plus one story in the immediate future. can we get there perhaps in the next 10 years, is where the government, the policymakers, the state governments are all framing their policies in that direction. And startups who fundamentally believe in the valuation game perhaps won't survive that long. The VCs are also pressing the reset button on this entire valuation metric. They are focusing on what matters. And for us at Capital A, we back manufacturing businesses because that's the business I understand. And that's tangible, that has credible outcome. The evolution of startup entrepreneurs from pure play tech to hardware plus tech is being witnessed now by the industry. So it's no longer a game of valuation anymore.
Sure. I'll just wrap this up before we'll take about a question or two. What does purpose mean to you? Anybody can go. Purpose to you means what? Pranav?
I think purpose is genuinely to solve a problem, and the problem solution and the problem solving has to happen in a value accretive manner for the company, the customers, everybody, so
All
that
the
everybody comes out winner. So, I'll give you a quick example. When we thought of starting to look at Ayurveda globally, we said, what could we do? So let's say we started with a small country in Europe called Romania. And we said that, can we start to own the way doctors prescribe nutraceuticals and natural products in this country? So we actually went about setting up the entire company's systems and processes in such a manner that everybody was set up to succeed. And today, in about 3.5 years, 14,000 doctors in Romania are actually prescribing Ayurveda-based Nutra products. And today, we are the fastest growing nutraceutical company. I'm not boasting about the company here on the platform, but I'm just trying to buttress the point that if you have the entire incentive systems correctly in place, you don't really have to have robust HR policies. If every employee knows that at the end of the year, after achieving what is it that he or she can get, I think they are automatically motivated. You don't need to have convoluted, long, protracted sessions on management or motivation when everybody is motivated with your clarity as the leaders of the organization.
Sure. Sumit?
So for our company, purpose has been always to build up a safety wire. There are thousands of people who die every year because of the short circuit. And we decided from day one, whatever we takes, we'll sell only safety wires in the market. Well, purpose helps, I think, 4 steps. It's always there. Purpose helps you to decide your priority. If purpose is clear, your priority is there. And if your priority is there, it will help you to increase in your productivity. And if your productivity increases, which generally results into profit. So if you follow these 4 steps, which will lead to the profit. So purpose to the profit is for me like this.
That's a very nice thought. Okay. Yeah.
For us at Capital A, our purpose is very simple, is to make our founders successful. We don't have any more jargons to add to it, because whatever we do at the end of it, we just come back that the success of the founders will lead to our success and everyone else's success.
Sure. So that.
So I think purpose would be different for every person. For me, purpose is to being happy. So if I am running an organization, I should feel happy with the people around. And it is my dream that to have an organization, even if I'm not there in the world, to have an organization where people feel connected and the organization keep growing. So that is my purpose of doing the business.
I can also add from a banker.
I wanted to ask you a question also, because
Slightly
you
deviation.
wanted the last word with SBI.
So, I mean, we already play a very significant role in the development of the country. So our purpose is to continue to play that role in a much more effective manner,
Sure.
But also taking care of interest of all the stakeholders, whether it is a customer, whether it is employees, whether it is a community, or whether it is the shareholder. I mean, all put together, we want to take care of the interests. Yeah.
But I wanted your last word on how would you see the rock star businesses, family businesses from the also rans? How would you define those businesses?
I said in the beginning, I think particularly when they want to become rock star or when they want to scale up the operations, certain basic elements have to be in place. Talked about technology, talked about professionalizing the entire management kind of setup, investing in internal control, strengthening, while at the same time carrying the virtues of the family business. They connect with the community and living with that purpose. If they're able to combine all these things, I think they will become the differentiator as compared to the rest of the pack.
Thank you all so much. We'll open the floor to some questions. A couple of quick questions if there are. Who have a question?
Hi, ma'am. This is Adi Shankar.
Oh,
Firstly, I want
hi,
to tell,
Adi.
yeah, ma'am, how are you?
Good,
That's
good.
what I'm about to tell, that I am also SPGN
Yes,
student.
yes, yes.
And nice to see you here. And I know what we learned from SPGN definitely. And ma'am, now, so I'm so happy to see the family business entrepreneurs on the stage. And firstly, thank you very much for the SBA for giving this opportunity also. Ma'am, basically in this family business, when it is growing, definitely, you know, there is no problem. As one of entrepreneur, he said that the startups are basically a lifestyle changes. Like, you know, when they see the gap between the market, definitely, you know, new idea generates into the startup. And sometimes we have seen number of startups are very successful. In that case, you know, when the traditionally, conventionally industries, you know, since ages 30, 40 years, we were into the industry and we are not able to, you know, catch that trend. So when that third generation or fourth generation, you know, assess, okay, this is the trend and this is the gap, we need to fulfill that. And how do they handle for the change? How do they convince their forefathers and fathers for the change? This is one thing. And second thing, ma'am, in the family business, what luckily my father and my uncle is also here. Luckily, they are very supportive. When I have entered into my business, we were doing 275 crores and now we are into 3,000 crores because they have given that liberty for me, and we have digitalized massively. But, you know, so many companies I don't see, family-owned companies, you know, they were not so upgraded, not so advanced. But what is the message you give them, how to convince their fathers and forefathers for the change? Because when family is growing, number of brothers are growing, definitely one say yes, one say no. In that context, how do you prove yourself this is correct for the market?
So this question is to whom?
Actually, any of them can
Anyone can answer?
Ankit
Including the moderator?
Ankit ji? Yeah, anyone.
Yeah, sure.
I will take a, I'll take a stab at it. You know, when we were just starting off, one of the things that, in fact, Sumit and I, when we were in the same batch, and we sometimes used to discuss this back in college, that, you know, we will, as new entrepreneurs in a family business, you always have this idea, and if you have a new idea, you blow air into this balloon and blow that balloon so big, in your mind you think this is going to be the best idea ever that will transform your company. And then when you take it to your dad, he probably has a pin behind just to go and prick that balloon and burst that balloon, and there goes your idea. I think most of these times these ideas exist in our head and not really in reality, because if we are too premature, the day you join the business and the day you introduce those ideas may not come into life. At least that was my experience. I was fortunate to have a lot of advisors and mentors, you know, in the business. Some of them are sitting amongst us. We actually had to earn it. And the way to earn that was to earn the trust of your family that whatever you are doing right now is aligned with their ways of working for some time. Once you understand the business and then you say, I have this new idea which I want to try, can I take a stab at it? That's an organic journey. That's been my experience.
No, absolutely. I think two things here, Adishankar. One is the trust that you have to earn, right? It can't be that, oh, I'm now 18, I have this idea, as Ankit said, and that the world is going to change because my idea is going to be put into order, right? So that's one. The second is also for the senior generation to be educated on this concept of what I call a stop loss. What is the amount of risk that they are willing to place? What is the bet they are willing to place on you? And what's the amount of money that they would lose on a new idea, which is yours, or any other new idea for that matter? I think both of these would be important for all new ideas to be tested and verified. But before that, you have to earn the trust.
Yeah, and I think just to add to whatever you said, very clear division of roles within the family when you are actually expanding and the family is also expanding. Because it does so happen that whenever you are assessing risk in a family business or a reward in a family business, you're always having the benefit of hindsight. So, you know, when a business is seeded to when it actually matures and starts making money, there are differing perspectives, and the moment it becomes successful or not so successful, the views are always very, very differing. And if you can have a constitution or some sort of a vision statement or a clear statement of purpose within the family of who's entitled to what, because the other problem in family businesses, I would say, apart from all the opportunities that we get, is the sense of entitlement. Because we are born in that family, we should get the capital by default. And to Sir's point that we must have professionals therefore and have the ability to actually concede to the professionals because they are professionals and they're actually going to be able to help you add more value than you can as a family business, to actually realize that and have people who are far more intuitive, far better than you. You know, in Harvard they say in the business programs that, you know, how many decisions do you make based on numbers and how many decisions you make based on gut. You know, they are saying that you should move 90% plus the decisions based on numbers rather than only gut. And of course, there is an element of risk in the business, which is why you can't solve all the problems or all the pieces of the puzzle. Otherwise, it would have been like an FD. And there would be no upside. So I think those things are very, very crucial when you are actually trying to put the building blocks into place.
Okay, I think we have completely run out of time. And I think that's time, right? Yeah, yes.
I have one observation. I don't call it question. The very purpose of bringing you guys here is essentially to understand that what is the trajectory for Indian family-owned businesses. Let me tell you, 90% or even more of the businesses which India witnesses today all have started as family businesses only. I mean, this differentiation of family business is artificial. Every conglomerate what we deal with today essentially started as a family business somewhere. But the success story of these conglomerates also you need to absorb and observe and understand. And what, in fact, my question, Adi, has preempted me asking that. The basic friction comes in the family business from a financing point of view. We have seen a lot of businesses over the years, is that each generation would like to pursue something different. And how the families facilitate that is the one which made conglomerates to grow and survive. Whether you take Tatas, Birlas, Adanis, Ambanis, all of them have started as a family businesses, but they were able to, our family members were allowed to think beyond certain boundaries. So, as I agree with Tulsi in terms of allocating certain risk capital for each generation. You can't risk the whole family business, obviously. You know, this is what we look at. Are you risking your fundamental basic business by venturing into non-core activities, what we call non-core? But if you are convincing the financiers that this is a capital which we are willing to set aside and allow our family members to think differently, is something what I would definitely recommend to all the family businesses, That is how the conglomerates have grown globally.
Absolutely.
If any of you want to supplement my view, you're welcome.
Sir, I completely agree. I recollect the 2018 conversation where fortunately very few deals happened where we got a secondary money from TPG. So after a long time in growing business, you never have a free capital cash flow to spend on yourself or probably the new ventures as well, right? So this was the first moment where we had a good significant amount to live a luxury lifestyle. Me and my brother were sitting in a room with my father and said, like, okay, you have two options. Either we buy all luxury cars and houses and everything and stay good life and the original business is continuing, or else we have a startup businesses where we will invest and try to create 1,000 crore valuation out of that. It was really me and my brother who took an intuitive call along with my father who gave us an open culture and open environment to take this bold step. You won't believe, within 5 years, brother and me, we are able to create 2 startups which is valuing more than 1,000 crores right now at this stage. So it is all up to you. Like, so we ventured into electric scooter segment. We built up a very good technology on light fidelity where through laser beam communication we give internet connectivity, and through visual light communication we are able to transfer the data. And we are working with defense right now. So altogether new sectors opened up in last 5 years which we never knew, and we started all together.
So in my experience, what I would see, and which is actually aligned with the theme of today's session, is that it's not enough for you to think you have a purpose. It's also important for you to be very clearly communicating that purpose to multiple stakeholders, not as a marketing rhetoric, but also as an internal marketing for your own family members, where everybody is aligned to that purpose. There is a clear line of communication. There is freedom to voice opinions, and people are allowed to think and to be able to put their points across. I think that purpose and the way the buy-in of every family member into that purpose is actually actively sought is going to make the difference between kind of a family business that SBI would and any other banker would like to finance versus one which you would not want to touch with a barge pole, right? So I think on that note, we could stop here. Thank you all so much for a wonderful discussion. Thank you.
Thank you so much to all our panelists. I would now request Chairman Sir to please come on stage and present our panelists and the moderator with a memento. Ladies and gentlemen, a huge round of applause for this panel, the panelists as well as the moderator. Thank you so much to everyone. Moving on to our next panel, the topic is navigating climate challenges through sustainable opportunities. may I please request everyone to be seated so that we can begin with our next panel. Now, climate transition is not just a responsibility, it is a growth frontier and a vector for sustainable next-gen practices that fortify our competitive advantage. This discussion brings together leaders shaping India's green financing playbook, renewable energy strategy, and sustainable business frameworks. Before I call the panelists and the moderator on the stage, can I please request everyone in the front and at the back to please be seated so that we can begin with this panel. Okay, ladies and gentlemen, please put your hands together for the moderator of this session, Ms. Ritu Singh of CNBC TV 18. Also, the panelists, may I please request to come on stage, Shri Pradeep Kumar Das, CMD IREDA, Ms. Hina Kushlani, Partner Climate Change and Sustainability Services at EY India. Ladies and gentlemen, please a huge round of applause for Shri Jayant Dua, Business Head Renewables and DTAFOS at Aditya Birla Group, Professor Kasturi Das, Chairperson Sustainability and Social Responsibility at IMT Ghaziabad, Shri Ashwini Tiwari, MD CBNS at State Bank of India. Ladies and gentlemen, panel number 2.
Well, good afternoon, everyone, and thank you all for patiently, or should I say good morning still. We're 10 years on from the Paris Agreement. The world has made a lot of progress, but not nearly enough is what a lot of people would say. But India's story does stand out. We have, at least on paper, achieved 50% non-fossil power capacity 5 years ahead of schedule, and the IEA, that is the International Energy Agency, now does see India becoming the second largest renewable market in the world. But the road ahead is not without challenges. It is steep. Climate vulnerabilities are still rising. Global finance has not really matched up to the commitments that we need. And we, as a country, still face about a $2.5 trillion funding gap to become a net zero nation by 2017. So how do we navigate through these tough journeys, these challenges, and also seize the opportunities to come out on top? That is what we're going to discuss here on our special panel through finance, technology, and policy that will truly make India sustainable and self-reliant. On that note, let me welcome all of you again. Thank you all for being here, and thank you all, for patiently standing by. Professor Kasturi Das, if I could start with you to really set the context for where India really stands in its journey towards a green future. Apart from what we're seeing on paper, having achieved 50% of our net renewable targets ahead of schedule, where do you think India truly stands?
Thank you, Ritu, and thanks SBI for having me here. Coming to your question, I think, let me also tell you that if we look at the international scenario, as we speak, in a few days from now, the world is gearing up to meet in Belém in Brazil for COP30. And this is a remarkable moment that we are at this juncture, because this year marks 10 years of the Paris Agreement. That has created a lot of difference in terms of climate action globally. If we look at India over the past 10 years, I think the country has come a long way, be it in terms of government actions, be it in terms of business actions. It is not only in the regulatory space, but also in terms of different missions that India has launched for the national level as well as international level. It is also important for us to note that most recently we have come up with the Indian carbon market, which is a very important development. Why I'm saying it is important, it is not only because this is going to send the right kind of price signal going forward to the businesses and to incentivize them to do more in terms of climate action, but it may also help India navigate the kind of climate-related trade measures that we get to see coming up in the form of, say, carbon tariff in the European Union and other parts of the globe. Why I'm saying this, I can elaborate later on, but I think at this point I would like to stop there. And I would like to mention that while a lot has happened and a lot has been talked in this event about climate action in the mitigation space, I think it is important for a country like India, which is very vulnerable to climate change, to look at adaptation, which is not always looked up, in great detail. And I would like to emphasize on that. And that also means in the adaptation space, there is a lot of co-benefit in terms of development, dividend that we can reap. So this is something I would like to, talk about little bit in greater detail later.
Okay.
Thank you.
Sure. Hina, I think adaptation finance, that's something you wanted to touch upon. So just set the context for us in terms of where we're at and how much distance we have to cover.
Thank you. Thanks for having me. It's a pleasure to be a part of this esteemed panel here. On adaptation finance, I would say globally, this is a fairly niche. I wouldn't want to say niche. I think this needs to be mainstream. But unfortunately, it still continues to be niche, a concept that globally every country is dealing with. The reason being, I think most of the investments we've seen globally are mitigation, which is opportunities in renewables, opportunities in electric mobility, opportunities in so many other new technology. But when it comes to adaptation, the reason it's important and we need it now is, for example, last year, and according to a report that was just recently published, India had $12 billion of damage due to natural calamities. If you look at it, this could be around 10% of the budget that we're spending in some form. Now, we can, of course, dig deeper to say, hey, how is it 12 billion? What constitutes here? Primarily, the damage is infrastructure, agricultural productivity. There's also productivity in terms of human workforce due to heat waves and many others. Now, the reason we need it now is that we no longer are in a phase to say, is climate change going to happen, not going to happen? The reality is we see it every year. We've seen the change in climate patterns. It's causing impact as we speak. And how is this being integrated into our business decisions, right? So there are two parts of adaptation finance. One is every single penny that we're spending now, is that being looked at from a climate risk lens or not? The second piece is for the damage that's happening, how are we catering to that damage? There is currently very little financing towards adaptation because, most importantly, people don't understand adaptation finance. If you ask most investors, they wouldn't know the difference between mitigation and adaptation. They don't understand that cold chain and sustainable agriculture is very important to adaptation finance. Investing in wastewater treatment and water desal is an extremely important component to preserving water. So, what constitutes as adaptation finance? How do we, and the reality is the moment you look at sectors or segments that fall under adaptation finance, they're not profitable. So it's very difficult for financial institutions to be actually able to finance some of these projects because the returns are not economically fully viable yet. There are pockets where it's happening. But that's where we need blended finance to come in, where financial institutions are being supported by the government, by the philanthropic sector. We need a certain amount of, so there are instruments like that, frankly. There are pilots that are happening at the global stage. Mostly it's being driven by the policies and the governments. Very little is being driven by the private sector. But I think the private sector doesn't process the impact that climate change and adaptation is actually having. Like, for example, with so much flood risk, how many of our own private sector buildings and units are actually resilient to flood risk? 2 years ago when we had the Chennai floods, so many data centers got shut down and that impacted the businesses, right? So every business in every single sector needs to invest in adaptation for their own units and assets.
Let me ask the private sector player on the panel then, Mr. Jayan Dua. How would you respond to what Hina is saying in terms of the preparedness of the private sector investing towards this?
So thank you, SBI, and thank you for this, everybody, for this getting me part of here. So let me put it this way, that she's absolutely right. I mean, what are we doing? We're looking at mitigation rather than actually at the root cause. And I think the point Professor touched over there on the carbon credit market, I think if you dig deeper into it, it's actually going to get you to re-look at the way you invest tomorrow. Let me jump to both the points and try to mitigate it from a corporate sector perspective. You have this carbon credit trading scheme which is there, which has the end product which you trade is on your CCS, which you call your carbon credits. Now, 23, I think year 23 is the policy was launched. The base year was set as 23, 24 or somewhere thereabout. Where I think the biggest difference which is being brought about is that now you're setting targets on your GHS, your global house emissions, at the CO2 level at a unit entity level. Yeah. There are about 4 or 5 industries which have been captured in the first phase, starting with cement, aluminium, chlor-alkali, pulp and paper. I think fertilizer is also there, and hopefully soon refineries will also come in. Now, earlier what you used to do was you used to do small little things on mitigation, as you talked about, energy efficiency. You used to talk about a small RE part. Let me meet my norms. Now, as you go forward, cut yourself 10, 15, 20 years forward, as this entire market is going to mature and you will start tightening from the base year onwards your carbon emissions, you will start looking at technology from a very future perspective. How do I get low technology carbon emission plants? How do I capture carbon and use it into a more productive? So you're going to have a technology breakthrough. Yeah. Once you have a technology breakthrough, you will start also getting the adaptation funding, which will start coming in, because it's a picture which is going to be drawn up. I don't think so this journey is going to get covered in 5 or 7 years. I think it's a little longish journey. But I think India is well on track. And I think this policy by the government, if it gets implemented in the right earnest, both by the corporate sector and by the government sector, it could be a game changer in India meeting its target, both technology, both on climate, both on actually getting a marketplace where what you are investing today for the future, there is a return perspective coming in today. To your point today, there is no market today. So you have to get marketplaces to come in for things to start moving forward.
Yeah, and you're right, Mr. Dua, it's not a 1 or 2 year game, it's not a 5 or 7 year journey, it's a long-term journey. Let me bring in the financiers on that note. Mr. Pradeep Kumar Das, talking about balancing India's growth aspirations, and we do have aspirations as the world's largest growing, fastest growing economy. The trade-off between sustainability imperatives and our growth aspirations. Are we getting that right? I mean, not just on paper, not just a ticking box, some sort of ambitions, but are we getting it right on paper, you think? And do you still see a gap between implementation and the kind of ambitions that we have?
Yeah, very good morning to all. And thanks to SBI and Chetisa for inviting me and giving IREDA to be part of it. You are talking about business perspectives or sense of economics. We are talking about climate transitions. First of all, if you look at the history of IREDA, since 38 years we are doing the same thing what we are discussing now. And in 38 years we have financed more than 1.72 lakh crores, and our cumulative write-off is only 135 crore. And if you look at last 5 years CAGR, profits and are growing at 40+%. Sanctions and disbursement, if you look at half-yearly basis, 84% sanction disbursement, 56%, and PAT 41%. So these are all indication as well as reflection of sense of economics with the mindset of energy transition. Now the speed, if you look at, though we are there since 38 years, but since last 10, 11 years, it has taken the speed. What is the one change happened in 10, 11 years? It is not that just COP came, so it happened. COP is there since long. But some major change happened with the leaders and the mindset. In the previous panelist, they were discussing about that, how the family business, the mindset is impacted. Instead of going for a luxury car, luxury house, they invested in startup. Now you look at What is the economy? He said 1,000 crore they have already built up the startup. Had they invested in the luxury car, luxury house, even if the price of the house has gone up, how much it would have been gone up? So fair amount of economic sense is there. And moreover, if you look at anybody coming from NCR, Delhi, probably they will be grateful to SBI. SBI has given them to be away from Delhi for at least a couple of days. Why it is so? I am living there since 23.5 years. Incidentally, it is happening like that last 3-4 years. Almost 2 months I am traveling during this period. So I'll be grateful to my organization and to the economic ecosystem which has been built up for developing a perfect RE development to be developed in a jet speed. When I'm saying jet speed, from simple 3 gigawatt of solar capacity, we have gone to 127 of gigawatt solar capacity now. And when we envisage this 500 gigawatt of non-fossil, out of which 485 renewable, not only globally people become very critical about our ambition. They used to tell it is ambitious goal. What is ambitious? We set a target. It's not ambition, it's a target. We have to work in a target approach manner, and then only you can reach to your goal. And we have already surpassed certain goals out of the 5 Panchamrit goals, which you indicated, much ahead of time. And this could be materialized. First, again, I'll come back to the mindset of the leaders, that is the policymakers, regulators, developers, and last but most important, the lenders like us. Because you all can think over and discuss. The developer can think and have innovative ideas and all. Policymakers will frame the policies and all. Your ideas cannot be translated if you do not have the financial support by the lenders. You can, even for the equity also, you need support from others. Today, in RE space, what we have experienced, those who have idea, even though they do not have equity, 100% FDI government of India has allowed to them. If you have idea, you can generate equity through them. Most of the developed economies who is having their ESG mandate, they are very keenly, enthusiastically, eagerly waiting to invest in India. What has undergone change in last 1 decade? Corporate governance, governance in government, governance in the regulators, governance in the entire ecosystem of the development, it has undergone change. The level of ease of doing business, level of transparency, level of accountability, level of fairness towards each and everybody's conducts and actions, that has been improved drastically and dramatically. And at the end of the day, again, I will say, whenever IREDA is lending, if you look at wind, solar, hydro, which is plain vanilla RE we call it, that means very easy. Like when in your childhood or even school days, when you used to go for exam, always we have been taught, attempt the easy question first. Probably in RE development, solar was the easiest question. So everybody wanted to adopt it. If you can import the modules and you can identify the barren lands, which was easy to identify earlier, but after 10, 11 years of jet speed growth, this barren land are becoming costly also. So technological improvement has happened quite a lot. Scale of economy has grown up in the RE space. Today, which is matured, they were emerging earlier. We have lended them then, and we are lending them now. And today also we are lending, again, the complete nascent stage industries like green hydrogen, storage, be it pumps or be it base, e-mobility. And again, we are the first agency who had done the large scale EV financing in India, and which created history for wrong regions in the month of April. Needless to say, the company, and that is purely, it is appearing so far as per the interim report of SEBI, because of the misgovernance, lapse of corporate governance, and promoters' improper managerial outlook. Except for that, if you can eliminate those things, RE is not at all that difficult. We have proven it. And as a lender, we can enhance our governance. As a lender, we can handhold the developers to improvise their governance, but certainly we cannot change their mindset. We can only attempt to influence. So it is ultimately they have to maintain the discipline. Therefore, I always say, if the developers have the discipline in their approach, and the policymakers have fairness in their attitude, and the lenders maintain the simplicity in their procedures, that is called DAS principle, RE is going to continue to jet speed and sustainable finance can sustain. Thank
Well, Mr. Das, you've given us plenty to think about, and I hope all the lenders out there have the kind of conviction, determination, and clarity that you have. But let me ask the other big lender on the panel, the banker to every Indian, Mr. Tiwari at State Bank of India. How front and central is this sustainability theme to your practices today? And you know, as Mr. Das was pointing out, corporates still answering the easy questions on the sheet, going after solar power, or doing a whole lot more. What are you seeing on the ground?
So let me, first of all, thank you. And let me begin with saying that we are also lenders to IREDA. So from a lender's perspective, I echo whatever he said. And they have been good borrowers so far. So with that,
more loans coming their way.
More loans coming their way, and there is enough demand from him. So with that caveat, let me just briefly explain as you mentioned, the sustainability. But before that, as Mr. Das has explained and others have also explained, the Indian landscape, very, very briefly. So one side, see, India started a little late in this journey, somewhere around 2011-12 when we started thinking about this. But you have to see the growth which has happened, right? The solar, as he mentioned, 123 gigawatt, the overall non-fossil of nearly 500, which are getting there much ahead of time. So all this growth is largely driven by private sector, of course, with honorable additions like IREDA and others. And this is because there is a clear economic rationale. Solar is proven itself. There is no need for any subsidy. There is no need for any dispensation. And similarly, prior to that also, wind had also proven itself. So therefore, as and when technologies become commercially viable, I think the private sector will step in, should be allowed to step in, and they would make it, they would scale it, they would make it more efficient, and there will be no need for any interventions. Now, therefore, like India has done very well on solar, very well on renewable in general, but despite all this, the contribution of the renewable sector to the energy generation is just about 10% in terms of units which are ultimately utilized. So that brought us to the problem which is next, which is how do you have the base power, which was coal, which continues to be coal, but now can we supplement between non-fossil? So we are talking about pump storage, hydro and others, battery, etc., but they're yet to scale up. The other thing is, of course, the grids. Now the grids, can they take up this level of renewable energy, this intermittency and all? We are working on that as well. So as these things have scaled, this is the next step. Once this stabilizes, my sense is that the renewable will be forming a major part of even the utilization. In addition to this, adaptation, which is talked about, adaptation, of course, is very important, no doubt, because we are already there at 1.5 and 2 degrees also will be achieved. So how do we then handle all these unseasonal rains, heat, etc., etc.? Today, that is couched in what is the natural, the disaster response and preparedness. It's not called adaptation, though a significant budget is allocated to that. We have the NDRF. I would argue all of that is part of the adaptation response itself. But we need to have more formal mechanisms on this. And of course, carbon markets and others are also being worked. So a lot of things are being done. And India, to its credit, has not been guided by any external environment changes, etc. Today we have an environment where this is not being looked upon very favorably. People are denying climate change and yet nobody is countering them, etc. But India has continued on its journey as it should. So that is where India stands, and I have no doubt that we would be further leaders in this field. Coming very quickly to the bank, sustainability is something we have adopted, and we have a dedicated department for the last 2.5 years on ESG. On its own, the bank is possibly already net zero, including the scope 1 and scope 2 emissions. Scope 3, of course, which is our portfolio, is the main thing for a financing institution like this. And there we are guided by, while we have started to measure emissions, taking the feedback from corporates who declare it. But the point is that we have to be balanced between energy security on one side, the requirement of the nation, so we can't say we will not do coal, we will not do mining, etc. We will do that, but at the same time we encourage the green part of it, and therefore we have certain facilitations, interest rate concessions, etc., which we offer on green. We also done on EVs, on pump storage, hydros also, we are looking at that. So we are doing all because as a largest bank, we span the entire spectrum. And we will support all such activities. Of course, for riskier activities like green hydrogen, we have not gone in a big way. We are looking at proposals, and there probably some kind of a risk capital approach, maybe by way of either a green fund or maybe an institution which does these kind of initial fundings, and then the banks can come in and make it more cost competitive, is probably the need of the hour.
Well, Mr. Tiwari, before you put the mic down, just to put some numbers to the kind of support you're lending to India's green financing journey. How large a part of your portfolio, and I ask you because you're almost a quarter, if not a third of the entire banking system, so what you do pretty much sets the direction. How large a part of your portfolio do you aspire, green financing to really be in the future?
So our stated target, which Chairman has mentioned earlier, is to have 8% of the book in green by 2030, which is where the Panchamrit goals have to also align. India is on record to do that. Currently, we have done around 80,000 crores to date. Of course, some of that has been repaid, so the current outstanding should be around 50,000 crores. Largely, of course, this is solar and wind and hydro, those three. But we continue to assess a lot of large hydro, a lot of wind projects. Solar continues to be there. So a lot of action there. But in solar, what is interesting is banks are being outpriced by PE funds, by many other, the InvIT kind of structures, which is a good thing, because that is bringing in fresh money and its dependency on the banks getting reduced. So therefore, I think we are very much integrated into this, and we have supported almost, I think, around 8 gigawatts of renewable energy so far.
Well, that is commendable. We'll get to the dependency on the bank.
Can I add
sure,
a couple of points to him? Because you started with that private sector. And see, in renewable, 80% of the project have been developed by the private sector. The remaining 20% is again corporate PSUs. And that is largely large hydro. And private sector doesn't do business if there is no economics. And when you talk about new and emerging one, yes, it is the responsibility of the parent to handle during the infancy stage. Therefore, be it green hydrogen or pump storage, battery storage, anything, even the manufacturing of modules and integration of the activity like wafers to cell or polysilicon to wafers and all. But certainly, if somebody wants to manufacture module today in India, the handholding is not required. So government is not giving any subsidy for that. If it is cell, yes. So what is that? So unless the industry is coming to a fair level of certainty, to level of maturity, till such time the handholding is to be required. Like a natural child, till 18 years the parents have to support. I think in solar, wind, hydro, we have crossed that 18 years. Probably we are in now 25 years. We are marriageable age now, as far as that is concerned. Not only we need to support the developing and underdeveloped economies, which we are doing through ISA.
Who are the teenagers and who are the adults here?
Yeah. Well, not even teenagers, even infants. Green hydrogen is infant. BESS is infant. Pump storage is not infant exactly because it is connected to hydro. So therefore, you can tell it's at least pre-adolescent.
Well, we have a fairly young bunch of people there, but Hina, overall, just give us a broader picture now that we sort of set the context on where we're at in this green transition. The real work, the policymakers can think, the financiers can lend money, but the corporates have to do the real work. Just tell us from your vantage point, in your interactions with them, how much of a mindset shift are you seeing from ESG as an obligation to really ESG as a business strategy, as a core business strategy?
I'll quickly take a minute to set the context of when it started, where we are. Frankly, the most mature sectors on ESG that you see in India are the export-oriented sectors, because the pressure actually started for them, and you could say export-oriented and I would say the top 100 companies in India, because they are so export-driven, specifically to Europe, specifically to Australia, and some of these, US doesn't have its own regulations very clear, but some of these other countries do. And that's where their initiatives on ESG and sustainability started, I would say, 10, 15 years ago. There is a different kind of a maturity curve that you see in India across sectors and across companies. I think the large conglomerates who, like I mentioned, have an exposure to exports have had in some of their businesses sustainability integrated into their business strategies. These could be, steel, for example, chemicals, manufacturing in some form that's export driven, because they are susceptible to carbon regulations across the globe, they have foreseen this and invested in sustainability and frankly also seen the returns. Like some of their products in today's age are very competitive because they are so efficient on the emissions side as well. But when it comes to many other companies and sectors, the push that happened, I would say, is 4 years or 3 years ago when SEBI came out with their BRSR regulation. The biggest gap in India that we still continue to see, and hopefully we will accelerate and leapfrog this like we've done in many other spaces, is really climate data, or ESG data, let's put it that way. BRSR made that a bit more democratic. Like what happened is suddenly now starting 2021 is when it was effective voluntarily and 2022 was when it was mandatory, is all the companies, the top 1,000 companies have to report on their ESG data. Many of them were undertaking that exercise for the first time. They didn't really understand how to go about it. Many of them who still joined that club of top 1,000 are doing it for the first time. So we worked with a lot of companies pre-IPO to just be ready because as soon as they're listed, depending on the market cap, they're going to have to do it. That's when it's an eye-opener for them. That's when, frankly, it's a step one of ESG. They try to understand what it is. Now we are in 2025, which is 3 years post BRSR regulation. I think India has a journey of sustainability regulations. If you see, we've made all the right moves. I think we have regulations in place when most others didn't. Like for example, when SEBI came out with the BRSR reasonable assurance, which is take 50 questions, take 50 indicators, get reasonable assurance. We were the first one in the world to do it. Even EU, with its 20+ years of history, has never done reasonable assurance. But the reality is, were the Indian companies ready for it? And that's where I feel we've made the right moves as regulations, but the adoption of those regulations, the acceleration and impact is where we're still a bit slow. And I wish as a country, as a community, we could accelerate that. Like what happened is now SEBI has brought that reasonable down to limited because there was a lot of pushback. Most countries are not able to do it. Most auditors don't know how to do reasonable assurance, how to sign it because there's no global standards. So there are certain sectors that continue and companies that continue. I think 3 years down the line, I can say that most of the companies who started reporting 3 years ago, they don't look at ESG as a tick box exercise anymore, because they've seen value come out of measuring these numbers, monitoring them and reporting on them. Is it a part of their core strategy? Not yet. It still continues to be in some form, somewhere in between of a regulation and a tick box exercise to a core strategy. I think we're just 30% there. There's another 70% to cover for them to be able to make it as a, and that won't happen like all the panelists mentioned until it's economically viable in the market, until there is either a stick or a carrot on the table that's allowing them to do it. And that's where financial institutions play a very important role. The moment finance is aligned to sustainability targets, and this is the concept of sustainability-linked finance, like for example, when banks take net zero targets, and if it's not that they're going to stop lending to these sectors, they will just align their financing to sustainability goals of that company. So the moment the company is being questioned by the investors as to where they stand on their sustainability, on their environmental goals, they will start acting on it, and that's when they will make it a part of their core strategy, because they're being either questioned, they're being given an incentive, or they're being asked to pay a penalty for it. So,
Mr. Dua, would you like to take that up? I mean, the fact that Hina says roughly we're just about 30% there. You know, it's either the questioning or the push from the regulator or a stakeholder investor that's driving companies to do it. How real is the appetite of the industry to invest in decarbonization, especially with what's going around globally, whether that is cost pressures or uncertainty?
I think you got to cut the cake into different slices. If you look at the top quartile of the companies, I think it's largely baked in. We don't look at it from an ESG perspective. We actually look at it as a strategy perspective. So if I were to take an example, I know that, let's say, one of our cement companies, group cement companies, has already crossed 1 gigawatt of renewable power in its portfolio today. If I were to look at the aluminium business, because of the export-linked sector, as she points out.
Yeah.
They're coming up with expansions which are going to be largely green aluminum. So I think it's baked into strategy. But when you start looking at it from the diaspora of the companies which are there, and you need a lot of capital to do that. Your returns on the investment are not going to come to you soon. They will come, but there's going to be a point of time. I think the whole ideology in terms of how does financing look at it and gives you a better deal towards it, I think will go a long way for a faster adoption. So, anything on sustainability, I would look at it, don't look at it as a silver bullet, please. It's a complete sustainability ecosystem that you need to create. It starts, and I'm not saying it's circular, so let's not say where it starts. You got to look at green financing. You got to look at how you're going to be getting a marketplace for the carbon credits. You're going to be looking at how you're going to look at technology, because without technology adoption, it's not going to come through. You got to look at it from ultimately, the whole thing is how you're going to do skill development. How much of it you're talking about in terms of the production capability or your supply chain systems. We talked in this forum today that solar is mature. On the generation side, completely in agreement, solar is mature. But the technical obsolescence on solar, from the ingot to the wafer to the cell to the module, and I'm saying module is the end product, every 5 years it changes. Now, land is finite. Okay? From the same land, you need to draw out more and more for you to do. That's not going to happen till technology does not take a leapfrog in every technology aspect, be it wind farms, be it solar, be it the new point of generation of ammonia, hydrogen, or for that matter, the PSP or the system. But I'm going to leave one thought over here. We're talking all about development. Have you looked at the end state or the end life of these products? They themselves will need to be disposed of or managed properly. And I don't think so yet. Today, India is talking about that. And that day is not going to be far away. Come 2040 onwards, you're going to be talking about what do I do with the end state of my renewable assets. And I think that's where the policy needs to start coming in. What is our repowering policy? If your land is finite, your wind farms are finite, and if you've got technology which is obsolete there, how do you bring all of it together? And I think that's where the lenders should actually push us. They should push the regulators, they should put the policy makers, because I think there is a lot of assets in India which can come up as replacement.
Well, I'll let Mr. Ashwini Tiwari address that actually.
So frankly, the first set of solar things, solar loans started getting done 2010-11 onwards. They typically have a life of up to 25 years and can be extended. So we haven't reached that state yet. It's just 15, 16 years down the line. But clearly, this is a good point which is made, and I'm sure that the replacement will happen. Nobody is replacing currently, largely because the earlier PPAs at a higher cost. As we go down the road and we have PPAs of 2 rupees or 2.5, etc., compared to the traditional thermal ones of 8 rupees plus. So I think there's a huge gap, and replacement is clearly something which will happen. I have no doubt about this. And the questions I used to ask many developers, look, TopCon is now giving you a plant load factor of 25, claimed 25, maybe 23, 24, whatever. So why don't you replace? They said, no, sir, our PPAs earlier are as per this cost. And as long as we maintain it well, clean the panels well, the generation which is happening is equivalent to that. So replacement clearly is going to happen. The other interesting thing is what we are seeing very recently, one of the infants, BESS, the battery energy storage system. So we have currently a lot of pipeline for that. Many people are approaching, because the thing I talked about earlier, which is that round-the-clock power is what is the current contracts which are coming up. And to use solar and wind more, we need base power. Battery is one of the options. The interesting thing is that many people are now moving away from necessarily having a full assurance on a full PPA, which is full power agreement. They are saying that we will have a part or sometimes a large part of the agreement open, which means they would sell it on the exchange. Because currently the exchange, it's capped at 10 rupees right now per unit. but it had reached 14, 15 rupees, and they anticipate with the kind of demand which is going to come in, this battery power will be a scarce resource for a long time, and therefore they are willing to let it be unsecured without any PPA, which is something of a revelation to us in the lending side, but these are new trends. So I think we will see a lot of interesting trends on solar. As he said, solar by itself on generation is mature, but even there the RTC is relatively recent, and round-the-clock power is where we should go.
But just to close the loop on this.
One more point to that.
Yeah.
You know, very interestingly, if you look at the whole value chain there, I think what we really need to look at is, and you're talking about high-cost PPAs, and honestly, all of us have some high-cost PPAs, which actually makes us lethargic towards doing anything. And that's the case with all developers. And I'm saying, cut to next 5-7 years when you will have a lot more renewable power in the country, along with adequate storage. Maybe it's a good time to start exploring a model where you don't have PPAs at all.
So how would the new system work?
So I'm just saying, now I'm just taking a very extreme position, and I don't know how it'll get financed, but I'm just trying to make it a little provocative.
Mr. Das?
No lender will come to lend you if you do not have a fairly certainty of the PPA.
That's the policy right now.
Number one.
That's the policy today.
You are talking about
But do you imagine a future where this would be possible?
I'm coming to that. Replacement has already been happening. It is not that replacement is going to happen. More than dozens of our borrowers, they have already replaced in the last couple of years. They are doing on their own cost. Still, it is economically sensible. See, we all know that 25 years PPA, that probably nobody is keen. Simple common sense. If I'm getting today something at a cheaper rate, because I had committed in the past, then how will do it? But from a lender perspective, PPA is my backbone. On that basis, entire mathematics has been worked. See, if you cannot determine what is the price at which you are going to get your revenue and cash flow, who is going to lend you? Forget about who will lend you. As an equity investor, are you going to invest? Answer is no. The question is whether that 25 years, 20 years, 15 years, 10 years, certainly 5 to 10 years of certainty would be there. See, now, are we going to grow solar in the pace for forever? No. Certainly, the solar and wind, which is land-centric, that is going to be stopped after some time. So that is the reason for which alternate sources of energy like green hydrogen, that is being talked, which is not affordable today. The solar was not affordable 25 years back. Wind was also not affordable 25 years back. So generation-based incentives government has brought in to make it viable and all. And those who have made it, they are quite enjoying. I think another couple of years, still they are getting the subsidy. So similarly, in this, we have to shift from a PPA-based to a molecule, that is commodity-based activity. And still today also, a lot of developers are selling in the open exchange without having PPA. And we also have similar kind of borrower. Recently, I will not disclose the name, some of our borrower, they have shifted from PPA to open exchange. But if you look at the profile, the borrower is so solid and so sound. From our risk assessment perspective, we do not find anything.
Aditya Birla not solid enough?
No. See, it's very difficult to trace. We have some thousands of borrower, one borrower, even if you are going to scrutinize all accounts, then only you will know that is not possible just. And we are a listed company, I cannot disclose certain facts just in
We'll speak more about that later, but Mr. Dua, to close the point on what the alternative to this could be, what is your solution without PPAs?
See, I'm not giving a solution. I'm just trying to make the whole conversation a little future-centric. My point is PPA a perfect world? Yes, for financing, it's a perfect world because you've got a fixed commitment over a period of time. For investing.
Yeah.
That's a fair point. And honestly, he's right. Nobody would put equity if there is no line of sight.
Yes.
Okay? It's a clear given. I'm not even saying that that's not the way. Now, what I'm trying to say is how do you make the entire ecosystem more agile? Okay? You've got today tenders floating. There's 40 gigawatt where there is no PPA signed today. They'll probably get cancelled. You're talking about RE parks, wasteland, which are going to be talked about. And you've got, you still are about halfway through to a 500 gigawatt target, give or take a little bit. You've still got a long way to go.
Yeah.
Today, and I'm going to take 2 minutes on some data points. Bear with me. The RE consumption in the entire electrical sector is today at about 18 to 30% of total, right? varies month to month because the resources are not stable. Whereas the RE capacity today has crossed 51% of the total requirement. So you obviously see that the whole energy system has to come into place, and that's why we're talking about storage. Okay. Now, you also have, along with that, while you're talking about land as a constraint, which is finite, you also need to have an augmented distribution system which recognizes that some places are going to be wind heavy, some places are going to be solar heavy, and have the flexibility of it all converting into a grid. So the whole policy regulatory needs to become seamless. So you've got to start looking at it from a very holistic point. How do you get the renewable, which is 51% capacity, let's say theoretically, and ideally a 51% consumption? That's your utopia. Now that in the current technology world is not going to happen. On top of it, you will have at different points of time your different PPAs. And I'm saying particularly only for utilities, and I'm not talking about the C&I sector. Do you really want to work in developing marketplaces, and how would you get financing more robust? So the more marketplaces you have, the more IEX you have, the more clarity of competitiveness will come into play, rather than looking at 25, 20, 15. I think we need to start thinking for the next generation and say, are we creating an ecosystem which is going to get competitiveness of our industry going up, which is going to get the climate into control, which is going to make sure there is marketplace for everything, and there is financing available with the adequate risk attached to it. And I think that's the whole circle you need to traverse.
Hina, just to close the loop on this, when you talk to the industry, what are the biggest friction points when they talk about investing for the future into renewables? I mean, the finite land, is it lack of financing? Is it policy clarity, or just something else altogether?
Frankly, when it comes to the corporates and the private sector, it's really a combination of everything, right? I think if you ask me, I think renewable energy, like Sir mentioned, is already at a mature stage. Currently, there is a lot more to green finance even after leaving REs and EVs aside. I think EVs is not as mature as RE, but somewhere in between. I would say EV could be a teenager if RE is 25 years, right? But there is so much more to green financing that people, both across communities, need to dive deeper and understand. And this is where the need of the hour is for, cross-stakeholder forums, platforms to be able to drive. Now, for example, what are the sectors where we really need financing, but it's not going? Agriculture, most important, right? I mean, we're a country that continues to have a certain percentage of our GDP being driven by agriculture. Agriculture is India is the 7th most climate vulnerable country in the world. There will be a significant impact. Now, we need to look at sustainable agriculture practices. How much are we investing there? Who is driving that investment? I mean, the truth is, how much of our farmer community understands sustainability practices? Do our lenders understand how to underwrite and be able to cater to those kind of products? Very early stage. We need, water is supposed to be the new gold. How much of our lending portfolio, and this is a very interesting conversation we have with some of the financial institutions, is RBI 2 years ago came up with the green deposits framework, right? Has that, many banks and institutions have launched green deposits. But if you look at the allocation of those green deposits, a lot of it continues to be driven by renewable energy and EVs because they're economically viable, because the banks are also responsible to be able to allocate a certain amount of returns, right?
Yeah, of course.
Now, the rest of if you look at the RBI framework, other than EVs and renewables, there are 5 other categories, which is wastewater, or you could talk about circular economy. There's agriculture in there. There's water in there. There's very little to no allocation going to these sectors, and frankly, that's where we need to focus on. Yes, we need to, as a country, evaluate how do we make some of the mature sectors more economically viable and ready for the future. But we also have to take the best practices and lessons from those sectors, which is renewable energy and EV, and look at sectors where we need to invest. Because if we don't invest, I mean, if you don't invest in water, there's no green hydrogen. Yeah. If you don't invest in water, frankly, there is no data centers.
Yeah.
I mean, we're talking about AI expansion and the amount of data centers that we're building. We need water and green energy.
Cool
I mean,
them,
green energy is there, but where is the water? So I think it's important to start looking, and that's where I wouldn't say corporates and privates are lagging. I think as a community, we are lagging.
Well, Mr. Tiwari, just to take that forward, in terms of financial instruments, what do you think, given all the friction points and various challenges outlined, holds the most promise for a country like India today?
So I think we have done enough on renewable energy. Let's move on to other things, because otherwise this whole panel becomes an RE panel rather than a sustainability panel. But in terms of instruments, see, there are no unique instruments, I would say. One is that in the terms of, just to complete on renewable energy, the financing is long term. It's 25 years, 30 years sometimes, even for hydro, pump storage hydro, again, long gestations. So we have to account for that, which is a part of the cycle and the process. And once we understand that there is a risk in this executions, and how do we mitigate that, whether it is by way of a PPA, as very rightly pointed out, and lenders will not risk non-PPAs till they have a comfort with the name itself of the developer or the company. So therefore, the models are largely traditional. It's just that today we are also looking at some of the, let's say, blended finance was talked about but not taken forward. So many of the multilaterals are willing to fund some of this. And those lines help us bridge some of this risk in terms of our easier financing and maybe less costly. But again, many of the multilaterals, they insist on a sovereign guarantee, which of course is, if that is to be given, then it takes away the whole gamut of either the cost, or maybe the government also doesn't want to allocate its scarce borrowing fiscal towards sovereign guarantees. So I think there is a need for a gap financing, which is part of the risk capital, which is currently not something where it should be, and we need much more of that.
Well, we do, and Professor Kasturi Das, let me just zoom out and ask you then, in terms of what India is doing. Let's move away from the industry in terms of what we can do, for the world. How do you assess our position when it comes to trade in environmental goods, for one, and how do you see India's position from, a rule taker to a rule maker in this area?
Okay, that's a very good question. Trade and environment, and particularly trade and climate change, is increasingly getting intertwined. If you look at India's position traditionally, India traditionally has maintained that environment and trade should be kept separate from each other, because there was this argument of slippery slope, as we say, that environmental issues may be misused as a trade weapon. So from that angle, India was looking at it, and India wanted to keep trade and environment separate. So that has been the traditional approach. But if we look at more recently, India has already recently signed the UK FTA, that is the CETA. In that, there is a separate chapter on environment, and there is a lot in that, and which is a very important development, I would say. And it is showing that India is moving away slightly, at least from the traditional position. And I think that's a positive development, because in today's world, the way things are intertwined, it is very difficult to think of trade and environment in two different compartments, because it is not possible. Because in today's world, it is trade-oriented. We are talking about integration in the global value chain. My co-panelists were talking about what is happening in the export-oriented sector, and why is it that ESG space or the initiatives that companies are taking in the export-oriented sectors are more compared to others? Because if you look at some of the export markets of India, say European Union, we know that European Union is ahead of the curve in terms of the environmental regulations. And it is not only that the carbon tariff or carbon border adjustment mechanism which European Union has come up with, but there are other, CSRD and CSDD, which are provisions. So, we can't get into the detail because of the paucity of time, but these are related to corporate sustainability. So if we have to keep working towards increasing our export to the European market, it is important that we move towards that. And let me, tell you something about the carbon border adjustment mechanism. Recently, I was in Yale University as a Fulbright fellow, and during my stint, I came up with a study which was co-authored with, someone from IIM Lucknow. We looked at the impact of carbon border adjustment mechanism on steel decarbonization in India. And why it is like that? Because if you look at the carbon border adjustment mechanism, the way European Union has designed it, one of the objectives is that in the trading partner countries, it is likely to help decarbonize faster. Now, that was the starting point of our study, and what we did is that rather than doing just modeling, we went to the real stakeholders and tried to understand from them what they are thinking and what they are doing. And some of the most important stakeholders were from the industry itself. And if you look at the steel sector, you have the big players, we all know about them, you have the JSW Steel, you have the Tata Steel and all, but we also have a huge MSME sector in the steel. And when it comes to impact of CBAM and how far it is influencing decarbonization effort in the sector, we found very different way they are looking at it. When we talk about the big players, they, as you rightly mentioned, that they are doing more, and they are in the export-oriented sectors, they are doing more. But having said that, if you look at the CBAM timeline, it came up in October 2023. And from January 2026, they are going to apply the carbon price. So this was the transition period. Now, this is a very short time period. So if you expect that the sectors like the steel, which is a highly emitting sector, and export-oriented, and European Union is a big export market for steel, if we expect that even the big players will be in a position to completely transform their decarbonization journey just because CBAM has come up in a way, so that they don't have to pay a very high carbon price when they try to enter the EU market, that is not something that is going to happen as a whole. Instead, some of the big players, I'm not going to take any names, so how they are strategizing is that they are differentiating between what they are doing for the export market, particularly the EU, and what they are trying to do in the that segment of their production which is catering to domestic market, because India has a huge domestic market for steel. So they are planning to produce relatively lower carbon steel for exporting to EU and relatively higher carbon steel for elsewhere. And that is not because they don't want to do more, but it is just not possible in this very short span of time to completely transform their, and decarbonize their entire production. So that was about the big players. When we looked at the MSMEs, we found that they are not in a good shape in terms of their decarbonization journey. Many of them do not have the understanding and do not have the capacity to take it forward. So there is a lot of need for capacity building. Some of the big players are trying to do in the supply chain for the MSMEs for capacity building, but I think there is a huge gap. And maybe, there comes this question that what India could have done in the trade negotiation. And as we speak, the EU delegation is here in India, in New Delhi, and they are trying to figure out some of the sticking points in the EU-India FTA. The negotiations have been going on since 2007, but we have come a long way now. But whether CBAM and those issues be included in that India-EU FTA is something that we are not sure of. Because if you look at the recently signed India-UK FTA, that is CETA, that was signed in July and it is yet to be operationalized, UK is already thinking of coming up with its own CBAM. And it was discussed and we talked about it that whether it should be included in the FTA, but that was not done. It must be that they could not come to a landing zone because of that. And whether in terms of EU FTA, India is going to include that, will be able to do that, that is something we have to wait and see. But having said that, it is very important to understand that if the measures like climate-related trade measures like carbon tariff or CBAM kind of measure, if they are trying to really help in decarbonization in the developing countries like us, it is important that they don't do it for protectionist purposes. And they could actually, help us do that by recycling some of the revenues.
Yeah.
They could help the MSMEs to do better. These are some of the things that India can negotiate, in my view.
Well, sure. We've left with little time, so let me just get some broad picture comments from all of you. Professor Das, probably I'll start with you again and end there. If you had to pick one specific policy change to reduce friction in our attempt to become a net zero economy, what would that be?
I would not say policy change, but we all know that in one India there are many Indias. So there, when our Honorable Prime Minister already announced during COP26 that we are going to be a net zero nation by 2070, but it is very clear that this requires a sort of a overall and transformation of the entire economy.
Yeah.
And I think it is very important that we do it in a manner that is just and fair within India.
Yes.
There comes this question of just transition.
Yeah.
And in the international arena, if that requires, support in terms of finance and technology transfer, India has been, talking about this. India has been raising its voice about finance and technology transfer, but
Sure.
not much has happened. So we need to look at this from these angles.
Okay, Mr. Tiwari, one bold idea, whether that is innovation, partnership, or something else that could make India's transition faster, just and fairer, and also make us self-reliant.
Yeah, before that, I'll just say that India has to be Atmanirbhar in this also. Nobody is going to give
As
us
the
money.
finance minister
We have to
outlined
do it
yesterday,
ourselves,
yes.
so there's
Yeah.
no question on that.
Yeah.
But in terms of big idea, I think what I mentioned, that we need an institution which is focused on providing initial risk capital for green technologies, which are frontier, which are yet to be commercially stabilized, at least in the Indian environment. And that will go a long way in making these acceptable and putting out pilots which are large enough, commercially viable. So once that happens, and there are instances or precedents of this. One in Australia, for example, they have an institution, and then as technology commercializes, the banks take over, and that's how things move forward.
All right, Mr. Das, how does India mobilize capital at scale to meet these kind of targets?
I don't think fund was a constraint at all. We almost another 28 lakh crores of investment will be required. We had envisaged initially 31.6 lakh crores, almost 2-3 lakh crores has already been done. Out of 28 lakh crores, debt equity, if you see, almost 21 lakh crore will come from debt. If you see the existing composition, 35% is coming from NBFC, 15% coming from bank, and 50% coming from bond market, despite India not having a defined green taxonomy in the country. We have already submitted, and government has almost in the advanced stage of bringing green taxonomy. That will enable a fair amount of bond market, where we have insisted up to 5% of AUMs from the PF, superannuation, and other long-term gratuity funds. And anybody who is doing green, they should be given a special green tag with some proper definition. Then what ecosystem government has built up, the speed in which it has grown, at least in matured area, the policy they should maintain it consistently. And in the emerging area, they should bring prompt policy. Because in emerging area, you cannot just make a policy and sit on it.
Yeah.
And at the end, whatever policy you bring, execution has to happen.
Yes.
Execution have to be significantly important in this. Almost 70 to 80% weightage I'll give to that. And 20 to 30% I can tell you policy.
I think that can be said of all policies. I mean, the execution is as important as the intent. Hina, if I were to put
And
it
while
this way.
financing, we have an inertia that all the developed economies, they are going to give us concessional funding. Last 5 years, we have not resorted to any overseas funding. We used to have our resource composition of 57% overseas and 43 domestic. Our latest report is only 14 is overseas, 86 is domestic. And why somebody will give you a concession? Why?
Yeah.
You are doing business.
Yeah.
See, only when, again, the infancy, which is very innovative stage, if they believe that post-innovation, fair amount of scale is going to come up, then only they will invest.
Absolutely.
And we should not expect also.
Yeah.
So where there is economic sense, we don't require. Where that is innovation sense, then only. There this blended financing, all these greenhouses, they can support through some kind of grant and through a blending of debt. That will bring it down. And in the initial stage, you need a concessional rate, which government is also, like in green hydrogen, government of India has already announced subsidy in that. In PLI modules and other subsidy in that.
Yeah.
EV FAME subsidy is there.
Yeah.
So I think
a little hand holding for the infants and the younger ones before. But Hina, quickly, one technology or innovation that you think that can really transform sustainability into a more profitable proposition for corporates?
I would say that's neither a technology nor an innovation. That's I'm going to build on Mr. Tiwari's idea. It needs to be a platform that brings different stakeholders together. Frankly, I really like the theme of today's event, which is India's self-reliance in a fragmented world.
Yeah.
I think sustainability comes naturally to India, if only as a community we go back 20 years. I think in the last 20 years, we've been very driven by Western ideas. We're very consumption driven, but if you look at how we all grew up, it was, I mean, an efficiency, circular economy, these are fantastic words, but frankly, this is exactly what we used to do. We used to reuse everything at home. We never carried plastic bags. We always had our own. So water was preserved. We didn't have major shower heads. We used to all use water very conservatively. So as a society and as a culture, sustainability, respecting nature comes naturally to us. We just need to go back and frankly integrate it in how we're doing business nowadays. The platform idea is definitely required because you may have a first loss fund, you may have but how is that fund going to be deployed? Which sector? Each sector needs to have its own nuances. So I would say the one big idea that can transform sustainability in India and put it at the heart of business is let's create a platform together where the policymakers are on the table, where the investors and the finances are on the table. There's philanthropy on the table. Blended finance happens with all of these. But they don't know which instrument. They don't know. We need pilots. The pilot will happen sector by sector. So I would say a platform with, say, 3-4 sectors which are priority for India as a country, or and those could be technologies, those could be climate smart agriculture, where there is a little bit of technology, but it's more of a mindset that needs to change as well. And once these stakeholders come together, let's look at 2 to 3 pilots of different kinds of instruments, blended finance or different kinds of business models, which one's more profitable, and then go ahead and let the institutions back those kind of business models or financing instruments and scale that up.
So a platform with all the stakeholders.
Absolutely.
Mr. Dua, final thoughts, your one big bold idea to leave this panel with.
Honestly, in this thing, there is nothing like a big bold idea which will happen tomorrow. It'll take generations.
That we're very clear on. But just to nitpick.
I think one idea which I have, which is very close to me and which I believe in, which could actually change behaviors. And I think this is the era where you have to change behaviors about how you look at it. It's about how do you, and let's say today is the commercial world. It's something which everybody looks at it. Can I finance it? Is there value in it? Should I put money in it? And you have to look at that reality. And I would say there was a point made by Hina here. Water is going to be the new gold. Right? I would say, why can't carbon credit be the new gold? The more you save, the more you have in your bank. If that becomes a currency of future going forward, you could actually get all these things done there. You could actually reach your goal.
Well, on that note,
I would just add one more thing to this. I think, as much as we want to be self-sufficient, we also need to keep in perspective that nature and environment doesn't discriminate. So even as a country, if we put the best practices in place and our neighbors and everybody else continues to emit the emissions, and we're still going to be in the same soup. So, we also need to be advocates to drive similar change globally, because this is where we need unity at the global level, because one country can reduce their emissions, and if the other one continues to emit, then nature is going to do its job.
It's very much a global issue, and therefore, coordinated action is what we're talking about. Quickly, if anyone from the audience has a question, we could take that. Mr. Sethi, would you want to add?
Very interesting perspectives. In fact, what we believe as the largest bank in the country is aligning the goals of financing to the goals of the country. And many forum, many fora I've heard the policymakers saying, if India has to, I think Ina also has mentioned, leapfrogging to a different level of economic development, this need not be pursued as other economies have pursued. I think we need to have our own unique model of development. And the central to this model is sustainability. We may not really do it tomorrow, as Mr. Dua said. The big ideas don't come, big ideas not necessarily that they have to be realized tomorrow. And big ideas assume that you have to sustainably invest in them. And I think a lot of thinking in this panel. I'm very glad that we were able to bring you together. Thank you.
Even if you form one innovative idea, unique idea, in a country like us, which represent at least multiple countries' conduct and character, so implementing that idea itself will become difficult. We have a very complex kind of. So you form an idea, form a policy, execution of it, because of our federal structure and energy, particularly power, which is a concurrent subject, so many complexities comes there.
Well, this panel has given us so much food for thought. I'm going to leave it at that. Thank you all for being so wonderful. Professor Das, Hina, gentlemen, it's been a pleasure to speak to all of you, and thank you for giving us so much to think about. Thank you all as well for being a very wonderful audience. Thank you.
Thank you so much to our panelists and to our moderator. May I please request Chairman SBI to come on the stage and present.
We need to thank our moderator for keeping us in check.
Of course. May I please request Chairman SBI to come on the stage and present mementos to all the panelists and the moderator as well. Thank you so much. Well, that was a power-packed panel. Now we break for lunch, and please come back at 2 p.m. exactly for more such panels and a lot more lined up. Thank you so much. See you at 2 p.m.
Request everybody to sit, please. We'll start the next session at 2 o'clock sharp. Thank you.
Ladies and gentlemen, we are about to begin with our next session. May I please request everyone to please be seated so that we can start with the next session. Ladies and gentlemen, in front of the door, could I please ask you to be seated so that we can begin? I hope you all had a great lunch. Can I please request everyone to please take a seat so that I can call my next guest? Ladies and gentlemen, request you all to please be seated. We are about to begin with the next session. Good afternoon, and I hope you had a great lunch session. And we now resume with the special address focusing on the evolving metrics of financial markets, governance, and regulatory priorities shaping India's next growth phase. For this, ladies and gentlemen, please help me welcome on stage with a huge round of applause, Shri T. Ravi Shankar, Deputy Governor, RBI, and Member 16th Finance Commission.
Good afternoon, Mr. Shetty, Chairman, SBI, Mr. Amara, MD, SBI, distinguished leaders, and members of the financial fraternity. It gives me immense pleasure to be part of what feels like, and perhaps is, the nerve center of the Indian financial system. The theme of the Conclave, which is India's quest for self-reliance in a fragmented world order, makes this event particularly timely and critical. The comfortable assumptions of the post-Cold War era of globalization are fading as we are seeing a re-emergence of protectionist tendencies and reshoring of critical supply chains. Economies and societies are struggling to adjust not just to the rapid pace of change of technology, but also as the fundamental nature of technology itself is undergoing a paradigm shift. Now, technology has always been a catalyst for improving efficiency in delivering financial products, but now it has become the very foundation upon which the future of financial intermediation lies. Today, I want to dwell on this theme that reverberates in the current era of disruptions and fast-paced changes. And the theme I will talk on is the role of technology in banking. Every aspect of finance, from payments to credit, to savings, to investments, regulation, supervision, every aspect is already getting redefined through technology. With powerful technologies like artificial intelligence and quantum computing already underway, our challenge is how to embrace them with wisdom and purpose, and ensure that technological evolution is secure, inclusive, resilient, and future-ready. India's experience in digitization shows that countries who harness technology with foresight and responsibility will not only adapt to change, but shape it. Our uniquely successful model of leveraging digital public infrastructures, or DPIs, like Aadhaar and UPI, have not only positioned India as a leading example of digitization, but also it has set an example for other countries to follow. For transformational change, it is not enough that technology is ubiquitous, it should also be foundational. What I will try and do is glean some of the key lessons of our digitization experience in India and sort of explain the approach that banks need to take to technology based on those learnings. If we look back today, we can see that India's banking system has passed through 2.5 decades of innovations in payment technology, starting from ATM networking and moving through a gamut of real and wholesale digital payments instruments like RTGS, NEFT, IMPS, to the game-changing UPI and continuing on to experimenting with digital currency. The journey has been gradual, yet transformational. What are the main lessons that we can glean from this experience that has placed India as a leading example of payment innovation? The first point, the very first thing to note is that virtually all these initiatives came from the public sector. Whether it is the ATM switch, or NEFT, or RTGS, UPI, or moving slightly away from the financial sector, Aadhaar. Even the initiatives to set up key institutions which have played a fundamental role in our technology evolution, like IDRBT, NPCI, IFTAS, and more recently the Innovation Hub, were all public sector initiatives. That is the first thing we have to keep in mind. The reason I'm highlighting this is that this leads to the model of digitization or technology adoption that we have followed in India. The second aspect is that all these initiatives were by way of creating infrastructures, specifically digital public infrastructures. They were situated in what can be termed a public goods space. They were priced like public goods, minimal charges or free. They were accessible by all, like public goods. This is the second lesson that we can take from our digitization experience. Thirdly, these digital public infrastructures were made available as a foundational layer for technology firms to create innovation. This gave the Indian approach a uniquely public-private cooperation character, an approach that resulted in the best of both worlds. While the public sector focuses on what it does best, create public infrastructure, the private sector focuses on where it has clear competitive advantage, which is innovation. Together, we have developed a symbiotic approach to digital innovations or digital transformation in our financial system. Fourthly, open access to DPIs led to a rise of new fintech players, such as payment aggregators, PPI issuers, third-party app providers, etc., bringing agility, innovation, and particularly scale. A point which is, which doesn't come out that clearly is that DPI itself has substantially contributed to the growth of the fintech sector itself. And finally, there is a general realization that the new fintech players, mainly because they had no legacy systems that tied them down, were far more nimble and innovative than the incumbent banks. While this did not undermine the role of banks as such, it exposed the Achilles heel of the banking system, that banks could be vulnerable to strong inertia in adapting to new technology. This brings me to the basic theme of my talk, which is the nature of challenges that new technology poses to banks and how banks need to adapt to it. Let me first explain this vulnerability in the context of UPI. Now, UPI is essentially a payment instrument that transfers funds from one bank account to another. It can also use wallets, but that volume is very small. For this purpose, we can, it's negligible. We can ignore it for this purpose. So if we are seeing about 67 or 68 crore transactions a day, all these transactions, at least, an overwhelming part of these transactions are happening in bank books. All UPI transactions, therefore, are payment transactions made through banks. Yet, when we talk of UPI, the first entity that comes to mind is not a bank, but a non-bank UPI app. We talk of UPI, we talk of the apps. That's the first thing that comes to mind. it is well recognized that these fintech entities have taken UPI to where it is today. And that, but for them, UPI probably would not have been able to reach every nook and corner of this country. Acquisition of customers and their payments data was enough of an incentive for these app providers to extend these services even in the absence of any direct revenue. It is also important to appreciate that these fintechs had certain advantages vis-a-vis banks. The first is, of course, the technology edge. Fintechs are more agile as they have no legacy IT systems, enabling them to use technology that is more conducive to scale up, integrate, and upgrade. Banks with their core banking systems find it relatively more difficult to modernize and upgrade. The second advantage that they have is the data advantage. Fintechs can access wider, larger, and more comprehensive data sources. For example, across multiple banks and spending channels, and are able to create a much better financial profile of their customers than banks are able to. This data advantage is another thing that they had. And finally, the cost advantage. With asset-light balance sheets, no physical branches, and very little due diligence requirements, KYC, AML, CFT, etc., these fintechs incurred a lot less cost than banks. These are the advantages that they already had. And these advantages were large. It can be reasonably argued that banks were unfairly disadvantaged. Higher regulatory burden, the friction of KYC process and AML checks, and so on. In a perfectly competitive market, banks would probably have recovered their higher costs from these fintechs. But then, adoption of new technology would probably have suffered. But even without these disadvantages that banks had, the point I'm now trying to make is that it would be reasonable to assume that banks just did not foresee the potential in UPI that the fintechs did. Part of that explanation of why banks could not foresee the benefits of data, the benefits of customer acquisition and all that, part of that explanation lies in the very nature of banks. It's important to understand this if we have to reach a situation where we can realistically look at how to adapt to the new technologies. Now, first, banks are special entities, unlike any other business. They have an important socio-economic role, that of creating money. Because of this role, banks are licensed and closely regulated and supervised. This arrangement works to the benefit of banks in some ways, because entry is not free into this space. And there is some degree of underwriting by the state, by the central bank, state. I'm treating them together. It also has a disadvantage that banks have to bear the cost of regulation, both financially and in terms of the obligation to follow prudential processes. One corollary of this somewhat protected environment within which banks operate is that their innovation edge is blunted. This is probably one reason why banks did not fully appreciate the potential benefits of UPI as keenly as the fintech players did. To put it simply, the fintech players needed UPI a lot more than banks needed UPI, to convey that. Now, if this indeed is true, is it time the banking system thought hard and deep about the challenges from the transformational technology changes we are living through? Technologies like artificial intelligence, blockchain, quantum computing, and digital currencies will shape the next decade of financial transformation. Now, these technologies pose very specific and peculiar challenges that are fundamental to banks. I will highlight those two challenges that come to my mind. The first is that most money in modern economies is bank money. Creating, if we for a moment ignore paper currency, creating money through extending credit is the most basic function of a bank. The advent of digital currencies is now providing an alternative, which was never there. So technology is not necessarily used only for better delivery of financial products. They can actually create alternative financial products. We can no longer assume that banks would always remain, because who else would create money in the system? That is the lifeblood of any modern economy. The risks from private digital currencies to banks appear existential, yet not very well understood or debated globally. Even with CBDCs, which are digital currencies but fiat, CBDCs which become a necessary bulwark against private digital currencies, which are extremely harmful, as we have argued elsewhere, to policy sovereignty and to the existing financial system. Digital CBDCs, even with CBDCs, banking business is likely to change significantly. And these impacts need to be understood by banks. It is not just the responsibility of a bank, of the central bank, the issuer, but also of the banks whose business is going to get affected. The second point is banks. The first point was that only banks could create money. Digital currencies are changing that narrative. The second point is banks are the core intermediaries in financial markets. Every financial transaction, again, I'm not considering currency transactions here, paper currency. Every financial transaction, whether or not it requires other types of intermediaries, for example, brokers or market makers, would always require a bank to authenticate the payment leg. Because money exists in the books of the bank, and that bank has to authenticate that that money exists. It's necessary. This is something that only a bank could do. With the blockchain technology, this could very well change. The basic function of a blockchain is to authenticate transactions, financial or otherwise, in the absence of a trusted intermediary. This is the basic reason for existence of the blockchain. It is now possible that banks may not be required to authenticate payments, substantially impacting their role as intermediaries. So the role as intermediaries and the role of creating money, which were very unique to banks, are seeing challenges from emerging technology. Apart from these fundamental changes, new technology poses various other risks to the roles that banks traditionally play. For instance, digital currencies can provide a superior alternative to banks in cross-border payments. Quantum computing, though nascent, could one day revolutionize encryption, risk modeling, portfolio optimization. AI can interpret blockchain data, can probably do market making a lot better than human beings can. CBDC can embed smart contracts. IoT devices can trigger automated financial settlements. Together, these technologies signal a shift from a system of intermediated finance to one of intelligent interconnections. Now, the risks emanating from these technological shifts need to be recognized and understood. True, at this stage, these risks are more conceptual than actual. Yet, at the very least, they can eat into the exclusive domain of banks. going forward. Banks, therefore, need to be prepared well to meet these challenges and maintain their central role in monetary transmission and financial stability. While by now, banks have a fairly good understanding of how to approach technology adoption, I would like to reiterate a few aspects that need to be kept in mind with respect to adopting the new transformational technologies that we are seeing now. There are 3 points I would like to make. One, that banks have inherent strengths: credibility, balance sheet strength, and customer base. Technology asymmetry tends to dilute these benefits. Therefore, the ability to leverage these strengths depends on the agility and speed with which banks modernize their systems and reimagine their business processes. 2, the nature of technology change facing banks is different this time. Many technology changes are no longer incremental. They are re-architectural. They require rethinking on the architecture of banking business. Platform technologies, for instance, effectively enable non-banks to come into the bank's domain. Distributed ledgers undermine the traditional institutional guarantees that banks provided. Therefore, competitiveness may no longer depend as much on balance sheet strength as on data capability and technology flexibility. Since banks are structurally vulnerable because of their monolithic IT systems and high fixed costs arising from branch networks and compliance costs, incremental digitization this is something that we need to keep in mind, that incremental digitization is unlikely to keep banks competitive. In this context, what can be the strategic imperatives that one must do for banks to prepare for these transformational technologies? Modernizing core infrastructure to make it less monolithic and rigid is clearly one imperative if banks have to compete with the fintech ecosystem. Adopting, or I'm not saying completely shifting over to, but incorporating a platform orientation and API-based collaborations with fintechs is another imperative. Perhaps the most important requirement is re-engineering the culture of innovation within banks and creating incentives for learning and skill upgradation from within. Human expertise to innovate, govern, and responsibly deploy technology would remain the differentiator in a digital world. Institutions must cultivate deep digital and data skills at all levels, ensuring teams are equipped to navigate complexity and seize opportunities. Equally importantly, banks need to treat fintechs as partners in innovation and create a mutually beneficial or symbiotic strategic partnerships with this ecosystem. The objective should be to benefit from the agility of fintechs without compromising prudential discipline. I would conclude now. As we reflect on the transformative absorption of technology in finance, one truth is unmistakable. While technology is inevitable, its direction is intentional. The choices banks make today will shape not only the architecture of their IT systems, but the experience, inclusion, and trust of millions of citizens tomorrow. As technology is rewriting the very DNA of finance, the preparedness of banks will determine whether they lead this transformation or are led by it. institutions that adopt technology strategically, embed strong governance principles, develop human capital, and collaborate across the ecosystem will not only navigate change, but will shape it. Thank you.
Thank you so much, sir. May I please request you to take a seat? And now I would want to invite Sri Rama Mohan Rao Amara, MD IBGMNT at State Bank of India, to moderate the Q&A session.
Good afternoon, everyone. Dr. Ravi Shankar doesn't need any introduction. Sir, in just 25 minutes, covered so many aspects. I was trying to write, but so many which are very, very relevant. Just to recall just one or two. Talked about the philosophy behind DPI and the public sector playing the bigger role, and how private sector latched on the opportunity. They're looking at the data, monetization and everything. And of course, the threat posed by the digital currencies. Then, of course, a lot of prescriptions and advices for the banking industry, given the bank's strengths. Sir, my questions are around these areas. A few I have, but the audience is equally keen to seek some responses from you. Sir, talking about the DPI and the kind of enormous strides what we made in the retail payments, where UPI accounts for 85%, and this is like a case study everywhere, not only in India, but also in every international forum. We are just a case study, a lot of curiosity is there. And to a large extent, I think 6-7 countries, we are trying to partner with them. NPCA is working on actually extending the UPI. They have been successful in a few countries. But what, in your view, will be the priorities for RBI in the next phase of digital payment evolution, especially around resilience, scalability, and inclusivity? And what role does RBI expect banks and non-banks to play in this area? Sir.
I can sort of read two questions in what you have asked. In terms of what the thinking is about the future of DPIs, and what is the agenda for payments going forward. I'll take those two separately.
Yes.
We have been creating, I've just given an example of UPI and Aadhaar, but there are many other digital public infrastructures that are already in place. Given the benefits that are so clearly recognized of these DPIs, we have to start expanding them. Now, for example, there are efforts to expand them into the area of credit. Again, this will just be a platform, the unified lending interface, the work that is going on there. This will just be a platform where lenders will be on one side, data will be on the other, and any borrower can access this platform and take a sort of market-determined loans. This, particularly because of the access to a huge sources of data, will probably play a far more transformative impact on the financial system, on the banking system going forward than any other payment system, UPI, etc., that we have seen. UPI has been extremely transformational, but this has a promise of being even more transformational. Similarly, we are looking at DPIs to reduce fraud and increase trust in the systems. And the work on mules, the mulehunter.ai, or the digital payment intelligence platform are efforts towards creating that. The general response perhaps would be that we continue with the model that has worked for us, which is infrastructure is created in the public sector, access is given to the private sector to use this infrastructure to innovate, will continue in all these areas. The second one on payments, I think there are two ways to look at where we are looking at payments going forward. Number one is that as far as payment efficiency is concerned, it is as close to perfection as we can have in many respects. It can always improve, of course, better reach, better inclusivity, and so on. But in terms of technology, in terms of available technology, we have the best that is available. Many countries have that. But the benefits that we see so clearly in the domestic space are so palpably absent in the cross-border space. Globally, there is a lot of effort to get that in the cross-border space, but there is a realization, under G20, this is being worked under the aegis of FSB, but there is a realization that despite a lot of efforts, one is not seeing the kind of benefits that one would like to see in terms of reduction in the cost or time of cross-border transactions. I think it is possible to use technology to achieve these cross-border efficiency. So the payment, I think the next stage of payments revolution globally and even for us, we are the largest receiver of remittances in the world. So an efficient system will be a lot more beneficial to us as well. The focus is on transporting the benefits we see on the domestic leg to the cross-border space. I think the second aspect is, is rather in terms of tokenization. So a lot of new technologies, facilitate tokenized money, tokenized assets. I think we are focusing, CBDC is tokenized money. We are also looking at tokenized financial assets. So that is the a second area where payments would focus on. Thank you.
Quite comprehensive, sir. Sir, I think RBI's stance with regard to the stable coins, which are becoming quite a lot of talk is there in other countries. But the stance of RBI is very clear. You made it very clear in other forums as well. But in India, RBI has been undertaking several experiments with CBDC, popularizing CBDC in both wholesale and retail operations as well. So what kind of operational and behavioral insights are we drawing from these ongoing pilots? And the second question will be perhaps on the next frontier challenges. What are those next frontier challenges, what we are seeing in the DPI in India? So.
What we have learned from our experimentation with CBDC is first and foremost, a question I've been asked in virtually every forum that I talk about CBDC, which is that we have UPI, why do we need a CBDC? So the first learning is that we need to demonstrate exclusive use cases for CBDC. In my mind, I have no doubt, as I've told earlier, that CBDC is money, whereas UPI is just a payment system. CBDC has a lot more versatility attached to it. A lot can be done on it, but we need to demonstrate that. And that demonstration would largely happen through programmability. Because there are digital tokens, we can attach programs on it. Very recently, we are talking about launching for a state government, a state government scheme which will be paid in CBDCs, which has two layers of programmability. One layer of programmability that it can only be used with identified merchants. And the second layer of programmability is that the merchant itself cannot use this money until government authorities have examined and said that yes, the transaction is genuine. So many things are possible. Many things are possible. So that is perhaps the biggest learning, that we need to establish exclusive use cases that only CBDCs can do. The second thing is CBDCs can play a transformative role in cross-border payments. And to be able to demonstrate that case, we will have to enter into at least bilateral or maybe a few multilateral arrangements and show to the rest of the world and to ourselves that it can actually work in achieving the benefits that we are looking to find in the cross-border space. So I think these are the two learnings that we have to gradually move over to cross-border use cases and also domestic use cases.
Sir, on the remittances, you said the cost associated with the cross-border remittance is high. According to some reports, it is as high as 6% for smaller remittances. Once a CBDC becomes popular and country to country or sovereign to sovereign understanding is there, to what extent it can come down? Are we looking at sub 1% or?
I think we need to understand what we aim for. More than half the cost I'm talking of retail transactions, of cross-border transactions is exchange cost of exchanging from one currency to the other. Changing the instrument from, let's say, bank money to central bank money, to CBDC, is not going to affect that cost. What CBDC will reduce is, because it is a central bank currency, it doesn't require settlement, it will reduce the settlement capital that banks have to otherwise provide. It will reduce the number of steps. It is like I can hand over CBDCs directly. It will reduce the number of steps that money has to go through, and every bank has to process it, therefore they have a charge. So those charges can be reduced. But more than 50% of the cost is still on the exchange cost. We are experimenting with something in some banks. SBI itself is participating now, and hopefully, through that experiment, we can show that it's possible to even reduce that cost. But that's a separate problem. I think we need to look at them as two different problems and address them separately.
Agree, sir, completely. So coming to AI, you said the private sector has taken the leap, particularly the fintechs through the TPAPs, etc. But I think last few years, NBFCs and banks have been extensively adopting AI and data analytics in a big way in terms of underwriting, fraud risk management, etc. So how do you propose, sir, as an RBI, how does RBI plan to ensure ethical data usage and algorithmic accountability? So
you are aware that we had set up a committee on free AI, which had given its recommendations. It had given those 7 sutras, based on, if I remember all of them, maybe I won't, trust.
Yeah, you enunciated 5 T's.
That 5 T's, but there are 7 sutras, the 7 principles that we did. Some of them are trust, people first. Some of the basic principles that any AI system should follow: trust, people first, innovation over restraint, accountability of the systems, explainability by design, safety, and so on. So these are the principles any system has to follow. Now, how do we ensure that the system knows how to go about it? The report has been given. It is now being internally examined. We propose to come out with a discussion paper, and based on the feedback from the ecosystem, we would look at implementing it for the ecosystem, not just regulated entities, but for ecosystem. In fact, the applicability of the RBI Free AI report is, in a sense, universal. Only recently, government came out with its AI suggestions, where they have said that they are using the 7 sutras, the principles of the RBI Free AI report for adoption of AI across the country. So, it has to be a consultative process before we can actually finalize implementable guidelines.
Sir, thank you, sir. And now I open it to the forum. Anybody feel free to ask any questions to sir. Yeah, please. Hand over the mic to Lataji.
So sorry for collaring the conversation. I just wanted to know, when do you expect the first such CBDC transaction to happen at all?
Sorry, the
I
first?
mean, inter-country. inter-country CBDC transactions, say from you to MAS or some other such country? Is there a timetable in mind?
Yeah, I know. I sense a little bit of an impatience in your question, but then a similar impatience has been expressed by others. And what I've told earlier, I would still say that now. When you are going for a new product or a new technology, it is just as important that you do it right to begin with than to do it quickly. Don't do it right and the product might not take off again. Conceptually, we have no doubt that CBDCs will virtually change the way many of these payment transactions and others happen. Conceptually, it's not very difficult to explain. But as I said in response to an earlier question, we have to place CBDC, we have to position it as something that not only does what any other payment instrument does, like UPI or others, but also it also has special functions like programmability. We are trying it out with many governments and government departments, but we are still keeping it at a pilot stage for two reasons. We are in no particular hurry to go for a proper launch, but try it at a pilot stage for two reasons. One is within the domestic space. Since no other country, no other significantly sized country has actually introduced CBDC, we have no way of understanding how it is going to affect your financial system, your banks, your ability of banks to mobilize deposits, your ability of banks to give credit. That learning we have to do as we are introducing, as we are going with the rolling out of CBDC. We can't take the risk of affecting the stability of the system. So we have to necessarily go slow internally. We believe that the strongest case for CBDC is in the cross-border space. But the cross-border narrative is fairly confusing. There are, countries which say CBDC is bad for privacy reasons, and there are countries which say stable coins is very good. There are international bodies which say stable coins have a lot of risks and no clear use cases that have been established. Our thinking has always been very clear that stable coins pose a risk, and the same functions can be done by CBDCs if they are interconnected. So to establish this, we have to get some degree of international agreement with other countries. We already have, we are doing it with a few countries, but we need that sort of a narrative to develop. We do not want to, straight away, perhaps the technology-wise we are ready. We can maybe start a transaction or two, and then nothing happens. You will be asking even more impatient question next time. So the point is that I think patience is a virtue here. We are in no hurry to introduce. We want to get the timing right, get the conditions right.
Last question from anybody in the audience?
Sir, you mentioned about two things, trust and inclusivity. And I'm referring to the CBDC domestic use on payments. So the thing is, UPI has been transformational, but even a small fraud or scam, anecdotally, if you see that, reduces the confidence of people in using UPI as such. So what we find is other central banks, they do a lot of qualitative studies to understand this trust part of it, because I'm likely to be financially included, but only when I have trust, I will use it. So there are two options, like I fall down and again I regain trust. So are we looking at this kind of a scenario, or we are doing something to, especially on the part of trust and inclusivity, so that the pilots which are on, so that can be scaled up, for the domestic payments I'm talking about.
That's important. You know, one of the reasons why there is so much of an effort to develop public infrastructures to reduce the incidence of and the impact of frauds is that it is important, especially in a country like ours, where maybe a substantial part of the population is not very digitally savvy, but can clearly see the advantages of using digital modes of payment and other instruments. It is extremely important that people have an inherent trust in the system, and it is the responsibility of authorities and institutions like banks to ensure that that trust is not only generated, but also maintained. So yes, to answer your question, we have to do everything we need to do to ensure that transactions don't fail, people are not cheated out of it, or systems are not very confusing or very difficult to use. We have to, we have to build that trust, which is being, worked on. Having said that, I think it's important to realize that in any system, there will be some degree of frauds. If we look at frauds per number of transactions, we would see that compared to last year, from the beginning of the year, that incidence kept on, reducing substantially until about July, when it again started rising up. So they might be cyclical, they might be going up and coming down, but we are hoping that with the digital infrastructure that we are creating and the success that we are seeing, Mule Hunter is seeing a success of more than 90% at this stage, we will be able to contain that. But this is not a fight that is won at a point in time. This is a fight that, against people, bad actors who will misuse any system. That's a fight that has to go on. Both sides can use technology. Just like we can use technology to prevent frauds, fraudsters can use technology to perpetrate frauds. So this is a continuing exercise we do, but we have to ensure that the incidence of such events is not so much that it affects the trust of the average person.
Thank you, sir, for responding to various questions very patiently. Let's extend a round of applause to sir.
Thank you so much. It was indeed very enlightening. I would now request a green certificate to be given to the Deputy Governor, and a huge round of applause, ladies and gentlemen. Chairman, sir, I request you to please come on the stage. Ladies and gentlemen, in front of the door, can I please request all of you to take seats so that we can begin with the next session? On to the next panel, the panel number 3 of today. The topic is, will India get older before it gets richer? Now, it's a very interesting topic. It depends on, the smoothening the odds of demographic dividends in a country like India. India's demographic advantage is real, but leveraging its impact depends on harmonizing skilling, employment, productivity, and state capability in a time frame. This next panel brings together country's most respected economic voices to examine the policy levers that can anchor this quest. Ladies and gentlemen, a huge round of applause for our moderator for the panel, Ms. Latha Venkatesh of CNBC TV 18. Also, with a huge round of applause, please welcome on stage Dr. Sajid Chinoy, PMEAC member and Chief India Economist JP Morgan, Professor Debashish Acharya, Dean School of Economics, University of Hyderabad, Professor Bonali Bhandari, Professor NCAER, Dr. Partha Ray, Director NIBM, Dr. Soumyakanti Ghosh, Member 16th Finance Commission and Group Chief Economic Advisor at SBI. Ladies and gentlemen, a huge round of applause for the panel and the moderator.
We await the host. Dr. Ghosh, we await you, sir. Thank you very much, State Bank of India, for arranging this discussion with a very eminent panel of economists. I shine in borrowed feathers. Thank you very much for inviting me. Well, the discussion on population, at least from my childhood, has come a full circle. Time was when in our textbooks, population was seen as a curse. And we began with the Malthusian theory, which said that population will result in destroying itself when there are too many people, more than the country can manage. And here we are in societies where people are desperate for the demographic dividend, so to speak, to continue. Well, I don't think to an audience like this, we need to explain the demographic dividend, but basically what all countries and all societies would like is that the working age population should be as high as possible and the dependent population should be as low as possible. But as people start having fewer children, or what you call total fertility rate goes down, and you're not replacing a husband and a wife or a man and a woman with 2 children, but with only 1 child, what you actually see is a decline in the total number of people. You first see the pace of total fertility rate going down, and then finally you see even the aggregate population going down. What we are interested is in the working age population because that directly impacts the GDP. The question we are asking is that when the demographic dividend is in India's favor, which it is believed to be at least for the next 10, 15 years, will we be able to grow our GDP fast enough to be rich before the fertility rate starts declining or the aggregate population starts declining? All decline in populations usually impact growth because there are fewer hands to work and more mouths to eat, dependency ratio being high. Those are periods when there is usually lower growth and higher inflation because there are fewer hands to work. So will we reach that situation before we get rich enough is the question that Shaumya has posed to the panel. Thank you very much, Sajid, Dr. Acharya, Ms. Bhandari, Shaumya, and Dr. Roy. Let me start with you, Sajid. Can you lay out the math? How is the population as of now expected to peak, or the working age population expected to peak? And simultaneously, can you lay out what kind of a rate of growth can one reasonably expect by the time population peaks?
Thank you, Lata, and thank you very much for inviting me here. So I think it's good to just put some numbers on the table. As you said, the key metric here is going to be what is the ratio of the working age population to the total population. This troughed in 1965 at about 55%. And it took 35 years in 2000 for it to go from 55% to 60%, right? Then the dividend really kicked in because from the millennium, 2000 to 2020, this gallops from 60% to 67%. Now, I think the first message I want to leave with is we are very much in the midst of this demographic transition such that the demographic dividend is going to peak in a little over a decade. The working age ratio from 67% now is expected to peak at 69% by 2032. We only have 7 years left before it peaks. It's expected to stabilize for 5 more years till 2037, right? So from 2025 to 37, we have basically 12 years. After that, it begins to come off very sharply.
But the more dangerous thing you're saying is that we've already spent 25 years of a growing dividend.
Let me give you another couple of numbers. We've already spent 25 years very much in the flush part of the dividend. You have another 12 years. After 2037, things begin to taper off and the dependency ratio starts to rise. What does this mean in terms of growth rates? Because you asked about growth rates. You know, growth is a contribution of capital deepening, total factor productivity, and the contribution of labor. Labor, in a way, the contribution of labor is a function of two variables. What is the growth rate of the working age population annually, and what is the contribution of human capital? Now, in the heady days of the early 2000s when growth was strong, let's not forget the working age population was growing close to 2%. Already that growth rate has halved to now 1.1%. In another 10 or 15 years, that's going to halve further to 0.5%. Why does this matter? Because if you're aspiring for 7, 8, 9% growth as we must to get to upper middle income status in 20 years, but your working age population is only growing at 0.5% or 1%, there's an enormous amount of work that needs to be done by productivity growth and by capital deepening. And you're seeing in China that as the growth of the working age population has come down, potential growth has gone from 12 to 10 to 8 to below 4 today. So let me end you with this message. We've got 12 years to maximize this dividend. The next 12 years represent the best chance for India to get as many people employed as possible, to empower them with as much human capital as possible so that the contribution of labor is at its peak in the next 12 years. One very final point, Lata, we'll talk about AI, but I now cover Asia, and I want to give you one scary statistic from Taiwan. Right? What is the challenge for employment? This growth in general has become so capital intensive. We're on the cusp of this big AI boom. Taiwan has been at the epicenter of this AI boom. Right? Taiwan's exports to the US are growing at 50% in the last year. Today's number 1 hour ago was 45% export growth. GDP growth in Taiwan has been 7%. But because AI is so capital intensive, consumption growth in Taiwan in the last year has been 0.5%. And consumer confidence is falling. This is all capital intensive. So the challenge for emerging markets, including India, is in the next 12 years, in a world that's becoming more and more capital intensive, how do you generate labor-intensive growth?
No, that point is taken there. I'm just coming out from a debate where people are arguing that this capital-intensive, trajectory in AI cannot continue, and it will sow the seeds of its own destruction, or at least slow down. I mean, AI will continue to be useful, but the expected financial investments perhaps cannot continue. But before that, the other part of the debate is, before we get older, will we get rich? Now, Shaumya, I come to you for that. What is the reasonable rate of growth we need? And how do we define rich? Should we define rich as what Tamil Nadu, Karnataka and all are now, because they are already seeing lower fertility rate? Or is that the dream number of $18,000, which is in front of us as high income or, Viksit Bharat?
No, thank you, Lata. I think I'll just add to the points that Sajid made and also your question. I think there is one more angle to this aging. Basically, the intra-differentiation within a country like us. For example, and we have been debating this for a long time. In fact, in the commission also, we had been debating all these issues. But that's a separate thing. But the important point to note is that some numbers, again, I'll just go 4 years ahead of Sajid, 2036. The total number of older population in India will be around 230 million, which is 15% of the overall population in India.
And the working population?
Working population could be still above 60%, 900 million. But the important point to note is that Uttar Pradesh will go up from 7% to 12% during that period, while Kerala will be at 23%. So look into the distinction. Uttar Pradesh is moving up, Kerala is as 23, Uttar Pradesh is just lower than that. So there is a clear demarcation, and not only the southern states. There are states like Himachal Pradesh, there are states like Punjab, which are also aging very fast. So, and Punjab was one of the states in 2002, remember, it has the highest per capita income. So if this is the case, and the other important thing is that, related to that, and that's a separate thing, if we have time we can discuss, is that the fiscal conditions and other things is also related directly to this aging. Kerala is an example, Tamil Nadu is an example, Himachal Pradesh is an example. So there are examples galore that if the state has an aging population, or you are giving, I mean,
the tax to GDP falls.
Tax to GDP ratio falls. So my sense, I think, even if we suppose the question which you posed, what much you have to grow, that number, 7%, 7.5%, we can all debate. But at the end of the day, what is important, the point which you mentioned at the beginning is that the question is whether you don't grow old before you go rich, whether you can grow enough so that you can overcome this liability of becoming rich, the old population becoming a burden on your growth rate.
Okay, no,
in
that's
terms of the healthcare, education, other costs.
That's a fair point. Even in that scenario, you still have the working population 3 times the dependent population, or the aged population.
3.5 times.
Yeah. What if, we don't even have that kind of a positive ratio? Okay, before I come to the growth argument then, would you all want to add anything, or have you all the numbers on the table? Dr. Roy?
Yeah, I thought, the situation is not necessarily a doomsday. There could be policy intervention, this first. And second is, while we are looking at the demographics, what Shomu said earlier, there is the other part of getting richer. So if you think of what would be the nominal rate of growth per capita, it's like 8, if you say an optimistic 8 plus 4 inflation.
Sir, 8 nominal is not...
No, I'm saying real. Real 8, inflation 4, that's 12, minus 1, 11. If you get 11, then you can expect by 2050 something like $36,000 dollar as per capita GDP. So one is the doomsday situation in terms of demography. The other is how fast you grow. And the second thing what Sajid has shared, that our window of opportunity is shrinking. Window of opportunity is 7 years. But there are a hell lot of intra-country adjustments. Like Shomo's Punjab and Kerala to say somewhere in UP. So those kind of adjustments are internal. You need not have to depend on, in this difficult world, out migration.
Okay, fair point. So would you want to add anything, Professor Acharya?
Thank you, Lata, and thank you, SBI. I just wanted to add to what Soumya said. The numbers have been put by Sajid. The intrastate differences. If you look at the southern states, I think 1.78 is their TFR, total fertility rate, which is below the replacement rate of 2.1. But some of these states are already, if you look at 2024 gross state domestic product, they are among the 10 richest states, if you look at 2024. Yes. And one thing which is concerning is that when you look at some of these southern states, they are doing well. There is a likelihood that because it is 1.78, so their demographic dividend will actually decline, and that is below the replacement rate of 2.1. I think that is the reason why, when you look at the interest rate differences, we have some apprehension that it is going to hinder economic progress and all that. And which is well placed in the, I think there is a paper by David Bloom in IMF's June 2025 article, which talks about the debate over falling fertility. The pluses and minuses are very well articulated. The pluses are, let's talk about the minuses first, because the debate we are having that, are we getting older before we get rich? Shrinking workforce, shrinking number of scientists, ideas decline, innovations decline. So obviously your economic progress will decline, in addition to other standard macro parameters. But when you look at the positive side, the literature also argues that, okay, you have smaller, less children, so you may spend less on housing and childcare activities and all that. So those resources can be diverted to advancement of technology and all that. And that's where Sajid's points come in with the capital deepening and all that. I would like to add that probably we can think of, from our standard growth models that we have studied, augmented kind of human capital. How do we make the best use of AI instead of getting scared of this technology? How do we use the existing dividend? He has already pointed out that we have sort of lost some time. Yes. But the next couple of years, if we can make the best use of human capital by augmenting with this, I think we should not fall into despair. I mean, that is one part. Okay. Just one line on the interstate. Maybe I'll come back
Yes,
later.
Certainly. Actually, I wanted to spend more time on what policy, therefore, we should we adopt to ensure that we don't lose these last 12 years of our demographic. That should be the thrust of this discussion. But Barnali, do you want to add anything more to the data itself? I want to jump to the growth data right away.
I just want to add is that the doomsday scenario is a little bit balanced by the fact that we are one country and there is migration. So if you look at the sociological or the demography literature within India, and my own colleague, Professor Desai, has done this work and has written extensively on it, that the migration allows you to actually, don't lose out this demographic dividend, the southern states. And the classic example internationally is India, US, and Japan, where US did allow for international migration. Yes. Of course, let's not talk about the more recent developments, but until recently it did allow for international migration, and that helped to stem its own falling fertility rates. And Japan didn't, so the differences are quite evident.
Oh no, that's very useful goals to have in mind, why probably southern states are benefiting because they are allowing migration. So even if we speak within the country, that's a very important point. But that is where my despair comes. The southern states, okay, let us take one state, Tamil Nadu, is probably double the national per capita income, and Bihar is probably half the per capita income. My fear, Soumya, is this, that when Bihar reaches the fertility rate of Tamil Nadu, which is already declining, Tamil Nadu is very close to lower number of people, not even pace of growth, very close to aggregate people falling. By then, will it only be as rich as Tamil Nadu? Then we are in a problem, because that is the richest we can aspire to be, is it?
No, I think that's a fair question, and I'll just add an interesting point to it. Tamil Nadu, many states, and not only Tamil Nadu, have very high per capita income to Bihar. But
what is there?
And I'm just one interesting, but Bihar is more fiscally prudent than Tamil Nadu. So that's basically the bottom line which I want to emphasize, is that there are richer states which have the money to splurge or whatever reasons. That's a separate debate. But at the end of the day, it is also important that, because the important point is that whether you can invest, you have enough money to invest in healthcare, whether you have enough money to invest in education, whether you have enough money to augment the labor productivity. Instead, if you don't money, for example, I'll just give an example. Total, we're discussing in the morning, total discount rate is around 7 trillion today. Tamil Nadu is perhaps more than 1.5 trillion across in many Indian states. But the point to note is that if you don't have money, so even if Tamil Nadu is rich, it has a problem in terms of the fiscal issue. And to your second question, whether Bihar can actually, I mean, go to that level.
We should not be condemned by just that much growth.
No, that is true. So basically, at the end of the day, it is very difficult to visualize a situation that Bihar will get to that level or so in the near future.
Fair point, fair point. And one can notice that once a finance commission member, always a finance commission member.
I have just one point here. Whatever literature I've seen on convergence, in terms of the states of India, there are reasonable evidence of conditional convergence. So it's not that they are hugely diverging. There are conditional convergence, after accounting for the initial condition and little other things. So there are some ray of hopes, even in that abysmally different situation of Bihar and Tamil Nadu.
Can you answer my despair, Dr. Roy, that, when Bihar's TFI, I'm just taking the extreme examples. I looked up the chart of per capita income, and Tamil Nadu stood at the highest or among the highest. There was, of course, Goa also, but I thought I should take a bigger state. And the bottom of the list was Bihar. That's the only reason why I'm taking them just as examples. There are many other examples I can take. But if by the time Bihar's per capita total fertility rate falls from the current 2.5 to probably 1.8, will it be able to be richer than Tamil Nadu? Is the current rate of growth giving you that confidence?
Answer is perhaps yes. I'll tell you why. One of the things is fertility is essentially a function of reduction in fertility, essentially a function of education in general and women's education in particular. So, I mean, in terms of the list of things that Sajid shared, I will add education in general, women's education in particular. So many of these numbers, many of these calculus could go astray if we have enough human capital formation in terms of basic education. And basic
so policy intervention is what we should be talking about. Let me start with you.
Let me just add in a quick point. That you started with Malthus, but Malthus's point was disproved really quickly, partly because there are interventions in technology, right? There were technology changed the notion, investments in education and health changed the notion. So I don't think we have to be so gloomy about Bihar not catching up with Tamil Nadu. Of course, that means the right set of interventions, and what interventions are, that's the next step.
No, I'm not at all gloomy about Bihar. At the moment, we should be very positive, because that is the state which has the best prospect. But I think we have to concentrate more on the policy interventions that are needed, so that we are able to push up growth to a point where when the human capital starts to, or the human numbers start to decline, we have enough productivity in our hands. Let me start with you on that, Sajid.
No, and Lata,
what would be your number one policy priority?
Well, this is almost true by definition, that you everywhere around the world, India is no exception here, you want to make growth more labor intensive. Now, what does that even mean? It means that development is this battle between capital and labor, right? And how do you give labor the best possible chance to compete with capital? We should not presume that capital intensity and AI is going to slow, right? Technological progress has happened in the world for the last 300 years from the first industrial revolution. It's going to accelerate, if anything. People think AI could be exponential growth, and therefore first mover advantage becomes critical. You'll get massive investments in capacity. And this is very capital intensive. So that progress is inexorable. You can't wish that away, and you can't regulate that away also beyond a point. The question is, how do you on the positive side give labor the best possible chance to compete with capital? And again, this goes back to old solutions. You spoke about this. Education, skilling, health, laws that don't discriminate against labor while trying to help labor, right? You don't want to subsidize capital. For a long time in India, we used to have accelerated depreciation. So you were basically subsidizing capital, and there were some labor laws, one will argue, that were meant to help labor, but discourage the use of labor. So you want to balance the playing field between capital and labor. I can't emphasize enough, there's no easy fix here, Lata. For growth to be more labor intensive, you have to do the hard work of fundamentally changing lower, education, higher education, skilling, health, labor intensity. Let me end with 2 points. There is a huge opportunity here because as China has pivoted hard to very capital intensive green transition, solar panels, EV, they want to compete with the US in the AI race. They are leaving a vacuum, right? And the vacuum is that they have withdrawn from labor intensive stuff. So textiles, apparel, footwear. Asia is going to be where the growth dynamism is. As that growth happens in Asia, people will still be wearing shoes, right? And wearing clothes, right? So there is this pool of labor intensive growth that India needs to tap into and can tap into. The opportunity is there. One very final thing I'll say is, right now the constraint is not the supply of labor. You see, this demographic dividend argument assumes that there won't be enough people to work and potential growth comes down. We have a stock of people that are not fully utilized. Let's look at female labor force participation. So in theory, even if labor force growth, working age population growth goes to 0, but you have a stock of existing people that are not working. FLF is very low. You can create that by getting more people to work. So I think the challenge is today, how do you make jobs, how do you create demand? I would argue the constraint today on binding constraint is demand, not supply. How do you create more demand? How do you make growth more labor intensive? And how do you boost female labor force participation, which both makes growth more labor intensive and boosts our potential growth?
No, you have a very big point in that. And more importantly, as labor starts getting somewhat scarce, not scarce, but the stock's running out, we probably will have an improvement in income. India may not be suffering a problem of jobs as much as a problem of income, because you don't need to pay more. There is enough supply available. So probably we will actually be encouraging consumption in the early stages of labor getting somewhat able to demand its price. But speaking of education and skilling, I think the expert in this panel quite clearly would be Dr. Acharya, Dean at the School of Economics in Hyderabad University, as well as having taught both at IIT and at various other universities. Dr. Acharya, what would you say should be the education policy? Because as Soumya pointed out in his introductory note, we may be overinvested in schools actually, and we probably have to overinvest not in schools, but in universities and skilling. What are the flaws now and what need immediate correction?
Thank you for that question, Lata. Thing is, relating to what Sajid said, we need to make the best use of our demographic dividend. Especially, I'm talking about higher education now, since you mentioned about that. If you look at the data from 2-3 sources, so there are some concerns. If you look at the annual survey of higher education, which Ministry of Education does, and the other day, the Honorable FM said that universities have increased, colleges have increased, we have more IITs, more IIMs, all that is true. Yes. So that has also shown up in the 2020-21 survey. If you look at, that is the latest survey available. I mean, institutions upload data on their own when asked. And so there is a possibility that some institutions may not have uploaded data, but given the data, what we find is enrollment in the last 5 years has gone up. That is one thing. And if you look at overall enrollment, female will be around 48 point some percent.
This is school enrollment you're talking
No, I'm talking about higher education enrollment. Specifically about higher education, since you asked that. And male is about 50%. So enrollment has gone up, point number one, and then we have around 50% of enrollment in higher education. But what is interesting to say is that you will have the largest number of students are getting enrolled into UG programs, followed by PG programs, and that too in social science, commerce, and these kind of disciplines.
You'll have a whole host of undergraduates and postgraduates in history.
All kinds of social science disciplines.
History, economics, sociology.
Sajid is in PMESC, so he will find a way out how to make the best utilization of this crowd. State Bank of India will have people from all streams, including medicine, engineering, economics, social science, and all that, working at different levels. So this is something, if you look at 50% enrollment, it has increased, but large number in UG, followed by PG, and around 78%, let's say. And then you have the engineering and technology. They have the largest enrollment in PhD programs, followed by science. So if you look at this UG population, so I think we should be thinking about how to make the best use of it. Because if you go back to 2012, one senior professor from IIT Madras, he had written something in Times of India, and his concern, he was sharing his concern, which is that we created all these IITs, but have they led to new products? Or they are only managing shop floor, and they are getting into management, education, and all that. Maybe we need to look at the data, what is happening now, but after that, I think there are startups, a lot of focus on innovation, startups are happening, research parks in IITs. Some of the universities are all following the footsteps. So that is one thing which is happening, which may have addressed his concerns. And also his concern was people going out. But I'm talking about this Ministry of Education survey, where we have a large bunch of people working this. What about employability? That is getting reflected in the India skills report also, around 50% employability. So what to do with the rest 50%? And even the PLFS data annual report 2023-24, that also gives similar numbers. So you can corroborate all these figures, and which is, if you look at PLFS data, secondary and above education, unemployment rate is around 6.5%. It has come down from 8% in 2021, and then it came to 6.5, now it is 6.5. So marginal improvement there. So these three sources of data, if you corroborate, we should be concerned about how to make the best utilization of this crowd. What should you do? How to skill them? Okay. So maybe I'll come back later.
Okay, so two very important points that Professor Acharya is making. One is both the government subsidized engineering education through the IITs, best in class, and the middle class invested all its emotion and intellect in that. So India put its best foot forward, both in terms of public policy and in terms of social interest. And we've not really harvested, a huge number of patents or products from that. We should be concerned about that. That are we gearing our STEM education in the right direction? And the other big question he's raising is that today we have a vast number of, we are proud that they've all got into higher education, but they're likely to be social science students, and there the employability is 50%, as he says. So are we heading towards an unemployability problem? And therefore should we, tweak our education system seriously? Barnali, your thoughts on, you don't have to stick to education, but what kind of policy intervention?
Okay. I want to make 3 key points. The first is education. Education and skilling is the answer to, of course, to better use so that we are in a better position to reap our demographic dividend. But I absolutely hate the idea that education is not skilling. I think somewhere we need to understand that education is skilling. Education is not just about who attacked whom. It's about you learn cognitive skills. You learn how to read, write, problem solve, creative writing at different stages. Right from prep school, even to listen. From prep school to college onwards, it's about mainstreaming. Of course, its mainstream includes vocational education too, but there's research which shows our pre-vocational education also up to class 10 is very theoretical in nature. So the important thing is, please stop thinking about education and skilling as disparate topics. They aren't. Education is about imparting knowledge, but it's also about imparting skills in class. I think that's the first key message I want to say. The second thing is based off more recent research that we have done with the Ministry of Skill Development and Entrepreneurship. When using the example that Lata has been talking about, Bihar and Tamil Nadu, guess where the jobs are? The jobs are in the south and the west. It's easier to move to the west because you know the language. Hindi and Marathi are probably close to each other. Hindi and Gujarati are close to each other. But what when you move to the south? So when you want people to move to the south, because that's where the jobs are, you need to train people in languages. When you do these firm surveys and ask the firms what type of workers do you want, the firms say, oh, we want, typically in the West, it's just about one language. Okay, this is the language we want. In India, it's about 2 languages. So you have to train people in the region, the language, the culture, the food, where they are moving in, and it matters more at the low level than, of course, at the high level. So this skilling has to be detailed in nature, and you have to open up the black box. The third point I want to make is about the over-investment in education. I have a different view. I think we aren't making enough. It's not about the number of schools. It's about what happens in the classroom. Trust me, I have taught for 5 years of the formative years of grad school and then afterwards in a classroom. It matters. I had the best of technology. It didn't work if I am not interested in meeting the needs of my students. Improving educational quality, and that needs 5 things. Examinations, the CBSE is moving to that. Curriculum, books, teachers, and not enough is talked about as pedagogy. How do you teach in class? If I go to a class and I end up speaking in English to a couple of people who do not even know the language, I've lost the plot. So educational quality has to be improved, and we are not doing enough on that. Sorry, stop.
No, fair point. Actually, all great points. I don't think Professor Acharya or I were alluding to overinvestment. I think what he was trying to say is that in spite of our very good investment in engineering, sorry, we did not yield much in terms of products. And in terms of cultural migration, what Nandan Nilikari pointed out, and this was because of a survey, he said there is a rice migration route and a wheat migration route. So normally the kind of migrants you will find in Tamil Nadu would be people from Orissa, Bengal, Jharkhand, who are usually rice eaters, and the people whom you will find in Maharashtra and Gujarat would be people from Bihar and Uttar Pradesh who are wheat eaters. So that kind of cultural dichotomy or dissonance is probably resolved by the pattern of migration. And finally, one point in terms of teaching language skills, Tamil Nadu may have a political problem with Hindi, but I can tell you with relatives over there, the latest, when I recently visited them, they were all talking to their domestic help in Hindi. I've never heard Hindi in the household, in my relatives and friends, but now everyone is reconciled to the migrant labor. None of them were Hindi-speaking people. They were all Oriya and Jharkhand. That is why I'm telling you with confidence that it is that set of East India migrants who come there, and the common language is Hindi. So communication happens, the dissonance is not that severe, because you have to adjust. So both sides learn. But your point is well taken in terms of, we should not give education itself a bad name. Our only hope is that, is it increasing even numeracy skills, which, in several places it is not. My positive point to your education issue is that as the TFR starts declining, a teacher who was teaching 100 children is now going to teach 90 children. And probably the quality will improve because of that, because the pressure is not there. There was a time when if the village teacher went for a wedding, the village school closed down because there was only one teacher. Now we will probably have 2 teachers, and therefore this education is a continuous a process and doesn't get disrupted by these one-off events. So those could be the positives of oversupply of teachers, or at least improvement of the teacher-student ratio. Okay, I'm going to skip Soumya for the moment because I want to ask him the fiscal question. But Dr. Roy, the female labor participation issue, can you dwell more on that? We need policy intervention so that we squeeze out the labor advantage or the demographic advantage.
That's a very important point. In fact, I will look at the numbers. With unpaid work, I think female labor participation is around 37%. Without unpaid work, if you include just paid work, is 25%. So there's a huge potential there. Just to bring the females into the workforce, you can improve the so-called, you can reap the benefits of demographic dividend. That's the basic point. However, I want to add, just supplement another point on education. Everywhere, and I'm sure this is music to Shommo's ear, everywhere outlay and outcome are different. We have learned it. Perhaps the stark contrast of this is reflected in the field of education. We have all seen the Pratham study, which found out that even after 8th grader, the pupils do not know how to basic arithmetic operation, add, subtraction. So therefore, we need to do something to control the outcome. But the language is a great issue. I'm aware of that Japan, when they had to open up their migration to Filipino nurses, the only condition that they added is they need to know Japanese. So therefore, otherwise Filipino nurses are well known all over the world, but they could get a job in Japan. I presume they are highly paid than in Philippines. The basic precondition was they need to know Japanese. So this kind of a skill. I'm told that a taxi driver who knows English in Mumbai gets a higher salary. So these are important things. Soft skill maybe, I mean, but even those kind of things matter. But essentially, female labor force participation, we can do number of policies as simple things like having a creche in the office. Simple thing like extended maternity leave. All those things which can, affect this. And there's a huge informal sector, what you are going to do to the informal sector. But I thought one point we have missed, and that I would request the panel to consider, we are only thinking of how to bring them there. This, by 2050, if one-fifth of the population are 60 plus, you need to do something for them. And therefore, that needs health insurance and pension reforms. I'll leave the panel to...
Oh, no, absolutely. I mean, I was wanting to pass the baton from education to health. And your point is well taken. We don't have geri care at all, geriatric care. We have faltered in, even child care to the extent that, we don't have creches. But at least there the extended family helped. But the extended family is the one that's disappearing, which is why we have the, fertility rate also coming down. So what are we doing for the care of the aged when the number of aged become, as you say, 35% or 40%, a higher percentage of the population? That certainly is a policy intervention which state governments will have to think about, because it will fall squarely on their shoulder first. So that question to you, Soumya. How should state governments tweak their policies? Because whether it's education or health, both are state subjects.
No, that is important. Before I answer that question, 2 points I think we can also, just to mention. I think education, being in the field of education, is also not remunerative. In India, the spending on R&D is one of the lowest if you compare to other countries. So with such a, and in fact, in many of the institutes, our institutes, a large part of faculty is actually not even filled. So that is one issue also we need to address. We make this research and development in India more remunerative over a point of time. So that is the part of underinvestment.
So the reason for that also, I mean, besides the fact that you're not filling or you're not finding enough people who find teaching attractive,
yes,
the more recent problem is that most of the states have gone off into income transfers,
yes, that's exactly.
And therefore there are unpaid salaries in schools and colleges or unfilled positions because the money is not available. So that is a huge problem that state governments have to tackle. I take your point about, a spendthrift Tamil Nadu in that point that, states can't afford this anymore.
No, I think regarding the policies which the states need to make, I think, yes, healthcare and education are, the health and education are state subjects. I think many states are actually doing quite a good number of health policies. There are many states. But in Indian context, the problem is basically is that no amount of spending on health will be sufficient. And because at the end of the day, what is more important is out-of-pocket expenses on health. So even if the state's government has to have enough amount of money to do that, or they have to raise enough resources to do that.
Let me flip this question. Since you are the Finance Commission member, I'm punishing you with this question. What did Kerala get right? I mean, ideally speaking, we should be able to extrapolate that. We've got, 26 laboratories or 30 laboratories. If midday meal has succeeded in Tamil Nadu to pull more children into education, what did Kerala get right that it got at HDI at that level?
No, Kerala actually has been ahead of these HDI of other states. It has invested significantly in primary healthcare centers, and there are several policies which Kerala actually does. I've seen the Panchayat system that is an extremely...
They have the highest number of nurse colleges,
yes,
nurses colleges, I believe.
And they have the best Panchayat system which has been running in the country, which is fully computerized. But at the end of the day, if you look into the numbers also, I don't know how long these policies could be sustainable or so on. I'm not saying these policies are good.
It is being sustained by NRI remittances.
Yes.
Obviously, they don't have industry or agriculture.
So the point is that Kerala, if you know, runs one of the highest number of revenue deficits in the country. Kerala is one of them, West Bengal is one of them, Punjab is one of them. There are many other states.
No, if you run a revenue deficit and have a high HDI, it is forgiven. If you run a high...
But how long it will be sustainable, that's the crucial question. So only time can tell. My sense is that Kerala has done very well on these HDI parameters, but on the other parameters like fiscal parameters, other things you need to take up so that both can run complementarily.
You know,
you have another example of Sri Lanka. Very high HDI, fiscally completely unsustainable.
Yeah, but that is more a recent mistake. I guess the last 10 years, policy bungled badly. And, you know, they were caught napping when COVID happened. We have to very quickly get the growth numbers. What kind of, you know, growth aspiration, ultimately, growth solves. We don't have enough to go around. And we just have to increase the pie. Increase the pace at which the pie is growing. So, Barnali, since you have done work on that, what is the rate at which, what is the historical, say, last 10 years or 20 years, rate of growth of per capita income or rate of growth of GDP, and what does it need to increase to?
So per capita GDP, using the from 1960 onwards, I was looking at the data, it is around 5 to 5.5% depending on what you use. And whereas if we want to reach the per capita income, at least my simulations show that you would at least need 7% growth rate for the next 10 years. So we have to reach more than 7% growth rate to reach the high income targets. So
I think that number is very important. We normally tend to think of an average rate of growth. For instance, 6.5 or 7. We are normally thinking of the average annual growth. But if you look at the CAGR and if you look at per capita, what we discover is that we are actually in the 5 handle. And therefore, the pace of growth has to be much faster. So ideas over there, Sajid. You know, we discussed enough about social wealth.
I think the macro work is clearly cut out. So if you look at the last 15 years, per capita income is about 5.9% growth. Now let's take a minimalistic target that by 2047 we want to at least get to upper middle income, which is $15,000 per capita. The math would suggest you need to grow at about 7.7% per capita income. So per capita incomes have to go up by 2 percentage points more than our historical averages. And this is assuming, you know, the rate of inflation is offset by currency depreciation, so let's stick to real terms. Now, the challenge is going to be, as I said, this comes back to the first question. If you want to go at 7.7 between 2025 and 2047, your demographic humps the first 12 years. So if you want an average of 7.7, you need to be, you know, think of this as the power play.
You should do 8 and...
Think of this as the power play in a one-day match, right? Niranjan's here, we love cricket. If your asking rate is 6 for 50 overs, you want to start by growing at 8 in the first 10 overs when the field is in, right? So the next 12 years, you have to be averaging above 7.7% per capita income, 12, 15 years, so that you can afford some softening when working age population goes from 1.1 to half and still get your average right. That is the challenge above us. Now, if you translate that to real GDP growth, given what the population growth is supposed to be, you're looking at a minimum, so this is an 8.5% real average for 25 years. If you want to outperform in the first 15, so you have to be upwards of 8.5. That's the, and you know where this ultimately comes back to, these levels of growth alongside some of the reforms mentioned will create the demand for jobs that then satisfies the supply side and the demographic transition. I'll just make one final personal plug. My mother's been a primary school teacher for 50 years. She's run a school. And just to reinforce what ma'am said, you know, she says 80% of a child's intelligence is shaped between the ages of 2.5 and 6. So you can't emphasize the importance of that kind of human capital accumulation to create a generation of workers 20, 30 years down who will be ready for the jobs of the future.
No, I think that's so admirably summarized. I'm not going to, repeat that effort. That's the kind of pace of growth and the policy interventions which the other panelists have already spoken to.
I just want to add one point. I think to Sajid's point, I think while it is equally important that we need to grow at in excess of 7% to have a developed economy tech, but the positive we can take out of it is at the end of the day, we can't have all the 28 states in the developed. So we'll have some states which are already doing quite good. I mean, we have a per capita income and current prices today at 2.3 lakh crores. There are states like Haryana, others were at 3.3 trillion and others. Maharashtra is also another some example. So we'll have some states. So it is important that how many states we take along in our path to Vikshit Bharat as the government wants to achieve. So it may not be 28, but even if it is more than 50%, I think we would have done a great job.
I was very sure it's a Finance Commission point of view. Well, we still have about 5 minutes for, or even more, 6 minutes for questions. Yes, sir, please.
So at a time when there is always some concern on income disparity, is mean income, which is what GDP and per capita always measures, a good measure? Or are there better measures? Is there a way to measure median income? Are there countries which have done something different? Just want to understand.
I think everyone's capable of answering that, but Sajid, I'll give that to you. Okay. Yeah, Dr. Acharya.
I would like to answer in a very different way, like probably it relates to what Dr. Parthare said in the beginning. If you see income disparities in terms of real GSDP of the states, it should also reflect in consumption inequality, let's say. So that's what I think Dr. Ray was referring to. So if you look at the monthly per capita expenditure, which is calculated from the National Sample Survey Office data. So in one of our works, we found that when you looked at all the 5 rounds of data, and we didn't look at conditional convergence and all that, we were looking at club convergence, taking a group how the states are doing. So what we found is states like AP, Gujarat, Tamil Nadu, they're in one group. So there is some convergence as a group. Maybe they are of same living standards and all that. But overall, there was divergence. But interestingly, in September 2025 RBI Bulletin, there was an article, and I came to know because they had reviewed this paper. So what they have found something, some positive news, that they are finding that there is an overall evidence of convergence now, because they have used the latest 2022-23 data. So I think what Soumya said and Dr. Ray said, the interstate, the way these parts grow to give us the whole sum of growth rate for the country is quite important.
No, actually, it's a great question. I was wanting to ask Soumya if you all do such intra-state data also in the Finance Commission. Is it that some states have grown more equally? Because Maharashtra clearly is skewed. It's like Bombay and the hinterland. Or Konkan is way more prosperous than the plateau.
No, so this is not a problem with Maharashtra, and this has been also been very, interesting. This is also an issue raised by many states. Maharashtra is not an example. Karnataka
is a bigger example. Yeah.
Haryana is an example. You take out Gurugram, your per capita income collapses to nothing. You take out Bangalore from Karnataka. So basically, one of the points which every state wants is that whether it is possible to make a comparison in terms of the district level parameters. Okay. But unfortunately, that data is still not available. That is a process which the CSO has already started to do. If that data is available, you can actually have a complete picture of the interstate disparity. And if you take out, for example, Mumbai, Mumbai out of Maharashtra, its per capita income will decline significantly. So that's the case with many other states in India, and it's not the, that is one important thing.
So you actually touched a raw nerve. It was absolutely correct that, the MOSPI also is trying to goad states to look at district domestic product. The state gross domestic product is calculated by the MOSPI, but they want the state governments to calculate district-wise product. It won't be easy, obviously, because there are too many interlinkages, but even if an effort is made, probably
UP has done it, I think. UP has done it.
Okay, I think we can manage one more question by transgressing the limit given to us. Yes, sir.
Niranjan.
Actually, the person speaking, Niranjan Rajadhyaksha, should have been on this side of the stage, but he has chosen to participate from there.
So I have a question about interest rates. The usual assumption is that in an aging world, the equilibrium interest rate comes down, right? But this is normally in the case of advanced countries. Now, since Soumya has used both the aging and the growth thing together, in India, will we see declining real interest rates as the world ages? Or because of the need to maintain investment rates at high levels, will we actually, over the next 25 years in an aging India, see equilibrium interest rates rise?
Oh, That's a great question. And Niranjan, you too will have to answer that question after the panel takes a jab. Soumya? No, you can both answer. First, go ahead, Soumya.
Well, no, it's not a trivial question, right? Because ultimately you think of equilibrium real interest rates as being where the supply curve is and where the demand curve is. And one of the, as you get older, at that point in time, you should be saving, right? So savings rate should fall, and then the demographic
I thought
transition.
interest could go up.
Well, but it depends what happens to demand, right? Because, if potential growth at some point is coming down, it depends on how much capital deepening. If you can generate more capital deepening, right, in a world in which your supply of savings is coming down, then equilibrium interest rate should be higher. But of course, in an emerging market, which is an open economy, right, the investment savings gap is also met by the current account deficit, right? So this is actually, trust Niranjan to ask a complicated, important question. There are just too many moving parts here. That the supply of savings should fall as we age. If we want higher rates of growth, investment should stay high. For example, one can even argue with this whole AI boom right now, you're going to get so much capacity in the next 4 or 5 years as this technological progress. Will that push R star up? The only complicating factor for emerging markets is when you get the investment savings gap, there are two variables that can fill it. One is your domestic R star, the second is your current account deficit. So in a world, will emerging markets be allowed to run larger current account deficits, which takes the pressure off domestic R star?
And the whole current account deficit itself has become a creature to geopolitics. So
exactly.
At the moment, it's a difficult one to answer. But yeah, Mr. Sethi, you had a question, sir?
I had an observation. Of course, after seeing Anand, I stopped asking that question. But I still would take the risk. See, one question what we must also remember is not only we growing older and not getting richer, there is, in some state, what Soumya has mentioned, the people are rich, the states are poor because of the policies. I think with their ability to invest in urban and social infrastructure is getting impaired. And whatever we speak in terms of investing in education, health, is not going to come only from the private sector. Private sector has hardly invested in urban infrastructure, which means that the heavy lifting has to be done by the states. And if they don't actually have a fiscal prudence, we will have some of the people getting richer and the states getting poorer. And as a whole, I think is getting impacted.
Actually, the definition of developed and not so developed precisely is that in emerging economies, people tend to get richer, not the governments, simply because that evolution, political evolution, has not happened, or political development has not happened. Yeah.
Just 10 seconds, I think Sir makes a really important point, because I think for our developmental needs, I think we need a lot of expenditure allocations on health, on education, on the green transition that Anant has spoken about. So the question is, if you add this up, additively, could be potentially 3-4% of GDP. We know in this world, if you want to stabilize public debt and bring it down, fiscal deficits have to be at these levels or go down further even. The only way to square that circle is to raise receipts to GDP, tax to GDP.
Absolutely.
Now, we've made huge progress. Last year, combined tax to GDP was 17, almost 18% of GDP. The last time we hit that was 2007. So we have to go down that path where you increase tax to GDP so you can increase expenditure obligations while keeping deficits low. One other point I'll make, I've been saying this like a broken record for a decade, asset sales and disinvestment. That if we do more asset recycling, that's a way of reducing deficits without imparting a contractionary impulse. So I think there has to be a focus on that.
Okay. I was just going to say that you will be the most hated man over here if you're going to say raise taxes, but you have alleviated it.
I just want to mention Sajid's point of tax to GDP. There is another fundamental, but we can actually spend a couple of days on that discussion. 12% is the center tax to GDP, 7% stays to GDP. Municipal bodies, local bodies tax ratio is 0.4% to GDP. And of these rural local bodies, 0.0012% of GDP. So if this is the number when there is no discovery of any pricing in rural and urban areas, I don't see, and that's another aspect.
No,
I don't
that's
see
a whole new problem
that will actually open up another Pandora's box.
I think local self-government and devolution to that point is a whole new topic. But just one very quick, Niranjan, what's your guess? As the population ages, will interest rates go up or down? Since you posed that question.
Lata, I have the easy option of just asking the questions, so I'll skip that.
I thought that was my option. Anyways, thank you very much, Niranjan, and thank you very much, Sajid, Dr. Acharya, Banali, Shaumyo, and Parthore. We've thrown up a lot of suggestions and issues, but all of them are very difficult ones to answer. We just hope that we do get richer before we get older.
Thank you so much. May I please request the panel to stay for a group photograph. I would also request Chairman SBI to come on stage and felicitate the panel with mementos. Thank you so much to all the panelists and Ms. Lata Venkatesh for that great enlightening panel. Now, moving on to a special address. We now move on to our final keynote of the conclave, which comes with the benefit of first-hand curating policies and drafting a vision that ensures the country remains on the path of transition and transformation, scripting a good to great odyssey. And may I now request all of you to give a huge round of applause for the speaker, Dr. V. Anantha Nageshwaran, the Chief Economic Advisor, Government of India.
Good afternoon. Respected Chairperson of the State Bank of India, Dr. Soumyakanti Ghosh, senior executives, my friends, ladies and gentlemen. We start about 6 minutes early, but be rest assured I'm not going to use that extra time. So I think I like the title of the theme of this two-day conclave. India's quest for self-reliance in a fragmented world, and I think that's a right pursuit that we need to have. In fact, my presentation will tell you that we need to be more ambitious, we need to move further or graduate further from self-reliance to even strategic indispensability. So strategic invulnerability is equivalent to self-reliance, but without being strategically indispensable, you cannot be strategically invulnerable. So as the world goes through a churn, upheaval, or a resetting of the last 80 years of established order, it throws up, as normally it does, both chaos and opportunities. And we need to be a lot more nimble-footed and also be able to depart from our established ways and means of decision-making, both in the private and in the public sector, and the considerations that we normally apply in making those decisions. All those things have to be up for discussion, review, and even jettisoning overboard. So let me just share with you the state of the world as we see. Notwithstanding the fact that the IMF upgraded the growth numbers for the coming year in October as compared to what they told us in April 2025, on a trend basis, we are seeing lower global growth and lower trade growth. And trade restrictions and the emergence of blocs will also eventually affect investment flows. It's a matter of time. And climate change and energy transition are actually in a state of transition. If you go by the remarks made by Mr. Starmer in COP30 yesterday, I think several countries are now beginning to recognize the very trade-offs that we have been flagging in the last 2 or 3 economic surveys. Technology and jobs, which was the theme, and Lata was there in the morning curating a session that I was part of. That's an issue that is still very much open for discussion, and it is still very early days. What you see on the right side is a chart that shows you that trade restrictions are not just a recent Trump 2 phenomena, but they continued well after Trump 1 presidency ended. In fact, they even intensified a lot further between 2020 and 24. And I must also add, this is global, the number of trade restrictions that the world imposes on each other, countries impose on each other. And I must tell you that the European Union has 80% of its trade actions directed at one country, and I don't need to name it. And I think that is the state of affairs with respect to global trade. And it is in this environment that we have to strive to become strategically indispensable, at least in a few areas. It's not an easy challenge. Uncertainty is, it's obvious, it's at unprecedented historical highs. And what it does is to make humans opt for status quo. Risk aversion is a natural fallout of uncertainty being elevated. And it will show up in global investment flows, trade flows, and also capital flows. And what you see on the right side is what I mentioned earlier in the first slide, that on average, trend growth rates will be lower than what we were used to. For example, in the first decade of the millennium, when global growth averaged 4 to 5%. So now it's the other way around. Advanced economies are looking at a growth rate of 1.6% next year, and EMDE is looking at about 4%. And so by and large, I think we need to be prepared for a low growth world, and that makes the challenge of distribution and equity even more complex than they already are. Now, this slide, which I picked up about 5 years ago from the internet, and I don't know this gentleman, I didn't know him then, I don't know him now. But what is interesting is when he put this slide out in 2020 February, it was early days after COVID had broken out on a global basis. And what you see are the 5 pink boxes at the bottom and in the middle. Populism, trade wars, financial repression, military conflicts, negative real yields are the consequences of the process that had opened up post-2008 financial crisis. And he was very prescient with respect to almost all of them. And negative real yields in developed countries is a matter of time. They are coming. And that goes hand in hand with financial repression. But trade wars, military conflicts, and populism are very much already on display. But the important point that he's trying to point out here is that the origin doesn't lie in personalities and the policies they followed, whether it is from 2016 or 2024, etc. And it will be wrong to therefore give disproportionate blame or credit or ascribing to individuals here. But the process actually started when we responded to the crisis thrown up by excessive debt, by lowering interest rates to zero and printing money, which basically encouraged further debt accumulation. And the result of that is what you see in the middle portion of this slide, which is monopolistic behavior, higher inequality, and more financial fragility, asset bubbles, etc. But given that we are still not exorcised the ghost of 2008 and more financial stimulus, in fact, in the last few years, notwithstanding the fact that the Federal Reserve raised interest rates, financial conditions in the United States never really tightened. And that is why we see one more bubble now, whether it is in private credit or AI-related investments, etc. And that is why this is sort of an infinite doom loop. And the consequences are what you see in the bottom. And given that we haven't broken away from the habit that we started practicing way back from maybe the new millennium or even before that, of basically meeting every single structural problem with cyclical solutions like monetary easing, we are going to continue to face these structural cleavages or fault lines in the world. So the next 10 to 20 years, we should continue to see intensification of the forces or the consequences that are mentioned in the 5 pink boxes that you see at the bottom on a global basis. Now, this is the global context within which we are trying to become Viksit Bharat by 2047 or achieving self-reliance. Now, if you look at the record of 20th century, which countries became, or rather, which countries moved from third world to first world? At the beginning of the century, of course, the most promising country in the world was Argentina in 20th century. But the record turned out to be very different. And East Asian countries, whether it is Hong Kong or whether it is Japan, followed by Singapore, Hong Kong, Taiwan, Korea, and to a limited extent, given its size, China later, were the ones that made the transition. Of course, you may include countries like Chile and some countries in Eastern Europe, etc. But they were already had a very good start in terms of their per capita incomes. But really, from third world to first world, as Mr. Lee Kuan Yew put it in his autobiography, it was East Asia that did the transition. But East Asia did the transition in a very different geopolitical context. The United States helped several of them to rise because they saw them as a bulwark against the spread of communism. And I don't think that is necessarily the case today. And there was no energy transition constraint. Countries didn't have to choose between energy security, energy intensity, and energy transition. Demographics were different in several countries. Now it is changing for the worse. India probably has a good demographic window for about 10 to 15 years. And industrial policy in Northeast Asia, as many of you know, which well captured by Joe Studwell in his book, How Asia Works. Industrial policy in Northeast Asia focused on productivity and export performance in return for state protection. And state protection was not in perpetuity. These were the important features of why Northeast Asia was able to transition from third world to first world as compared to Southeast Asian nations. And then, of course, investment in primary education and the importance given to vocational skills, which will be very relevant in the world that is going to be dominated by AI if all the promises are going to be true with respect to AI. And these were some of the ingredients of why East Asia was able to transition to the first world. Now, all these conditions, at least the top 3 or 4, may be global in nature, but we have to make sure that we get some of the domestic policies correct with respect to the bottom 2 bullet points, and also with respect to industrial policy, where we have to make sure that whatever protection, subsidies, concessions, reliefs, trade insulation that we are able to give to domestic industry has to be in return for their contribution to national goals in terms of export performance, productivity, and so on. So in that sense, we do have a challenge on our hands because we are trying to make this progress from where we are, lower middle income to upper income, in a very different and even hostile global setting than East Asia was able to do. So what is first let me get the good news. Obviously, one of the things that used to be a problem for us was overheating. Whether you look at the 80s, 90s, or even in the 2000s, after a few years of growth, our economy used to get into the problem of high inflation, high current account deficit, overvalued exchange rate, credit boom giving way to non-performing assets, etc. And I hope we have put that behind us. At least one reason why I'm somewhat hopeful that we have put it behind us is the fact that we have invested a lot on the supply side of the infrastructure, because that also imposed its own ceiling on sustainable growth. When aggregate demand grows faster, if supply was unable to meet it, it naturally resulted in higher inflation. And just one statistic, because we have covered all of this in the economic survey comprehensively, one statistic from this slide I want to draw your attention to is the fact that in the first 7 decades since independence, we built about 74 airports, and in the next 11 years, we more than doubled it to 159, not to mention many other parameters that I have mentioned here, and it is no need for me to repeat them all. They are in front of you. But I think the investments we have made in elevating the supply capability of the economy is standing us in good stead with respect to bringing down the average inflation rate in the economy, what it used to be in terms of 7% in the first 6 to 7 decades since independence, down to now 3 and 4% and converging with the developed world. Notwithstanding the cyclical vagaries of food prices, but I think on a trend basis, I think inflation is converging with developed world levels. And then with respect to the small and medium enterprises, which we all know are indispensable to the rise of manufacturing, and today's developed countries like Korea, Japan, Switzerland, Germany, or even UK and the US in their heydays when manufacturing was still very dominant in those countries, they did not make it to being industrialized without having nurtured and allowed their small and medium enterprises to grow. And one of the big constraints was access to finance and working capital. Now, financial institutions have done a lot of commendable work in the last 11 years, particularly State Bank, in improving access to finance for SMEs. But more importantly, innovations such as the receivables exchanges have also played their part, and that is where I think the corporate sector can still do a lot more. And the policy has given a nudge in the right direction by stipulating that a payment that is due to a small and medium enterprise is not allowed as a tax deduction except in the year when the payment is actually made. And that's an important nudge. But more than that, what you see in terms of structural innovation is to allow receivables exchanges to play their part when financial institutions or factors purchase the bills from the MSMEs and collect it from the corporate buyers on the due date, and if they don't pay up, it becomes an NPA. And that kind of discounting of bills, which is hardly 950 crores, in FY25, they reached a level of 2.33 lakh crores. And I think there is much more that can be done to improve the access to finance if large corporate and government buyers end up using the receivables exchanges platforms to accept their invoices and discount them on the platform. This year, this is a more recent government effort, but memories these days in the short-term memory cycles that we all have are very short. But 8 months ago, we had the direct tax reductions in the budget. That was significant because two-member income-earning family doesn't have to pay a single paise of tax this year for this year's income, as long as the income is below 26.75 lakh rupees. And that's a huge difference compared to the year before, and we tend to forget it. So there was a very significant boost given to disposable income in the budget in February 25. And now in September, we have come up with this GST simplification, rationalization, and rate reduction. Now, many of you think about this too as government focusing on demand side of the economy, but both demand and supply sides are two sides of the same coin. A demand boost is what gives visibility to the corporate sector to boost its supply side investment, to boost the capital formation. And that is why I think despite the global uncertainties, early indications are suggesting that private sector capital formation is holding up well in 25-26 on top of an estimated good capital formation growth in 24-25 as well. So this is the good story, but as I said, as the theme of the conference also is making it clear, it is a fragmented world, and it is the one that is going to become even more challenging as to the Alberto Gallo side, which is what I pointed out earlier. And therefore, in that milieu, what are our challenges? I think in general, and I'm not sure that I'm capturing all the challenges of a country of 1.45 billion people, but what I see, and it is a subjective list, as important challenges for us in the next 25, 30 years, or maybe even longer: energy affordability, energy security, and energy transition. This is an important trade-off between them. Employment generation and artificial intelligence, we will spend some time on it. The share of income, a corollary of point number 2 is, if AI were to deliver the productivity gains, who benefits from it and how it is distributed? Both are ifs. First, AI has to deliver the productivity gains, which is still a work in progress at best. And if it does so, between capital and labor owners, who benefits? And all of us tend to focus on education and skilling in terms of reaping the rewards of demographic bulge sweet spot that we find ourselves in. But less talked about, but more important perhaps, are the mental, emotional, and physical health of our youth cohort. And if we want our manufacturing share to rise, and we have to, and it is not just about rebalancing the economy between services, manufacturing, and agriculture, but it is also about the goal of strategic indispensability that I mentioned earlier, that you cannot avoid having to improve manufacturing. And for that, we have to make sure that there is a good, viable middle stand in the Indian economy. And deregulation has a very big role to play in that, apart from many other things like access to finance, technology, and an ecosystem of innovation. And agricultural productivity, it is obviously India is now self-sufficient in food. So it's not about India alone. But if you look at demographic projections, in the next 25 years, the population in Africa, in the African continent, is going to double. And it will become more than 25 to 30% of the global population compared to what it is today. And therefore, from a strategic perspective, investing in agricultural productivity and being able to export agricultural produce is going to be a useful strategic focus and objective for India, given the population trends that may be happening elsewhere in the world. And of course, if we get all these things right, then naturally we will be building strategic resilience and strategic indispensability in the world. And you can see that how strategic indispensability gave countries a lot of leverage over the tariff negotiations they have had with the United States in the last 10 months or so. Now, first of these list is the energy security versus energy transition trade-off. I may have mentioned this even last year when I spoke at the NCPA and the SBI Conclave. Those of you who were not present then, I would still recommend that you read The Material World by Ed Conway. And this particular Substack post from him on December 11, 2023 tells you what the energy per capita consumption gap between developing countries and the developed world today on the left side. On the right side, what you see, after net zero, by 2050, this gap barely closes. So in other words, by imposing net zero and emission-related constraints or obligations on the developing world, the developed world may end up keeping the energy gap between themselves and the developing world permanently high. This is equivalent to saying that the economic gap between the developed and the developing world will also remain wide. So because there is no country that is economically rich today which is energy poor. in terms of consumption. Both go hand in hand. And if some of you do not remember the importance and significance of the date April 28th, I won't blame you. But I'll give you a few seconds to think about what April 28, 2025 means. It was the date of 9-hour energy blackout in Spain and parts of France and Portugal. That was not only because of the intermittency of solar and wind, but also because of their tendency to surge and then become a famine within a few seconds or a few minutes. And in India, we have other considerations because we collect a lot of taxes in selling petrol and diesel. And if we continue to increase the share of renewable energy, we have to precede that. We have to do, before that, increase the investment in upgrading our grids, which also requires more resources. And then there is dependence on outside nations for strategic minerals and rare earths that go into renewable energy generation. And then our railways derives 50% of its revenue from transporting coal from mines from pit heads to power generation plants. All these factors have to be taken into consideration when we pursue net zero and emission reduction as our overarching goals, because they do have a trade-off vis-a-vis energy security and energy affordability as well. We can't wish away the trade-off. More recently, there was a report that came out that in Germany, one of the contributing factors, apart from competition from a super competitive China, one of the factors that is contributing to deindustrialization is the rising energy cost, as is the case in Britain as well. And it is a function of the increasing share of renewable energy in their power generation mix. That is why in India, we have to adopt a menu of options and not just only solar and wind. That is why it's important that we are, as promised in the budget, that we open up nuclear energy to the private sector and amend the Civil Nuclear Liability Act, as was mentioned in the budget. And we invest in hydro energy and also in new technologies on carbon capture and storage, and also in battery storage, and also adapt energy demand management measures. Like, for example, investment in public transportation has to pay back in terms of increased usage. And for that, there needs to be a last mile connectivity between public transportation and where the users live. Without that, India cannot afford to have the per capita vehicle ownership or vehicles on the road as developed countries have, simply because our numbers are too vast. So there has to be both a sense of urgency and understanding of this issue, because India has to approach energy transition both from a demand and supply perspective with respect to energy. And these are not my words, but these are words of Mr. Ed Conway explaining the previous slide, that the net zero focus of the developed countries risks consigning the developing world to a permanent low energy or therefore low development trap. And quite fortuitously, last week, Mr. Bill Gates, in his website, wrote a piece as a prelude to Belém COP30 summit, recognizing these trade-offs, which I spoke about in the last couple of minutes. And what he said is, and I won't read out the entire left side of this chart here, he simply says, sometimes the world acts as if any effort to fight climate change is as worthwhile as any other cause. As a result, less effective projects are diverting money and attention from efforts that will have more impact on the human condition, such as healthcare and agriculture, for example. In other words, it goes back to the fundamental lesson of Economics 101. Economics is all about trade-offs, and so is public policy. You cannot pursue corner solutions on energy transition without taking into consideration what it does to our per capita income and potential GDP growth as well. And on the right side, what you see is a report that I spoke about, which came out last week on the causes that are driving the deindustrialization today in Germany, and one of them is higher energy costs, which is in turn partly a consequence of the increased focus on adding more and more renewable energy, which requires more and more collateral investments as well. Now, the Other big issue, which is in everyone's mind, on top of their mind these days, is artificial intelligence, its deployment, and what it means to the labor market. These are still early days. And that is why anecdotal stories, both positive and negative, dominate, because aggregate numbers are still scarce. And anecdotes have a very powerful dominance over statistics in people's minds, but they are not the most appropriate way to gauge their impact, which is still, therefore, evolving. One thing is, AI can have productivity gains, for sure. AI can be very useful in taking education and healthcare to remotest corners of the country. It can even change the manner in which Indian pedagogy has evolved over the last 70 years in terms of rote learning. All these things are possible, but at the same time, it can also have implications for existing jobs. There is no doubt that it may create new jobs, but the question is, we have to get down to the next level. How many will be created? How many will be lost? What is the net number? And how many of those who are losing their jobs will be able to find alternative in this new AI-dominated world? What will be the incomes that they will be losing, and what kind of jobs will be created, whether they are high quality, high educational attainment, high income jobs, in which case the income inequality may widen? And over what time frame will the positive developments emerge compared to the adverse developments which may happen relatively sooner in terms of job displacement? So even if many of these positive developments happen, which they well might, they will take their own time to basically manifest themselves, and in the process, therefore, there is a lagged effect which are much more difficult to handle in democracies which are also fiscally constrained. So these are all the complexities of AI deployment. That is why how we handle the AI deployment is not just a matter of public policy, but also private responsibility. And if you look at this paper by a young AI researcher, Jason Hausenloy, in March 2025, it's a 10-page paper, I recommend you to read it. He talks about jobs that are have low vulnerability to AI. And he classifies those which are highly vulnerable, and it's a very useful framework or template to analyze. And that is what brings you back, or brings me back, to the emphasis on vocational skills and primary education and technical education as well. Jobs that will not be affected by AI, where the human content is necessary, are the ones that we need to focus on as well, apart from preparing our youth to be able to participate in the world of AI dominance. So in other words, manual skills, carpenting, painting, plumbing, electrical, geoengineering, all these things will have to be made fashionable, and not just wearing a trouser and shirt in a glass and steel building, writing codes. That is not going to be the industry or the job of the future. And therefore, much work remains to be done, and it's going to be hard to change people's minds. It's very important to make vocational skills and vocational jobs fashionable. So that will require a lot of effort in terms of policy, and also in terms of private sector. Champions have to push the country in a direction where they are insulated from AI-related developments. And if it so turns out that the AI-related developments deliver net positive benefits, then we will still have diversified the economy and contributed to our overarching goal of boosting manufacturing as well, if we invest in technical and vocational education. The skill report of the CII VBox, when it was first launched in 2014 for college graduates or those who have one more year to go, only 1/3 of the people who took the test passed the test. 2/3 were not found employable on the basis of this test. 11 years later, and we have put this chart in the economic survey before, 11 years later, the percentage has gone up by about 18 percentage points. Now it is basically a little over 1 in 2 passed the test. That also means just under 1 in 2 are still not employable. So the skill development aspect still remains a work in progress. And once again, India's numbers make this challenge an important and an urgent one. There are multiple initiatives, particularly in the last 2 budgets, whether it is internship program or the importance given to polytechnic or ITIs and vocational skills. the centers of AI excellence. So there is no dearth of efforts, but as always, it requires two sides to clap, two hands to clap. But the private sector and academia also have to basically come together in being able to incentivize and facilitate both behaviorally and monetarily skilling upgrades on the part of the youth cohort as well. Now, the third dimension with respect to manufacturing and the growth of small and medium enterprises. The empirical evidence is very compelling. The more we move towards economic freedom, the greater is the GDP per capita. There is a very strong positive correlation across nations. And that is the direction in which we are setting out to go, especially so this year, with multiple initiatives on the part of the government. Whether it is the high-level committee headed by the former cabinet secretary, Mr. Rajiv Gauba, the two informal groups of ministers looking at non-financial sector-related deregulation, or the task force under the cabinet secretary which looks at state government deregulation efforts. They are very important because ultimately we have to remove the important pain points that Indian entrepreneurs have expressed in a World Bank survey. Senior management times spent dealing with regulation, or firms identifying tax administration, firms expected to give gifts to get operating license. These are all public information from World Bank surveys. Especially these numbers would be much higher in the case of small and medium enterprises, because given that they have limited human resources, the amount of time they spend, the management bandwidth that goes towards compliance, inspection, and licensing is better spent on marketing and production processes. And that is why deregulation matters in removing the fear of growth and enabling growth in small, micro, and medium enterprises. Not so much for large enterprises, because without them, there is no innovation cluster that will happen, and there is no global supply chain that will happen, because they are the ones that feed components and technology and innovation towards large enterprises. So deregulation is critical for the rise of manufacturing and the rise of SME's role in manufacturing. I spoke about state-level deregulation. These are newspaper headlines over the last 8 to 9 months, and there is much more, and we will be covering this in the economic survey. This is a good news story. The various states have addressed many of the regulatory compliances and compulsions and prohibitions that were imposed on enterprises. And we are just giving you a sample of them in this slide. And it is an exercise that is continuing as well. So having done the first phase, we will be looking at moving to the second phase of deregulation as well. And it is I'm very gratified to share with you that there is a lot of appetite in states to continue with the deregulation efforts as well. And more recently, apart from the headlines that I shared with you in the previous slide, Andhra Pradesh has come up with the most important area, which is a very difficult area from political economy perspective, which is about ease of land use conversion. They have almost made it automatic. And Uttar Pradesh amending the building bylaws is also an equally comprehensive effort, and several states have eased their mining regulations, which collectively add up to something very significant as well. So there is a lot of positive momentum on deregulation, which unfortunately you may not be able to measure on a one-to-one basis in terms of impact on growth, because growth is eventually subject to multiple other developments outside our control as well. That is why counterfactual is so hard in economics. But over time, these will definitely boost the potential growth and the actual growth performance of the Indian economy. Now, going back, this is the area where I think we need to spend some more time in terms of an effort, not today in this discussion, but I'm saying in general, because ultimately, in the way the world is going to evolve with greater military conflicts, trade conflicts, financial repression, populism, etc., each country has to be not only taking care of its needs, but also in being able to do so, you need to have certain leverage as well. I'm just sharing one example, which is that is why we need to move away from just focusing on import substitution, whether it is done intelligently or not. And it should mean investment in national strength. This evolves in 3 stages. import substitution, build domestic capacity, but that phase we tried between 1950 and 1980, it did not result in efficiency gains or productivity gains. It only basically led to pampering. But therefore, we have to now focus on strategic resilience, withstand external shocks through redundancy and diversification. And the next step is strategic indispensability, make India globally replaceable in key value chains, which we are not at the moment. In other words, the focus should shift from can we make it at home to can we keep functioning if the world breaks down, and in the next step, can the world function without us? We have to be basically moving from the first question to the second and second question to the third. Without that, this building national resilience in a fragmented world will remain conference theme, but not progress beyond that. And this is one example. And I think we are taking action in this area, whether in terms of the various processes in semiconductor chip production. India doesn't figure anywhere in this list. That is why the semiconductor mission is critically important. We have to get our foot inside the door to be able to sit at the table in the first place. And the semiconductor mission is about getting our foot inside the room. Same thing applies to the AI mission or what we are doing with the superfast train between Mumbai and Ahmedabad. In all these areas, it will create a technological ecosystem which will then create benefits in allied areas as well and build up the pool of technological manpower and also knowledge base as well. So in other words, we have to emulate that from a few areas to several areas, whether it is in pharmaceutical or agriculture or industry or even in services. We have to be part of the evolving global technologically sophisticated ecosystem. And that is why we have the advantage of 28 states. Some who are already middle income capable can do these high-tech areas and innovation. Some who are still lower down in the economic development ladder can concentrate on labor-intensive manufacturing before they move up the value chain. So we have the geographical spread to be able to span labor-intensive manufacturing to high-tech manufacturing. And that is where I think the real constraint is not policy or not resources, but also the mindset. This extract, and these are all not my words, from a particular Substack post of 24th June was written in the context of the United States, but you simply have to replace the word America with India, and these messages still will resonate very, very well. In a democracy, there is a natural tendency towards short-term goals and short-term gratification. And that is why, and even in a country which has an evolved capital markets as we have, with quarterly earnings reports and so on, there is a natural tendency to be able to cater to the market's demands, which in today's world is probably going to be somewhat counterproductive because you require long-term goals that transcend quarterly earnings per share measurement. And that is why those societies which we thought had erred in not putting their capital markets development ahead of national imperatives now seem to be having their upper hand vis-a-vis us. So we may have, therefore, developed ourselves financially far better or far ahead of time than we needed to. And in a world that is going to be increasingly fractious and fragmented, where strategic resilience is an imperative, where globalization is not going to come to our aid, and small components can be useful tools of strategic leverage, we have to ask ourselves whether the compulsions of markets and democracy will really enable us to transcend those barriers and be able to achieve goals of national interest. And this is a question that is not just relevant for the public sector, but also for private sector, banking, non-banking, and non-financial as well. Concluding thoughts. As I said, we are a country that have defied odds. I mean, I was with my team in Cochin shipyard last weekend, and I'm going to share some slides there with you. There is a lot that is happening beneath the headlines in a positive way. whether it is the amount of efforts we have taken in the last 1 year on critical minerals capability building, on semiconductor mission, on manufacturing, etc., we are getting a lot of things right as well. But again, given our size and given the demographic bulge we have, we need to do a lot more. But the good news is this is a problem that is faced by many others, and at least we are having the growth rate that will give us the resources to be able to sustain these initiatives. And for this financial year, many players are revising their growth rates upward, which looked unthinkable 2 months ago, and that's a good sign. And over the next several years, the IMF's World Economic Outlook projects Indian GDP to grow towards 6.6 trillion and an exchange rate that will be steady and stable rather than continuously depreciating. These are very good projections. These symbolize a certain sense of confidence about India's trajectory, and it is up to us to deliver on them. This is what I refer to in terms of what I saw in Cochin shipyard. They have built a new dry dock, and the amount of technological sophistication that has gone into it is something that should make all of us proud and happy and optimistic about the future. The amount of steel used, 70,000 metric tons, is 10 times the quantity of steel used in Eiffel Tower. You could build 10 Eiffel Tower with the amount of steel used. 7.2 lakh tons of concrete, which is 1.25 times used in the Bandra-Worli Sea Link, can hold 242 million liters of water, equivalent to 100 numbers of Olympic-sized swimming pools. 5,000 number of RCC piles, 26 times the number of piles installed in Burj Khalifa in Dubai. 5.5 lakh cubic meters of excavated material disposed to sea, equivalent to relaying 300 numbers of football fields. Electrical cables running to 80 kilometers and service pipelines runs to 20 kilometers. And the water will be treated before it is led back into the sea, because once a ship is built, it has to be floated into the water and the dry dock becomes flooded with water. And then once the ship sails out for testing, then the water has to be led back into the sea, and that is fully, efficiently, chemically treated before it is let back into the sea. So a lot of these wonderful developments are happening as well. We just have to make them from anecdotes into national statistics. Thank you very much.
Thank you so much, Mr. Nageshwaran, for that. Now I please invite on stage Sri Rana Ashutosh Kumar Singh, MD, RC and SARG at State Bank of India for a Q&A session with the CEA.
First of all, thank you very much. Gratitude, sir. You could join us in person this time. So, and thank you so much, sir. And very engaging and very comprehensive presentation. We still have 8 minutes left, so we can squeeze some questions, sir. A couple of questions I have, though I have a list of questions pre-printed kind of, but I'm not going to use that. The presentation itself is so comprehensive, there is no time for that also. Maybe a couple of questions from the audience. But first, my questions, sir. So in your presentation, we saw a lot of important points there on the employability, that is one. The education and a skill. And interestingly, the previous panel, which was Economist Panel, there was a lot of discussion happening on those themes. Education, skilling, separate education versus a skill, education with a skill. Another important point I saw in your presentation, sir, the Germany. You talked about Germany in terms of the energy issue they are facing. Also, the way forward for the country. Import substitution. And third point was there that how we make ourselves strategically indispensable kind of for the world. So Germany model is, if one has to identify the biggest contributor to their success of the economy. Now they are struggling for a different reason, that is a different thing. But the middle stand, the SMEs. And SME success was their education system. The vocational training system, where you have education and a skill going together. And I saw a slide on that also, what we are doing towards skilling our population and the So we have engineers, but they are not employable. That is a challenge we are facing. So any learning we have, or we are trying to learn something from the German system, making our youth more employable, and maybe making our SMEs going forward, the world champions, the global champions. Any thought on that, sir?
No, I think that is the emphasis that the government in the last 2 budgets has put in terms of incentivizing internships, revamping the ITIs, and further amending the Apprenticeship Act, etc., and also creating the centers of excellence in artificial intelligence, etc. All these are all multiple different initiatives that try to bring the importance of vocational education back into the national mainstream. And I would also like to take this opportunity to highlight the success of Odisha under Mr. Subrato Bagchi over the 7 years period from 2016 to 2023, when he was the chairperson of the Odisha Skill Development Authority. What he did to make physical and occupational skills fashionable, respectable, and aspirational is a model that other states can emulate, and I'm glad to tell you that many states are indeed trying to emulate that model. So these are the ways in which we can replicate some of their early successes in other countries on manufacturing and in creating that Mittelstand.
Thank you, sir. Sir, another question. So the lot of economics we talked in the previous panel, and so I'm digressing a little bit, and something I saw in your presentation also. So I'm taking this liberty to digress a bit. I was listening to one of your recent podcasts, and where again I noticed a very interesting comment you made, and which is kind of not in sync with what is happening as of now. So I'll tell you what it is. What you said in this podcast was that financial system, the regulations should be principle-based. Something like that you mentioned. I know that we as a country, we started, RBI has started, particularly RBI, I talked about the banking regulator. 2014, 2015, that was the time. RBI started moving away from rule-based supervision to principle-based supervision. And 2025, CA is saying that financial sector side, we should be more on the principle, and there was a very good argument about that. We should be more on the principle-based regulation. Prescriptive, yeah, so that is essentially.
I'll come to that.
So essentially you are saying that prescriptive, so rule-based supervision. So it is kind of a different approach from what RBI is trying to do as of now, as the banking regulator. So what is the thought behind that, sir?
Yeah, so I wrote this book in 2019 called The Rise of Finance, Causes, Consequences, and Cure. And even in my remarks today, I did leave the thought on the table whether the financialization of the Indian economy in some parts has it run ahead of national imperatives or the national economic development. When financial growth happens faster than national economic growth, empirical evidence across the world tells us that countries face important challenges in either attracting talent in non-financial sectors. And the reason why I said between principle-based and prescriptive rules and regulations, the relative emphasis should be principle-based for non-financial sector and slightly more leaning towards prescriptive rules when it comes to finance. Because in non-financial sectors, competition plays the role of the regulator. In financial sector, competition can actually accentuate the risks and the imbalances, making the system more unstable. So therefore, and secondly, when the financial system therefore gets into a crisis because of excess risk-taking, then the spillover effect on the rest of the economy is substantial. And the need for a public sector bailout is inevitable. And therefore, in these situations, the public sector therefore has a moral obligation to ensure, because it is public resources that are then used for bringing the sector back to health, then naturally it has a right also to impose the kind of regulations that will prevent such an occurrence from happening. So precisely because of the distinction of the role that competition plays between non-financial and financial sectors, I made the case for a relative overweight in terms of prescriptive rules in the financial sector and principle-based rules in the non-financial sectors.
No, good point, sir, and particularly my personal view again, this is not the MD SBI view. My personal view is the maturity level in the financial ecosystem in the country. It's at different levels. So maybe one segment of the REs, the regulated entities, they are mature enough maybe for a principal-based supervision, but there will be another segment where we still need some more time at least, a rule-based supervision. So with this, sir, if you permit, maybe a couple of questions from the audience, sir. So the floor is open. Any questions?
I think people are waiting for the national anthem.
No, I think I can see one person at least. Sir. Yes, please. Sampath, go ahead.
Good evening, sir. Thank you for the wonderful presentation. Now, the question which comes again and again is that how are we going to tackle the disparity between the haves and have-nots? Has it come down, or what are the long-term strategies? How do we ensure employment to every youth who is in the country? When do we achieve that dream? More than achieving that trillions of dollars of dream, I mean, getting a good employment for our youth becomes very important.
So, first of all, I think in the limited time we have, it will be difficult to give you a comprehensive answer to an important question that you have posed. Inequality is also a function of how you measure it, whether it is in terms of consumption or income or wealth. In terms of consumption, then you have to take into account not only the resources or the disposable income that they have, and also how far it is supplemented by transfers from the states. On that basis, India's inequality is actually quite low. And in terms of income as well, if you really take into account on a post-tax and post-transfers from the state, or which means the governments, again, the so-called Gini coefficient on a pre-tax, pre-transfer basis, that comes down quite significantly on a post-transfer basis. And we have written about it in the economic survey, or also in a small compendium of special essays we brought out towards the end of 2023. This is a never-ending topic. And I think the way to look at this topic is, while all of us sort of wave our hands at inequality, because it kind of strikes at the notion of intrinsic concept of fairness which all human beings subscribe to. It's important from the perspective of public policy to continuously look at expanding the opportunity set available to people. And humans in general are far more concerned with absolute improvements in their status rather than in relative comparisons, which comes next. And therefore, the state's obligation is to make sure that every generation feels that compared to the previous generation that they have had it better, and that the succeeding generations will do better than them. As long as the public policies are able to continuously deliver on this, then inequality per se becomes a relatively secondary consideration. But as I said, this is a short time. I've given you a brief answer, but we have covered it extensively in the economic survey and in the special essay compendium in 2023. Please take a look at this.
Thank you. Thank you very much.
So one more question, if we, otherwise we'll close. So I can't see anybody. Okay, please.
Thank you, sir. In the economics survey before the July 2024 budget, it had mentions of China +1 strategy for India. I think it's echoing. So the question is on the China +1 strategy. It had mentions in the economic survey 2024. With the tariffs playing into picture, how is India positioning, currently?
So obviously, in terms of the components of imports that India takes from China, which consists largely of intermediate goods and capital goods, there is a certain dependency, because if it is finished goods, then it is easier to replace them. Capital goods and intermediate goods have a different role to play in our production process. And the way to look at it as to how to reduce our dependence, one way is to look at investment as an option, which is what the survey wrote about 1 year ago. And that is why I think it's important to first, at the first stage, focus on foreign companies located in China and exporting to India, whether it is in chemicals or infrastructure equipment or electronics. There is much scope for trying to incentivize the relocation, as we have done in the case of Apple, and there the domestic value addition is improving by the day in India. In other areas as well, we need to find ways to incentivize and invite non-Chinese companies operating in China, exporting not only to India, but also the rest of the world, and make them manufacture here, which makes us therefore less dependent on imports from China, and also gives us a gateway into becoming an important player in the global value chain.
Sure, sir. Thank you.
We'll close, sir. Thank you so much, sir. Thank you very much.
Thank you so much, Dr. Nageshwaran. I would now request Chairman SBI to please come on the stage and present Dr. Nageshwaran with a green certificate. Thank you so much, Chairman Sir and Dr. Nageshwaran. Now, we have had an insightful time these 2 days, and the key takeaways should benefit the ecosystem as we remain an integral part of the vast ensemble shaping the quest for Viksit Bharat. Now, to formally conclude the 12th SBI Banking and Economics Conclave, I invite Shri Anindya Sundar Paul, Deputy Managing Director, Finance Designate, SBI, for the vote of thanks. A huge round of applause, ladies and gentlemen.
Good evening, ladies and gentlemen. This brings us to the end of day 2 proceedings, and it is my absolute pleasure to recap today's proceedings and thereafter propose the vote of thanks. I'm sure these 2 days have been very engaging and enriching for all of us. While in his welcome address today morning, Shri Ashwini Tiwari ji, MD SBI, had already very aptly summarized day 1 events. At the cost of repetition, let me highlight the key takeaways from day 1. We began our journey with deep insights from the inaugural address by Honorable Finance Minister and Minister of Corporate Affairs on 5 dimensions of self-reliance. The lively, optimistic, diversified CEO panel sharing solutions on navigating the fragmented world order, SEBI Chairman's call for resilient capital markets for achieving self-reliance, and finally, the comprehensive takeaway by Secretary DFS on building blocks of Viksit Bharat. Day 1, in fact, moved at a very fast pace. We ended day 1 on a high note with the scintillating performance by Sri Shankar Mahadevan and his team. Day 2 has also been very informative as day 1, and let me now share a few highlights of today's discussions and then end with the vote of thanks. Can we have the next slide? Yeah. In his keynote address by Sri Sanjay Mehrotra, Governor RBI, the governor gave a historical tour on emergence of Indian banks from lows of twin balance sheet problem to a strong financial position today. He emphasized that financial stability is a prerequisite for long-term growth, and policy needs to strike a balance between stability and efficiency in the short run. Prudential regulations such as the draft ECL, Basel III risk weight guidelines, and others are well calibrated and anchored in strong macroeconomic fundamentals such as stable external accounts. Strengthening of customer grievances is a key priority, and banks must undertake root cause analysis. He also, in fact, complimented SBI for achieving the 100 billion market capitalization. There was a panel, family business panel, Scaling with Purpose. The panel was moderated by Professor Tulsi Jayakumar. This was, in fact, a diverse panel of next generational family business leaders. All the panelists agreed that there is a need to balance ambition with efficiency and technological innovation. Capital is not a constraint for family business, but requires fundamental changes such as execution and value proposition to attract capital. Pivotal role of innovation, even if it is a trivial idea. Opportunities. The panel was moderated by Ms. Ritu Singh from CNBC TV 18. The India's progress in addressing climate change is commendable since the Paris Agreement not impacted by external environment. There is a need to strike a balance between energy security and environment sustainability. Domestic market growth in India is private sector-led growth supported by clear economic rationale. The panelists observed and agreed that export-oriented sectors are the most ESG mature in India. Adaptation finance needs special attention. Business needs to take note of adaptation to address business continuity. There was a special address by T. Ravi Shankar, Deputy Governor, RBI. Some of the key takeaways were the re-emergence of protectionism and reshoring of supply chains define the current economic order. Digital public goods such as UPI, DPI have placed India as a leading example in inclusive, incremental digitization. Fundamental nature of technology is undergoing a paradigm shift. Technology is emerging as a foundation of financial intermediation. Technology adoption should be guided by justified rationale and purpose. Human capital augmentation will follow technology adoption. Banks, in fact, need to develop alternate financial products, cope with rising influence of non-bank apps, and leverage their long-earned credibility and large consumer base. So there was also an Economist Panel with the subject, Will India get older before it gets richer? Very interesting. Smoothing the odds of demographic dividends. This was moderated by Ms. Lata Venkatesh from CNBC TV 18. Some of the key observations and takeaways were, India's demographic dividend will taper off by 2037. That leaves a window of opportunity of approximately 12 years. Capital deepening and human capital augmentation to drive growth in the long run. Education is not just about acquiring knowledge, but includes wider skill sets such as cognitive ability, problem solving, creative thinking, etc. There's a need to relook at our education policy. Pace of demographic aging is heterogeneous across states, will strain the state finances in the long run. Migration may or may not balance out the impact of aging. Female labor force participation should also increase to make growth more labor intensive. Finally, special address by Sir Shri Anant Nageshwaran, Chief Economic Advisor to the Government of India. Some of the key observations and takeaways. India needs to improve to strategic indispensability to achieve strategic invulnerability. Uncertainty will affect trend growth, investment flows, trade flows, and capital flows. Developing to developed transition in the 20th century had different geopolitical context with no energy constraint. India is put behind the problem of overrating through supply-side reforms. He also highlighted the physical infrastructure development initiatives, which is the key to sustainable growth. Strengthening the MSME sector through targeted policy changes. Substantial improvement has been witnessed in making credit accessible to the MSMEs. He emphasized the importance of TREDs in improving the liquidity of MSME units. Some of the key challenges faced, he spoke in details about them. The energy affordability, energy security versus energy transition, employment generation and AI, education and skilling, something which the earlier panel had also deliberated upon, food security and agricultural productivity, the importance of deregulations. That, in short, are the highlights of all the deliberations that we had in 2 days of this economic conclave by our esteemed dignitaries and guests. Now it is my privilege to formally propose the vote of thanks. Let me begin once again thanking all the esteemed dignitaries, panelists, and audience who graced this 2-day conclave. I extend my heartfelt gratitude to Sri Sanjay Mehrotra, Governor RBI, Sri T. Ravishankar, Deputy Governor RBI, for accepting our invitation and sharing their valuable insights today. My special thanks to Sri Anand Nageshwaran, Chief Economic Advisor, Government of India, for his special address and sharing his perspective on state of the economy and where it is heading. My sincere thanks to Sri C.S. Setty, Chairman SBI, for his guidance, support, and valuable suggestions to make overall conclave topical and thought-provoking. Special thanks to the Board of Directors of SBI, Managing Directors of SBI for taking the time out to join the sessions and moderate the question and answer sessions. I express my sincere gratitude towards esteemed panelists on Family Business Panel, Green Panel, and Economist Panel for accepting our panel speaker invitation and sharing their valuable insights. My sincere thanks to the representatives of industry associations, other industry leaders for their participation. Thanks to our media partners, CNBC TV 18, especially Ms. Shireen, Ms. Lata, Ms. Ritu, and Ms. Shivani. I now thank DMD Finance, Srimati Saloni Narayan, and special thanks to Dr. Soumya Kanti Ghosh for inviting marquee speakers and his team on economic research development for the content and successfully organizing the 12th edition of the conclave. I also thank Chairman Secretariat, volunteers from other departments, PR department, business units, social media department, and their support and help, officials at Liaison Department in Mumbai and New Delhi for coordination and logistics support. Last, not the least, I thank Taj Hotel, their management, the ground staff for the hospitality and keeping us comfortable for 2 days. I thank the event manager and his team for their support in overall management of the event coordination and seamless transition between sessions. Lastly, my sincere thanks to the invisible actors who pitched in and made the event successful. With this, we draw curtains to the 12th edition of SBI Banking and Economics Conclave with the promise that we shall reassemble next year with new theme and new set of questions. I now invite all of you to join us for high tea. Have a pleasant evening, good night, and Jai Hind.